Hello, hi everyone. Good morning, good afternoon, and good evening. So, students, they are waiting for BCCA CM Inter marathons. Okay, so this video is meant for giving a clarity about the marathons, CM Inter marathons. So, this time we are going to upload marathons for every subject except OM and SM. Due to the busy schedule of Rajesh sir, we couldn't upload OMSM marathon. Okay, but last marathon you can watch and do watch the MCQs recorded, uploaded for the last attempt. Okay, and there is a surprise for you. So again for this attempt, we are going to give super 50 questions for all the 8 subjects. Sir, that you have given last attempt also. This is not a surprise. Another surprise waiting for you is we are going to provide 200 bullet MCQs, which are most important MCQs. By solving those 200 MCQs, you can score at least 20 marks. At least 20 marks. So this is a surprise for you. And what are you waiting for? I'm going to announce marathon schedule. So business law and ethics. So faculty name Vignan Deepak sir. You know him, right? So already the marathon part 1 was uploaded. So law marathon will be uploaded in 2 parts. Actually this is not a marathon. This is an exam oriented batch being uploaded as a marathon. We are not collecting any charges or a fee from students. Okay, because most of the students will be okay repeater. They might have already paid fee some other, I mean in some other coaching institute. So that's why. So we are what uploading exam oriented classes as a marathon. So law will be uploaded in 2 parts. First part already uploaded and second part will be released on 3rd May. Okay, so financial accounting first part already uploaded, already released in the YouTube. Second part will be released on 1st May and third part will be on 4th May. Okay, so Banu sir, and next direct taxation, the most charming faculty in our BCCA team, Ravi sir. So the first part will be coming on 30th April and the second part will be coming on 6th May. So 2 parts DT. Indirect taxation, okay. So IDT Guru, he is popularly known as Manideep sir. Already part 1 was uploaded. So there is only one part for IDT, indirect taxation, okay. So already the video uploaded. Costing by Shiva sir, Shining Shiva sir. Part 1 will be uploaded on 28th April and the second part will be uploaded on 5th May. Corporate accounts and audit, Verma sir, 2 parts and first part will be uploaded on 4th May, second part will be uploaded on 7th May. Financial management by Ravi Kumar sir, that is me, and first part will be uploaded on 29th April, second part will be uploaded on 2nd May. Management accounting again by Shining Shiva sir. Part 1 will be uploaded on 8th May. So part 2 on 11th May. Actually not uploaded, will be made public because all the lectures were uploaded and scheduled for respective dates. So you need not worry. So there won't be any delay. There won't be any delay. There won't be any delay because already the classes were recorded and uploaded and scheduled for respective days. Okay, so do watch these marathons and do share your feedback. Please mention in comments from where you are watching these marathons, and if you want anything else, if you want any guidance how to read theory, how to approach a practical subject, if you want anything, if you have any problem, please let us know in our comments. And one more thing, so we have created a separate telegram group for each subject. We have a BCCA main telegram group. Other than that main telegram group, we have created a separate telegram group for every subject. Do join in those telegram groups. Telegram group links will be provided in the description. So do join those telegram groups and do ask doubts. Interact with faculty. So faculties will be helping you, okay, to clear CMA Inter in June 2025. Am I clear? Okay. And if you are looking for any classes, then these are the prices. Right now 20% offer is going on. So CMA both groups price 39,999, group 1 21,999, group 2 21,999. and books. Okay, so first student will be watching our book and then they watch our YouTube channel. Okay, so BCCA is famous just because of books. So 5999 both groups, group 1 2999 and group 2 2999. And students who are watching marathon, who have decided to watch marathons, they must have a books of a BCCA, because questions were discussed from BCCA study material. So that's why do purchase the books, and the course links will be provided in the description. Clear? Am I clear? Any other doubt? No. So do let us know. So whatever the doubt you have, if you have any difficulty in CM Mentor, for suppose if you are not willing to write examination, if you want to postpone, if you want any counseling, anything, any kind of a help, please do join in our Telegram groups and you can ask to the respective faculty any doubt. Okay, am I clear? And so eagerly waiting to meet you in CMA final. So let us rock together. Thank you so much. Thank you all. Financial management. So first chapter, introduction to financial management. Introduction to financial management. So financial management is concerned about two aspects: procurement of fund, effective utilization of a fund. Procurement of a fund, effective utilization of a fund. Okay, so financial management, if you see the topics, financial management. So first topic, what is the first topic? Introduction to financial management. Introduction to financial management, the first topic, introduction to financial management. So we are going to learn basics of a financial management in first chapter, introduction to financial management. So financial management is concerned about two aspects: procurement of fund, effective utilization of a fund. How to procure fund, and second part is effective utilization of a fund. So first part, introduction to FM. Second part, we can say second part as a procurement. Procurement of funds. Procurement of a funds. The next third part, utilization of funds. Utilization of our funds. The next part, financial analysis. Financial analysis. Financial analysis. So in FM we are going to discuss total 4: introduction to FM, basics of FM. Okay, and next second, two aspects of financial management or procurement of fund, effective utilization of fund. So next last one is financial analysis. So procurement of fund. Procurement of fund. Under procurement of fund category, we are going to discuss cost of a capital. Cost of a capital. Cost of a capital. Next, financial institutions and instruments. Financial institutions and instruments. Financial institutions and instruments. Third, capital structure. Capital structure. risk and return, risk and return, cost of a capital, financial institutions and instruments, capital, structure, risk and return. Time value of a money comes under introduction to FM. Time value of a money comes under what? Introduction to FM, because that is useful for both procurement of fund and effective utilization of a fund. Okay, so that's fine. Next, utilization of a fund. Capital budgeting, capital budgeting, working capital management, working capital management, utilization of fund, capital bursting and working capital management. Next, financial analysis. Ratio analysis, ratio analysis. Second, cash flow statement. Third, fund flow statement. And dividend decisions comes under a different one, because there are three types of decisions, four types of decision in SFM. Okay, strategic financial management, there are four types of a decision, but whereas in FM, okay, there are three types of a decision. Financing decision, that means from where to procure money. Investing decision, where to put money. Dividend decision, whether to declare a dividend or not, whether to declare a dividend or not. So that comes under a different category, dividend decision. I think all the chapters are covered, right? Okay, so dividend decision. So how many marks you will be getting from FM? Descriptive, first question, descriptive 7 marks. Next, so 8A, 8B from business data analytics. Okay, so you will be getting 7 marks from, out of 98, 21 marks from business data analytics. So remaining 77 marks from FM. So descriptive you will get 77 marks from financial management. Okay, so this is our syllabus. So financial management. So first, if you see the balance sheet, so there are two, assets and liabilities. Yes or no? Assets and liabilities. First, financial management is concerned about procurement of fund and effective utilization of a fund. Effective utilization of fund. If you see the balance sheet, on the liability side, you will find the procurement, and on the asset side, utilization. On asset side, utilization. Yes or no? So nothing but balance sheet, liability side, procurement, asset side, utilization. Asset side, utilization. Okay. So nothing but if you see the balance sheet, simple balance sheet, you will be finding two sources. You will be finding two sources for procurement of a funds. What are the two sources? One is equity. Equity means what? Own fund. Equity means own fund. And second one is what? Debt. Okay. So procurement, on liability side you will be finding two sources, equity and debt. Yes or no? That equity can be a face value of 100 rupees, 10 rupees, 5 rupees, etc. And you will be finding a debt. That can be a long-term debt or short-term debt. Long-term debt or short-term debt. Okay. So debt. And in case of a debt also, that can be 10% debenture, 12% debenture, 16% term loan, 16% term loan. That can be of any kind. But generally, if we summarize, there can be two sources. One is equity, second one is debt. Then what about preference? Preference share capital. Preference is called as a hybrid capital, hybrid source. Hybrid means there are two breeds. One is equity, second one is debt. For example, in case of a preference share capital, company has to pay fixed rate of a dividend. Fixed rate of a dividend. This is a feature of a debt. This is a feature of a debt. There are no voting rights to the preference shareholders except in few cases. There are no voting rights. There are no voting rights means what? There are no voting rights. This is a feature of debt. This is a feature of what? Debt. But whereas we pay dividend only if there are profits. We pay dividend only if there are profits. This is a feature of equity. This is a feature of a equity. Yes or no? So that means what? Simple. So it is having a features of both debt and equity. So that's why preference share capital is called as a hybrid. Sometimes we categorize preference share capital as a equity. Sometimes we categorize it as a debt. Depends. Okay. In most of the cases we categorize preference share capital as a equity. Preference share capital as a equity because we pay dividend only if there are profits. If there are profits. So if you see the balance sheet on liability side, you will be finding two sources. One is equity and the second one is debt. Okay, after procurement of fund, we utilize the fund for two purposes. What are the two purposes? Fixed assets and current assets. Fixed assets, current assets. Accounting is concerned about recording of a transactions. Accounting. But whereas financial management is concerned about what? Procurement of funds and effective utilization of a funds. Effective utilization of funds. So if you see the utilization, we utilize the fund for two purposes. Fixed assets, current assets. Okay. So investment in fixed assets, we are going to discuss this under capital budgeting. Okay, investment in current assets we are going to discuss under working capital management. Working capital management. Are you getting my point? So we utilize the fund for two purposes. What are the two purposes? Fixed assets and current assets. If you see the utilization of funds, we are going to discuss two topics. One is the capital bursting and the second one is working capital management. So again in final we are going to discuss this first same topic, capital budgeting. So first topic of SFM is capital budgeting. Okay. So clear? If you see the balance sheet, liability side procurement of fund, asset side utilization of a fund. So first of all, financial management. So whenever you want to start a business, what is the first step? First you have to decide a business. What type of a business you want to start? Yes or no? What type of a business? For example, Manoj, he wanted to start a business. He wanted to start a business. Okay. So textile business. He wanted to manufacture, okay, shirts and jeans. So textile business. What is the first step? First, he has to estimate the capital. He has to estimate the capital. First, common sense, estimate the capital. And how we estimate the capital? How much we require for fixed assets? That is for land, building, plant and machinery. And second is, okay, working capital. Working capital, current assets. For example, if you go to the DMart, always you will find a stock. Yes or no? Always you will find, okay, stock. Yes or no? So that is nothing but what? Investment in working capital. Current asset. Stock is a current asset. We purchase and sell. We keep on selling the stock. Yes or no? So that stock is nothing but what? Working capital. For example, we have to maintain some amount of a cash depending upon the size of an organization. For example, when you are in 10th class, you might be maintaining a cash of a 500. Yes or no? Okay. So why you maintain a cash? The cash is maintained for the purpose of a transaction. Cash will be maintained for three purposes. First purpose, transaction need. Transaction need. For example, right now also you might be maintaining a cash, 100 rupees or 500 rupees. The purpose of maintaining cash is first purpose, transactional need. Transactional need. That means you might need money for purchase of a snacks, right? So that is transactional need. Second purpose of maintaining a cash is safety need. Safety. Safety need. Safety need means nothing but if you, in case of emergency, you might get hospitalized, yes or no. For that you might maintain a cash. That is safety need. Third purpose is speculative need. Speculative need. For example, one or two boys might maintain a cash for the purpose of IPL betting. So they are also maintaining a cash. The purpose is not safety. The purpose is not transaction. The purpose is what? Speculative. They wanted to make a profit out of a speculation in this season. In this season. Likewise, organization also has to maintain a cash depending upon a size. For example, in 10th class you might have maintained 500, but right now you might be maintaining what? 1000. So after 2 years you might maintain what? 2000 rupees cash. Yes or no? So because your transactional needs increases. Transactional needs increases. Likewise, BCCA has to maintain some amount of a cash. Why BCCA has to maintain a cash? Why it has to maintain a cash? Simple, to meet the transactional needs. For example, so 500 rupees will be given to a person who gets a first mark in FM. So this announcement has been made. Okay. Manoj got first marks. He is expecting 500 rupees. But college is not giving that cash 500 rupees. Okay. Due to lack of a liquidity. Due to lack of a liquidity. Liquidity means what? We have a AC, building, benches, everything is there, but we do not have a cash. We are not giving 500 rupees to Manoj. What Manoj will be doing? Manoj will be telling to everyone or not? Manoj will be telling everyone. So BCC is not giving 500 rupees, yes or no? So whether it will affect reputation or not? Obviously it will affect reputation. For example, salary is not paid on time to the sweeper. Okay, salary is not paid on time to the in charge. Whether they will be telling to the third parties or not? Yes. So that will ruin our reputation or not? Yes, that will affect our reputation, image. So that's why in order to avoid this late payments, we have to maintain some amount of a cash. For example, some student might require 1000 rupees in emergency. So we have to give yes or no. So for suppose if we are not giving 1000 rupees, then what? That will change the image of a college, yes or no. So that's why depending upon the size of an organization, every organization has to maintain some amount of a cash. Okay. So the cash comes under what? Working capital. Cash comes under what? Working capital. Cash includes bank balance also. Cash includes bank balance also. Here cash means bank balance as well as cash equivalents. Cash equivalents. Cash equivalents example, marketable securities. Marketable securities. Marketable securities means the shares or a bonds which can be sold at any point of time. Generally shares will not come under marketable securities because shares can be sold at any time, but there is no safety. Share price will keeps on fluctuating. Okay, so that's why generally treasury bills comes under a category of marketable securities. Marketable securities means securities which can be immediately converted into cash. So that means whenever you decide to start a business, the first step is to estimate a capital. Estimate a capital. In that capital, so we use that money for fixed assets and current assets. Simple, visualize. Okay, if you want to start any business, first step is to inquire. If you want to start a brewery, beer making, you might have seen brewery, yes or no? So first you have to inquire how much Okay, does the machinery cost? Yes or no? Estimation. Estimation of a capital is the first step. Okay. Next step is to what? Procurement. Next step is to what? Procurement. Procurement of a fund. So we have to procure a fund. Second step. Okay, fund is procured. What is the third step? Utilization. Third step is what? Utilization. Okay. In between, so there will be a decision making. After estimation of a capital, after estimation of a capital, you will be deciding whether that business is feasible or not, business is profitable or not, that investment decision is profitable or not. So that we are going to learn under a chapter, capital budgeting. Capital budgeting. Okay. So clear. First step is what? Business estimation of a capital. Second step, procurement of fund. Third step, utilization of a fund. Utilization of a fund. So financial management is concerned about procurement of fund and utilization of a fund. How to procure a fund? So okay, for procurement of fund, there are two sources: equity, debt. There are only two sources: equity, debt. We can call it as own, loan. Own fund, loan fund. Own fund, loan fund. Debt and equity. Equity is a own. Equity is a own fund. Okay. So while procuring fund, we need to consider four factors. We need to consider four factors. While procuring fund, we should consider four factors. We should keep in mind four factors. Okay. So let us write next. While procuring fund, we should consider four factors. While procuring fund, we should consider four factors. Four factors to be considered. Four factors to be considered while procuring funds. While procuring funds, we should consider four factors. There are two sources: equity and debt. Equity and debt. So from which source we should procure a fund? Whether a debt or equity. Debt or a equity. For example, BCCA want to go for expansion. BCCA want to procure funds. BCCA want to procure funds. There are two sources. Okay. Equity, debt. Let us assume girls are interested in equity. Girls are interested in equity. Boys are interested in debt. Boys are interested in debt. So BCCA. Okay. So four factors. Four factors. Factors, debt. For basics, I will take time. Factors, debt, equity. First factor, control. First factor, control. Okay. From which source we should procure a fund? We cannot procure fund only from debt or a equity. Okay. So we have to keep in mind four factors while procuring a fund. That means especially a promoter. Promoter means a person who gets an idea of starting a business. Okay. Promoter means a person who gets an idea of starting a business. In case of textile manufacturing, promoter is Manoj is the promoter. Manoj is the promoter. He got an idea to start a business. Yes or no? So likewise BCCA, okay, from promoter point of view, company point of view. Company point of view. Company point of view, there are two sources. One is equity, Okay, and the other one is debt. The other one is debt. Clear? So first point to be considered is control. What is this control? Decision making. For example, right now I am taking all the decisions. Okay? Yes or no? So for suppose if I am taking a debt, I am issuing debentures to boys. Will boys will get any voting rights or not? Boys will not be getting any voting rights. Yes or no? So are they going to participate in decision making or not? They are not going to participate in decision making. They are not going to participate in decision making. Yes or no? So that means completely I will be taking a decision. For suppose if I procure fund from debt, if I procure fund from debt, all the decisions will be taken by me only. Okay, like in the existing case. Yes or no? Okay. Second, instead of taking debt, I am getting funds from equity. Okay, equity. Equity means whether these girls will get voting rights or not. These girls will get voting rights. So they will attend general meeting. They will attend general meeting. Before passing any resolution, I have to consider them also. Yes or no? Resolution means decision. So will they participate in a decision making or not? They will participate in decision making. Now let me know. So girls are going to participate in a decision making. Is it an advantage or a disadvantage? Advantage or disadvantage? Advantage or disadvantage? So that is a big disadvantage. So they participating in decision making is a big disadvantage. Why? The reason is simple reason. The control will get diluted. One state should have only one CM. If there are 4 chief ministers, what happens? Decision making will get delayed. Yes or no? First, suppose if they participate in decision making, then decision making will get delayed. First point. Yes or no? We cannot bring consensus. Consensus means consent. Okay, so consensus will not be arising. So that's why, and no promoter, okay, wants to dilute their control. Every promoter wants to have a control over the ownership. Yes or no? So that means so control should get diluted or not? Control should get diluted or not? Control should not get diluted. If a control should not get diluted, that means I should go for equity or a debt. I should go for a debt or equity. I should go for debt. I should go for debt. Are you getting my point? So that means while procuring fund, I should keep 4 factors in mind. First factor is control. So from control point of view, which source is the best one? Debt. Yes or no? If I go for equity, they keep on questioning me. Yes or no? Why you bringing boys from that campus to this campus? Why not to keep classes there itself? Yes or no? They keep on involving in a decision making. So that's why I generally, any promoter, they don't want to lose their control. That means which is the best one? That is the best one. That is the best one. So from risk point of view, control point of view. Next, risk. Next what? Risk. From risk point of view, which is the best one? First you have to understand the risk meaning. Risk means general meaning. Okay, generally. For example, Lohit is getting married. We say, why you taking risk? Yes or no? Okay. So likewise, so Baladitya, he is sitting beside what Abhi. We call why Balati, why you are taking risk? Yes or no? What is the meaning of risk? Risk. We many a times mention risk. For example, if somebody junior joining CMA, you might say them, why you're taking risk, yes or no? So the point is, now risk means what is your intention actually? What is your intention? Risk, risk. Every time you will be mentioning risk. Okay. So for example, Rakesh, he is walking on opposite to the train. So Rakesh, he is taking what? Risk. So what is that risk? Risk means possibility of occurrence of a loss. Possibility of occurrence of a loss. Risk means what? In brackets, write it down. Possibility of occurrence of loss. Possibility of occurrence of loss. Possibility of occurrence of loss. Okay. So the point is, Rakesh is walking opposite to the bike. Whether he is taking risk or not, yes. He is walking opposite to the lorry. Risk is increasing or decreasing? Increasing. Opposite to the train. Risk is increasing. Yes or no? Walking opposite to the wife. Risk is increasing even more. Yes or no? Risk means what? Possibility of occurrence of loss. Here there is a high risk when he is. So the point is, risk means possibility. It doesn't mean compulsory he is going to get a loss. There is a high possibility of a occurrence of a loss, risk. Okay. From company point of view, there are two sources. One is equity, second one is debt. Okay. If I take debt, I have to pay interest. Yes or no? If I take equity, I have to pay dividend. Now tell me whether payment of a dividend is mandatory or not mandatory. Payment of a dividend is not mandatory. It is not compulsory. I need not pay dividend, right? So what about payment of interest? I have to pay interest. Compulsory. For example, okay, the financial position of a company is not good. Still, Bharat will forego the interest or not? No. Debenture holder will forego the interest or not? No. Compulsory, I have to pay interest. Yes or no? So, what about dividend? Payment of a dividend is not mandatory. Yes or no? So first board has to recommend, board of directors has to recommend payment of a dividend. Then shareholders has to approve the payment of a dividend in a general meeting. That too, I will pay dividend only if there are profits. So tell me which is risky, debt or equity? That is risky. If a business is good, okay, fine. But if his business is not going well, then there is a possibility of occurrence of a loss. So the point is risk. So we want high risk or low risk? High risk. If you want high risk, then join CA. Want high risk or low risk? Everybody want what? Low risk. Yes or no? So low risk means which is the best source? Equity is the best one. So it is better to take investment from girls, right? So from risk point of view, which is the best source? Equity. Okay. Are you getting my point? Risk. Next, cost. Cost, simple meaning, brackets, write expectation. Cost. In bracket, write it as an expectation, cost. Here cost means expectation. So do not write the definition given in cost accounting. Here the cost means expectation or required return. Expectation. We can simply call it as an expectation. Okay. So expectations should be high or low? First point. Expectations should be high or low? Expectations should be high. Okay. For example, Ganesh, he is expecting a wife. Okay, he is expecting a wife. Okay. And she must be a qualified CMA. She must be a qualified CMA. Okay. So good looking. Okay. Food అది ప్రిపేర్ చేయాలి. సో హీ హ్యాస్ సమ్ ఎక్స్పెక్టేషన్. ఓకే, మర్డర్ అది చేయకూడదు. ఈ మధ్య అవుతున్నాయి కదా. సో సో బేసిక్ ఎక్స్పెక్టేషన్స్, గణేష్ ఎక్స్పెక్టేషన్స్. నౌ ద పాయింట్ ఈస్, సో the girl is a qualified CMA, but she is not preparing a food. Now the point is, the value of a girl will be increasing or decreasing? Decreasing. Value means a wealth. Value means a wealth. You told that expectation should be high. That is exactly opposite. We should have a low expectation. We should have a low expectation. We should have a low expectation. Low expectation. For example, so after, this class, you should expect a breakfast, that's it. But if you are expecting, okay, fruits, salad, juice, etc., etc., and if you are finding upma there, then what happens to the upma value? Will get decreased or increased? Upma value decreases. If you are keeping your expectations high, then the value decreases. But if you are keeping a low expectations, for example, Lohit expecting just a breakfast, okay, so but they are serving upma, then what happens? The value increases. Value increases. That means expectation should be low. Others must have a expectations low. Others must have a low expectations. Low expectation. అర్థమవుతుందా? అంటే ఏంటి, గణేష్ అనేవాడు వైఫ్ చంపకపోతే చాలు అనుకున్నాడు. ఊరికే కొడుతూ ఉంది. ఏమనుకుంటాడు? మా వైఫ్ చాలా మంచిది అనుకుంటాడా లేదా? షీ ఈజ్ వెరీ నైస్ టు మీ అనుకుంటాడా లేదా? హర్ వాల్యూ ఇంక్రీజెస్ ఇన్ హిస్ పర్సెప్షన్ ఆర్ నాట్? ఎస్, ఆబ్వియస్లీ. అర్థమవుతుందా? అలా కాకుండా లేదు నేను నుంచున్నాను, అరిస్తే నీళ్లు తీసుకురావాలి, ఫుడ్ తీసుకురావాలి అని అనుకున్నాడు అనుకోండి. అలా ఎక్స్పెక్టేషన్స్ ఎక్కువ ఉంటే అర్థమవుతుంది. ఎప్పుడన్నా వాటర్ తీసుకుని రాకపోయినా ఏమనుకుంటాడు? ఇదేంటి ఇలా ఏంటి వైఫ్ అనుకుంటాడు. అలా కాకుండా డైలీ న్యూస్లు చూస్తూ ఉంటే మనవాడికి ఏంటి ఎక్స్పెక్టేషన్స్ తగ్గుతూ ఉంటాయి. వైఫ్ వాల్యూ ఏమవుద్ది? ఇంక్రీజ్ అవుతూ ఉంటుంది. అర్థమవుతుందా? సో ద పాయింట్ ఈజ్ ఎక్స్పెక్టేషన్స్ షుడ్ బి లో. వెన్ యూ హ్యావ్ అ లో ఎక్స్పెక్టేషన్స్, వాల్యూ increases. Value increases. So that's why our happiness also depends upon our expectation. If you have a low expectation, then you will be very happy. When you have a low expectations, when your expectation increases, then happiness decreases. Happiness tagipoddi, avuna kada? So that's why some people who clear first group, they celebrate like anything. So but some students, even they have cleared both groups, they won't be celebrating, because that depends upon a perception. Value completely depends upon a perception, because value depends upon a perception, expectation, and everybody's expectation will not be same. Everybody's expectation will not be same. Now my point is, cost means a expectation. Cost means a expectation. Expectation of a debt holders and expectation of a equity shareholders. Who will have a high expectations on a company? Who will have a high expectations on a company? Okay, for example, debenture holders, they will be expecting only interest. What about equity shareholders? Equity shareholders will expect profits. So that means their expectations will be more than the debenture holder or less than? More than. For example, company is willing to pay 10% rate of interest. 10% rate of interest, irrespective of a financial position of a company. Okay. సో ఇప్పుడు షేర్ హోల్డర్స్ పాయింట్ ఆఫ్ వ్యూ, ఇన్వెస్టర్స్ పాయింట్ ఆఫ్ వ్యూ చూస్తే, ఇన్వెస్టర్స్ పాయింట్ ఆఫ్ వ్యూ చక్కగా ఏ రిస్క్ లేకుండా 10% ఇంట్రెస్ట్ వస్తుంటే, వితౌట్ ఎనీ రిస్క్, ఇన్వెస్టర్స్ పాయింట్ ఆఫ్ వ్యూలో 10% ఇంట్రెస్ట్ వస్తుంటే, గర్ల్స్ అందరూ ఏం చేశారు? Magoddu 10% interest. We don't want 10% interest. We want to make investment in equity shares. అన్నారు అంటే దట్ మీనింగ్ ఏంటి? వాళ్ళ ఎక్స్పెక్టేషన్స్ 10% కన్నా ఎక్కువ తక్కువ? దే ఆర్ ఎక్స్పెక్టింగ్ మోర్ దాన్ 10%. దే ఆర్ టేకింగ్ రిస్క్. They are taking risk. Company is not taking risk in case of equity. Equity shareholders are taking risk. So okay, so that means generally expectations of equity shareholders will be greater than the expectation of debenture holders on a company. So on company they have more expectations, equity shareholders. Now my point is, expectation should be high or low? Expectation should be low. Expectations should be low. Are you getting my point? For example, from Ganesh, parents must have a low expectations. Low expectation. Ganesh should qualify. Okay, so single group. If that is the expectation, and if he clears both groups, then the value will increase. For suppose parents are expecting a rank. Parents are expecting a rank from Ganesh, and if he clears only a single group, then value will get decreased. Yes or no? I cannot meet the expectations. If there are high expectations on a company, if a company doesn't meet the expectation, then the value of a company decreases in the perception of investors. So that's why we should select which source, debt or equity. Which source I should select? Debt or equity? Debt or equity? I should select what? Debt. From cost point of view, which is the best option? Debt is the best option. From cost point of view, which is the best option? Debt is the best option. Cost of a debt is always less than the cost of a equity. You will be getting an MCQ, multiple choice question. Cost of a debt is always less than what? Cost of a equity. Clear? So while procuring fund, we should consider 4 factors. We should keep 4 factors in mind. 4 factors in mind. First factor, control. Control should not get diluted. If a control should not get diluted, then I should go for what? I should go for debt. Risk. If I want less risk, I should go for equity. I should go for equity. Cost point of view. Debt. Cost means expectation. Why I should go for a debt? So I should select a source which is having a low expectations on a company. I'm talking about the company from the perspective of a company, business perspective. Okay, so this cost itself is a cost of a capital chapter. Cost of a capital. In our syllabus, why we are learning cost of a capital chapter? Because the reason is, while procuring fund, we should keep in mind 4 factors. One of the factor is what? Cost of a capital. Cost of a capital. Okay, so next, so let us discuss 4th factor later on. Next one, what is the object of financial management? Why we are learning financial management? Object of financial management is profit maximization, wealth maximization. Superior objective is wealth maximization. Superior objective is wealth maximization. Superior objective is wealth maximization. Objective of FM. Wealth is different from profit. Wealth is different from profit. Objectives of FM. Objectives of financial management. A. wealth maximization. B, profit maximization. Wealth maximization, profit maximization. So both are different. Wealth is different from profit. Wealth is different from profit. Okay. Wealth is completely different from what? Profit. Wealth is different from profit. Okay. So wealth means what? For example, I'm asking what is your wealth? Wealth means he might say, sir, we have a 2 acres of a land. 2 acres of a land, and each acre cost 50 lakhs. So total we have a 1 crore wealth. That is wealth. If I ask what is the profit, so this year we got a loss. Will you saying this year we got a loss this year? Okay, that means on 2 acres of a land, so they might have got a, in farming they might get loss, yes or no? So profit is different from wealth. For example, this building, if this building belongs to Vinod, the rental income is a profit, rental income is a profit, building is a wealth, building is a wealth. Okay. So for example, these benches are benches, AC, okay, TV, camera, mic, everything is a wealth. Everything is a wealth. But fee received minus expenses, that is profit. That is profit. So what should be the objective? Generally, why we are learning financial management, why we are taking up decision, financing decision and investing decision. Why are we procuring fund and why we are investing fund? The purpose of procuring and investing the fund is maximizing the profit and wealth maximization. Profit maximization and wealth maximization. So both are different. Both are different. Profit maximization is different from wealth maximization. Generally, we have a perception that if a profit maximizes, then obviously what happens? Wealth will also maximize. No. If a profit generally increases, then what happens to wealth? Wealth will also increase. Wealth will also increase. This is the basic perception, but that is completely wrong. That is completely wrong. For example, let us assume, so the BCCA objective is to maximize the profit. Let us assume. If the objective is to maximize only the profit, then what we can do is, okay, so instead of hiring, okay, so around 15 faculties, so 3 or 4 faculties, each faculty might take what? 3 to 4 subjects. Yes or no? And instead of teaching regular class, EVO class and marathon, so we can teach only what? Regular class. So that's how we can save money. Automatically profit what? Increases. Profit increases. In short run, okay. In short run, okay, fine. We might get profits. But what about long run? In long run, the pass percentage might decrease. Okay, the reputation, the image of a college might damaged. So that's why what? Okay, the value of a company will get decreased. Are you getting my point? So generally we have a perception that if a profit increases, wealth will also increase. No. Generally in profit, we have a short run aim and we ignore the risk factor. We ignore the risk factor completely. We ignore the risk factor completely. But whereas wealth, in case of a wealth, we consider 2 factors. Wealth depends upon 2 factors. What are the 2 factors? Wealth depends on 2 factors. One is profit and second one is risk. One is profit and second one is risk. Wealth depends upon 2 factors. One is profit, second one is risk. Okay, so basic fundamental very important. So I will be taking time. Wealth. The superior objective of FM is wealth maximization, and wealth depends upon two factors. One is profit, second one is risk. Generally, a profit or a benefit increases, the wealth, the value will also increase. For example, so nothing but what? If a profit increases, what happens to wealth? Wealth increases, no doubt. Okay, so profit increases, wealth increases. But if a profit decreases, wealth decreases. But profit alone is not deciding the wealth. Wealth depends upon two factors. One is profit, second one is risk. Profit and the second one is risk. Okay, so let me take an example for profit. For example, this building belongs to Vinod. So this building is located in Nujvid, right? Yes or no? Okay, so the same area building, okay, located in Hyderabad, and the building is owned by Vasant. Who will get a more rent? Vasant will be getting a more rent because Vasant building is located in Hyderabad. Obviously, he will be getting more rent. What about the value of a building? Which building will have a more value? Hyderabad building will have a more value, obviously. That means if a profit increases, wealth increases. Okay, for example, Bharat, he is running an auto between Nujvid and Mettagudam. He will get profits or not? He will get profits or not? Yes. Auto will have some value or not? Auto will have some value. Okay. So, for example, Yoteja operating a flight between, okay, Hyderabad and Guwahati, operating a flight. So, Yoteja will get some profits or not? Yoteja might get some profits. So, value of a flight will be more than value of auto, or vice versa? Flight will have a more value than a auto. Nothing but if a profit increases, wealth increases. If a profit increases, wealth increases. Are you getting my point? Clear? So, but what about next one? Risk. If risk increases, risk means a possibility of occurrence of a loss. If risk increases, okay, risk increases. For example, some of your friends might have joined BBA or BCom, right? Okay, you joined CMA. Who is taking more risk? CMA student is taking more risk. You will have a more expectation, or BBA student? Who will have a more expectation? CMA student will have a more expectation. Yes or no? BBA student might be expecting a job. Yes or no? 10,000 or 15,000 salary, and you will be expecting what? More salary, right? That means if risk increases, expectation. What? Expectation. Required return. Nothing but what? Required return, or we can call it as expectation. If risk increases, expectation increases. We can take one more example. Boys, they are interested in debt. Girls interested in equity. From investors' point of view, who are taking more risk? Equity shareholders are taking more risk. So that means equity shareholders will have a more expectation. Already we have seen cost. Equity shareholders will have a more expectation. That means if risk increases, expectation increases. If expectation increases, value decreases. If expectation increases, value decreases. We are going to discuss numerical examples, but right now, simple. If expectation increases, our happiness decreases. Expectation should be low. Okay, at 9 o'clock, you should expect only a breakfast. That's it. Okay. Then what? After seeing Upma, you will get a smile on your face. Yes or no? Okay, so value increases. If you are keeping your expectations low, value increases. If your expectation increases, value decreases. అంతేనా కదా? Okay. For example, after 11 o'clock, most of your friends will be keeping status, sad status, feeling alone. చాలామంది పెడతారు సాడ్ స్టేటస్లు, సాడ్ సాంగ్స్. మోహన, పవన్, మీరు అబ్జర్వ్ చేస్తే కనుక మీ ఫ్రెండ్స్ చాలామంది, మోస్ట్ ఆఫ్ ద స్టూడెంట్స్, ఐ మీన్ ఫ్రెండ్స్ విల్ బి కీపింగ్ అ సాడ్ స్టేటస్. ఎప్పుడు 11-11:30 ఆ టైంకి సాడ్ సాంగ్స్ ఉంటాయి. అంటే ఎవరో చెప్పినవి ఉంటాయి కదా, కొటేషన్స్ ఏవో కూడా, కొటేషన్స్ ఏవో ఉంటాయి నార్మల్గా, సాడ్ కొటేషన్స్. లేదా సాంగ్, ధనుష్ సాంగ్ ఉంటుంది కదా, లక్కన్న మాట నిల్లు నిల్లు, అది వినడం. ఓకే, ఇట్లాంటివి చేస్తుంటారు బేసిక్గా. ఇదంతా నార్మల్గా ఆలోచిస్తే ఏంటంటే తిన్నదరక్క మామూలుగా. ఈ జనరేషన్లో మోస్ట్ ఆఫ్ ద పీపుల్ ఆర్ డిప్రెస్డ్. ఎవ్రీబడి ఫేసింగ్ అ మెంటల్ ఇష్యూస్, మెంటల్ హెల్త్ అంటో, మెంటల్ హెల్త్ ఇష్యూస్. అంటే దే ఆర్ నాట్ హ్యాపీ. ఎందుకు అంటే రీజన్ లేదు. ఫర్ ఎగ్జాంపుల్, మనం 90స్లో కానీ 2000స్లో కానీ చూసినప్పుడు వి యూస్ టు వెయిట్ ఫర్ అ మూవీ టు వాచ్ ఆన్ సండే. ఏదో ఒక మూవీ కోసం సండే వరకు వెయిట్ చేయడం, చూడడం. అది కూడా ఏంటి, ఊర్లో ఎవరో రిచ్ ఫ్యామిలీ ఉంటే వాళ్ళ ఇంటికి వెళ్ళి చూడడం కదా. ఇప్పుడేంటి, యూ హ్యావ్ అ ఓటీటీ సబ్స్క్రిప్షన్, యూ కెన్ వాచ్ ఎనీ మూవీ, వదలకుండా అన్ని మూవీస్ చూస్తున్నాం. అంతేనా? ఇఫ్ యూ వాంట్ టు హ్యావ్ అ మటన్ వన్స్ ఇన్ అ మంత్ ఆర్ వన్స్ ఇన్ ఎ ఇయర్ కదా. చికెన్ అంటే వన్స్ ఇన్ ఎ వీక్ అయి ఉండొచ్చు స్పెషల్. ఇంకేదైనా స్నాక్స్ లాంటివి అయితే సంక్రాంతి, పొంగల్, మేబీ తెలంగాణ అయితే దసరా. మరి ఇప్పుడు మధ్యాహ్నం కావాలని కూడా యూ కెన్ ఆర్డర్ బిర్యానీ, ఎస్ ఆర్ నో. పేరెంట్స్ కూడా కోఆపరేట్ చేస్తున్నారు. ఓకే. అండ్ ఫర్ ఎంటర్టైన్మెంట్ యూ హ్యావ్ అ ఓటీటీ సబ్స్క్రిప్షన్. ఇన్స్టాలో చాలామంది ఉన్నారు చాపరీలు, అవునా? సో ఎంటర్టైన్ చేయడానికి రీల్స్ చేస్తూ చాలామంది ఉన్నారు. బట్ స్టిల్ డిప్రెస్డ్. స్టిల్ ఏంటమ్మా డిప్రెస్డ్. ఎందుకంటే రీజన్ తెలియదు అంతే. 11 o'clock ఫీలింగ్ అలోన్ అంటే ఎవడొస్తాడు నీతో 11 తర్వాత కూడా? ఎందుకు వస్తాడు? 11 దాకా, అప్ టు 11 అందరూ కలిసి తిరిగి, ఓకే సరదాగా తిరిగి ఇంకోటి చేసి 11 తర్వాత ఫీలింగ్ అలోన్ అంటే అటు పడుకోడా? ఇంకా నీతో కూర్చొని కబుర్లు చెప్తూ నేను పడుకోబెట్టి వాడు పడుకోవాలి. ఎందుకు పడుకుంటాడు అలాగా? ఎవడికి ఉంటుంది అంత టైం? ఫీలింగ్ అలోన్ అని స్టేటస్లు చూసే ఉంటారు మీరు, మీలో చాలామంది పెట్టుంటారు ఆల్రెడీ ఆ స్టేటస్. లేదా బ్యాక్ స్టాబింగ్ అని స్టేటస్లు పెట్టడం. బ్యాక్ స్టాబింగ్ ఎందుకంటే బస్ నీకన్నా ముందు ఎక్కాడని, అంతే, ఏముండదు అక్కడ. మళ్ళీ దానికి బ్యాక్ స్టాబింగ్ అని, లేదా విండో సీట్ ఇవ్వలేదనో, ఇట్లా చిన్నవి. సో ద పాయింట్ ఏంటంటే ఇక్కడ హ్యాపీనెస్ ఆఫ్ ప్రెసెంట్ జనరేషన్ ఈజ్ డిక్రీజింగ్ బికాస్ దేర్ ఎక్స్పెక్టేషన్స్ ఆర్ ఇంక్రీజింగ్. ఎక్స్పెక్టేషన్స్ ఇంక్రీజ్ అయ్యాయి. ఎక్స్పెక్టేషన్స్ వచ్చేది మనకి చాలా ఉన్నాయి, అర్థం ఉందా? ఇప్పుడు నువ్వు ఏది కావాలని తినడానికి ఏంటి ఇస్తున్నారు, అన్నీ ఓకే. బట్ స్టిల్ ఏంటి, యువర్ ఎక్స్పెక్టేషన్స్ ఆర్ ఇంక్రీజింగ్, సో ద హ్యాపీనెస్ ఈజ్ డిక్రీజింగ్. లైక్ వైజ్ అండ్ వాల్యూ ఆఫ్ అ లైఫ్ ఈజ్ గెటింగ్ డిక్రీజ్డ్. వాల్యూ ఆఫ్ అ లైఫ్, ఎక్స్పెక్టేషన్స్ ఎప్పుడైతే ఇంక్రీజ్ అవుతాయో, ఇంటర్ ఎగ్జామ్స్ రాసిన తర్వాత 990 రావాలి, రాకపోతే ఏమవుద్ది? సూసైడ్. అంటే వాల్యూ ఆఫ్ అ లైఫ్ ఏంటి? వాల్యూ ఆఫ్ అ లైఫ్ ఏమైంది? ఎందుకు తగ్గింది? ఎక్స్పెక్టేషన్ ఏంటి? ఇంక్రీజ్ అయింది. ఎక్స్పెక్టేషన్ ఏంటమ్మా? ఇంక్రీజ్. సో ఇఫ్ ఎక్స్పెక్టేషన్ ఇంక్రీజెస్, వాల్యూ డిక్రీజెస్. సింపుల్. ఓకే, సింపుల్, అర్థం అవుతుందా? సో అంటే ఏంటి, ఆఫ్టర్ బ్రేక్ ఐ షుడ్ ఎక్స్పెక్ట్ అట్లీస్ట్ వన్ స్టూడెంట్ షుడ్ కమ్ టు ద క్లాస్. ఒకళ్ళు వస్తే చాలనుకోవాలి నేను. అందరూ రావాలనుకోవడం అత్యాశ అవుతుంది. ఒకరు వచ్చినా చాలు అనుకుంటే అందరూ వచ్చారనుకో హ్యాపీగా ఫీల్ అవుతాం. ఇద్దరు వచ్చినా హ్యాపీగా ఫీల్ అవుతాం. అందరూ రావాలనుకొని ఒక్కడ అబ్సెంట్ అయినా ఏంటమ్మా డిప్రెషన్లోకి వెళ్ళిపోతాం. చెప్పలేం కదా క్లాసు. ఫీలింగ్ డిప్రెషన్ స్టేటస్ పెట్టుకోవాలి. సో ఇఫ్ రిస్క్ ఇంక్రీజెస్ ఐఎమ్ టాకింగ్ అబౌట్ ఎక్స్పెక్టేషన్. నేను చెప్తుంది ఏంటంటే ఎక్స్పెక్టేషన్. సో ఒకవేళ బ్రేక్ తర్వాత అందరూ రాకపోతే ఏం చేస్తాం అనేది సెకండరీ. అర్థమవుతుందా? తిడతామా కొడతామా అది సెకండరీ. నేను దాని గురించి మాట్లాడట్లా. నేను అనేది ఏంటంటే మన మైండ్ సెట్ పర్సెప్షన్ ఎక్స్పెక్టేషన్ ఏముండాలి? లో. ఎక్స్పెక్టేషన్ ఏంటమ్మా? లో. సో ఇఫ్ రిస్క్ ఇంక్రీజెస్ రిక్వైర్డ్ రిటర్న్ ఇంక్రీజెస్, రిక్వైర్డ్ రిటర్న్ ఇంక్రీజ్ అయితే వాల్యూ అంటే నథింగ్ బట్ వెల్త్. వాల్యూ అంటే ఏంటమ్మా? వెల్త్ decreases. So profit maximization, if a profit maximization is only the objective, then what happens? We are ignoring the risk factor. Wealth depends upon two factors. You might have seen organic vegetables business, something organic. You know organic, right? Without using pesticides. For example, we know he is selling organic vegetables. Okay, he is doing a business in Insta. He is doing a promotion. He is selling organic vegetables, but in fact he is selling inorganic vegetables. The name is organic, but he is selling inorganic. So in short run he will get profits. In long run, what happens? People will get to know, yes or no. So these vegetables are not organic, okay? So then what happens to the business value? Decrease. Wealth decrease. Risk. He's taking risk. He's keeping the business in risk, yes or no? So the point is, no doubt if a profit increases, wealth increases. But if you are selling inorganic vegetables in place of organic vegetables, that means you are taking risk. Due to increase of a risk, so the value decreases. So the value depends on two factors. Wealth depends on two factors. Okay, are you getting my point? So which is the superior objective? Wealth maximization or profit maximization? Wealth maximization is the superior objective. Wealth maximization is the superior objective. అర్థమైందా? ఓకే, సో క్లియర్. సో దేర్ ఆర్ టూ ఆబ్జెక్టివ్స్. వాట్ ఆర్ ద టూ ఆబ్జెక్టివ్స్? Profit maximization, wealth maximization. Profit maximization is not a superior objective because it is a short term goal. Profit is a vague term. Vague means unclear. Vague, VAGUE, vague term. Vague means unclear. Profit means what? Profit before tax, profit after tax, లేదా కాస్టింగ్ ప్రాఫిటా, అకౌంటింగ్ ప్రాఫిటా, ట్యాక్స్ ప్రాఫిటా? ప్రాఫిట్ ఈజ్ కంప్లీట్లీ ఏ వేగ్, అన్క్లియర్ టర్మ్. ఓకే, అండ్ ఇఫ్ అ ప్రాఫిట్ మ్యాక్సిమైజేషన్ ఈజ్ ద ఓన్లీ ఆబ్జెక్టివ్, we ignore the risk factor, but we should always keep in mind the risk factor. If risk increases, wealth decreases. For example, so building located in Nojiveedu, so there will be some value. The same building is located in Hyderabad, so value increases. Yes or no? If the same building is located in Ukraine capital, value decreases because there is a war between Russia and Ukraine. The same building is located in Pakistan, value decreases. In Afghanistan, value decreases. Why? We might get same rent, but still the value decreases. Why? Risk factor. Okay, in Afghanistan there is no proper law and order, yes or no? So that's why the value will be less. Value does not depend only on a profit. Value depends on two factors, profit and risk. Advaina, profit and risk. Clear? Superior objective, wealth maximization. So while procuring fund, we should consider four factors. What are the factors? Control. So control should not get diluted. So from control point of view, which is the best option? That is the best option. Next, from risk point of view, which is the best option? Equity is the best option. From cost point of view, Debt is the best option. Next, fourth factor, flexibility. Fourth factor, flexibility. So this is a simple one, flexibility. So fourth factor, flexibility. What is this flexibility? For example, the company is doing well. I wanted to repay. I can repay the debt at any time. Yes or no? I can repay the loan and I can save interest. What about equity? Can I repay or not? No, I cannot repay because even these equity shareholders are the owners. Without their consent, I cannot pay back the capital. I cannot buy back the equity share capital. Buy back the equity share capital. So from flexibility point of view, which is the best option? There should be a flexibility or not? There should be a flexibility. There should be a flexibility. There should be a flexibility. That means if I have money, I should be able to pay. Yes or no? So the point is, which is the best option? Debt or equity? Debt. Yes or no? So bank loan can be repaid at any time, but equity I cannot repay. So flexibility point of which is the best option? Debt is the best option. Debt is the best option. That means we should keep four factors in mind. So only from risk point of view, which is the best option? Equity is the best option. But from control point of view, cost point of view, flexibility point of view, debt is the best option. Overall, which is the best option, equity or a debt? No. Further, we should learn capital structure chapter. Okay, we cannot decide debt is the best option. Okay, so that depends upon a perception of a promoter. Perception of a promoter. If a promoter does not want to take a risk, he go for a equity. He compromise control. He compromise flexibility. Okay. If a promoter is willing to take a risk, then he will be going for a debt. Clear? So we cannot conclude debt is the best option because since we are getting 3 ranks, we cannot say debt is the best option. So we are going to learn the optimum capital structure concept. Optimum means best. Capital structure means capital mix. Capital mix. Capital mix cannot be 100% debt. Generally there cannot be 100% debt because there must be an owner. There cannot be 100% debt, right? So there can be 100% equity. There can be 100% equity. Capital structure means nothing but what? Capital mix. Capital mix. So capital mix can be 100% equity or 80-20. Nothing but 80 equity, debt 20. 60-40 equity, debt 30-70. Okay, 100% equity. It is also called as unlevered firm. Unlevered firm. 80-20. 80-20 means, I mean, here in this case, 80-20 equity debt. Nothing but equity 80%, debt 20%. 60-40 equity debt. 60 equity, 40 debt. 30-70. 30 equity, 70 debt. They might give debt equity ratio. Debt equity ratio. Depends. Okay. So, but there cannot be 100% debt. There cannot be 100% debt. In this case, only first one is unlevered firm. Unlevered. Here levered means debt. Leverage means debt. General meaning leverage means debt. Unlevered means the company which is having no debt. All equity company is also known as unlevered firm. 80-20, 60-40, all these are levered firms. All these are levered firms. Levered firm means the firm which is using debt. The firm which is using debt. So clear? Okay. So capital structure means capital mix. Capital mix can be 100% equity or 80 equity, 20 debt, 60 equity, 40 debt, likewise. Okay. Clear? Clear? So which is the best option? Which source is the best one? Equity or a debt? That depends upon a perception of a promoter, and we are going to learn in capital structure chapter. Okay. So right now, next types of decisions in FM. Types of decisions. Types of decisions. First one, financing decision. Financing decisions. Financing decision means from where to procure money. From where to procure money, that we are going to learn in cost of a capital, capital structure, leverages. Okay, and next second, investment decision. Investment decision we are going to learn in what? Investment decision, capital budgeting and working capital management. Where to invest money? Where to invest money? And next, dividend decision. Dividend decision. Whether to declare a dividend or not. Whether to declare a dividend or not. So there is one more decision, portfolio decision, that we are going to discuss in CMA final SFM. Okay, portfolio decision. So right now we are going to discuss three decisions: financing decision, investing decision, dividend decision. Financial management is concerned about procurement of fund and effective utilization of fund. So that's why you're going to take a decision where to get money, and next where to put money. And there are two sources, equity, debt. And for equity also there are again two. For equity there are again two. One is internal source, second one is external source. Internal source is nothing but retained earnings. Internal source is nothing but retained earnings. Retained earnings. We can retain our profits and we can make a reinvestment instead of using those profits. I mean, instead of distributing a dividend. Okay, so these are the three types of decisions. Am I clear? Okay, done. So one thing is clear, the primary objective of a financial management is wealth maximization. Wealth depends upon two factors, profit and risk. If risk increases, required return increases, and if required return increases, value decreases. Value decreases. Okay. Next, cost of a debt is cheaper than cost of equity. Yes or no? Cost of a debt is cheaper than cost of a equity. So KD is less than KE. KD is less than KE. So KD, cost of a debt, is less than cost of equity KE. Why cost of a debt is less than cost of equity? First reason, tax savings on interest. First reason, tax savings on interest. Tax savings on interest. Interest is an allowable expenditure. So okay, so on payment of interest the profit will get reduced and tax can be saved. Next, second, tax savings on interest. Next, second, expectations of debt holders is generally high or low? Low. Expectation of our debt holders are generally low when compared to equity shareholders. Third, flotation cost. Flotation cost of a debt is generally low. Flotation cost means cost of issue of a debt. Cost of a issue of a debt is generally low in case of a debt. So I will explain these points later on. Okay. So let us move on to the cost of a capital chapter. Cost of a capital. Why are we learning the cost of a capital chapter? Okay. So cost of a capital. So why we should learn cost of a capital chapter? First reason. While procuring fund, we should keep in mind 4 factors: control, risk, cost, flexibility. So one of the factor to be kept in mind is cost of a capital. Cost means expectation and required return. Why we should learn this chapter? Because if required return increases, wealth decreases. That means the cost of a capital should be minimum. Cost of a capital should be minimum. Clear? Okay. So before moving on to the cost of a capital chapter, so first chapter theory, finance is called a science of a money. Finance is a branch of economics till 1890. Corporate finance is concerned with budgeting, financial forecasting, cash management, credit administration. Next, all these are not that important. F point, 2 aspects of financial management are procurement of fund and effective utilization of fund. So financial management is managerial activity which is concerned with planning and control of the firm's financial resources. Okay. So financial management, as name suggests, it is a management of a finance. It deals with planning and mobilization of a funds. Objectives: profit maximization, wealth maximization. So profit maximization is a superior objective or secondary objective? Secondary objective. So revenue should be maximized and cost should be minimized. Here the cost is different. Here the cost means cost accounting cost, expenses. Expenses must be minimized. Wealth maximization. If a profit maximization is the only sole objective, then we ignore the risk factor. The primary objective is wealth maximization. Wealth of a firm is equal to wealth of a equity plus wealth of a debt. Market value of a firm is equal to market value of a equity plus market value of a debt, because firm capital includes equity and debt. Scope of functions of a financial management. There are 3 types of decisions: investment decision, financing decision, dividend decision. Investment decision is concerned about where to invest and how much to invest. And the objective must be to maximize the wealth. Okay. Financing decision, where to procure money and what should be the optimum. Optimum means best combination of a debt and equity. We should find out the best combination of a debt and equity. Okay. So the cost of a capital must be minimum. And the benefit we are going to get must be maximum. There are 2 sources: internal, external. Internal source means nothing but retained earnings. Okay. Dividend decision, whether to declare a dividend or not, how much to distribute as a dividend and how much to retain. Okay. So the objective of a dividend policy again is to maximize the wealth. Ultimately, whatever the decision we take in financial management, the only objective is to maximize the wealth. Functions of financial management. Functions of financial management. It involves acquiring funds for short-term purpose and long-term purpose. Short-term purpose and long-term purpose. So determining financial needs. We should estimate the financial requirement. First we should estimate the financial requirement, how much money we require. Next, financial analysis, ratio analysis, cash flow statement, fund flow statement. You can write on your own also functions of financial statement. Functions of financial statements. Procurement of fund, determining financial needs, financial analysis, cost volume, profit analysis, nothing but marginal costing. CVP analysis is nothing but marginal costing. Fixed assets management, corporate taxation, dividend policies, mergers and acquisition. Mergers and acquisition means, for example, Byju's has acquired Akash. Byju's company has acquired Akash. So so why do we acquire a company? For example, Tata has acquired Big Basket. Big Basket. Merger. So merger means what? Two or more companies will form as a one company, or will form as a one company, two or more companies. Merger. Acquisition means one company will acquire control in another company. Mergers and acquisition. So why do the companies will merge? To get a synergy benefit. Synergy benefit means 1 plus 1 always greater than 1. Synergy, 1 plus 1 always greater than 1. So 1 plus 1 always greater than 1 means, so generally, for example, I am teaching financial management. For suppose if I am teaching financial management in my own channel, let us assume, Rajesh sir, he is teaching OMSM in his own channel, Rakesh, he is teaching, so Constitution of India in his own channel. Then what happens? I mean, there might be subscribers and there might be views, yes or no? But if all the subjects are uploaded in one channel, then there will be a synergy benefit or not? Synergy benefit. Some people might like Rakesh sir, some people might like what Rajesh sir, one or two students may like me, so obviously there will be what? Synergy benefit. 1 plus 1, not 2. Synergy benefit means generally 1 plus 1 is equal to 2 only, but generally greater than 2. The best example is coalition government in AP. The coalition government in AP is the best example. Coalition government, so the previous ruling government has got 11 seats, The reason is what? 1 plus 1 plus 1. 3 parties together has contested the elections, so that's why they got more number of seats. They got synergy benefit. They got synergy benefit. So the market power will increase. Market power. They will come to a dominant position. They will come to a dominant position. Clear? Next, determining sources of funds. Optimum. Optimum means what? Best. Profit planning and control, capital bursting, working capital management. All these are functions. Next, profit maximization and value maximization. Which is the superior objective? Value maximization is the superior objective. So prima facie, that means on the face, you might feel that profit maximization is the superior objective, but the firm, over a time, the object of the firm have been changed from profit maximization to wealth maximization. So arguments in favor and against of these two objectives are discussed. So profit, when profit is the only objective, arguments in favor, when profit earning is the main aim, objective should be profit maximization. If the objective is only the profit maximization, then it leads to exploitation of workers and consumers. Yes or no? For example, you might have seen Vettayan movie, Rajnikant. Okay, Nat Academy. It used to sell tabs like Byju's. For example, if you can take example of Byju's, if the profit maximization is the only objective, then what companies will exploit either employees or consumers. అర్థమవుతుందా? ఎక్స్ప్లాయిట్ అంటే దోచుకోవడం, అదో ఎవరిని, కన్జ్యూమర్స్ని లేదా ఏంటి వర్కర్స్ని. ఇట్ లీడ్స్ టు లాంగ్ రన్లో ఏమవుద్ది, లాంగ్ రన్లో లైక్ బైజూస్ హ్యాస్ వెంట ఇన్ టు లిక్విడేషన్, బైజూస్ అలాగే అయిపోతుంది. అర్థమవుతుందా? నెక్స్ట్, ఫ్యూచర్ ఈజ్ అన్సర్టెన్. A firm should earn more and more profits as of now to meet the future contingencies. And the disadvantage is it ignores the risk factor. If the profit maximization is the objective, then it ignores what risk factor. The main source of finance for growth of a business is profit. But profit itself is a vague concept, because profit is seen as different from different perspectives. Because profit can be profit after tax, before tax, profit before depreciation and tax profit, accounting profit, costing profit, etc. So profit is a vague concept. Okay, so profit is justified on the grounds of rationalities. It acts as a efficiency and economic prosperity, but it is a narrow concept. It is a narrow concept. సో నారో కాన్సెప్ట్ అంటే తెలుసు కదా. నారో అంటే నారో మైండ్ సెట్ అంటాం. నారో మైండ్ సెట్ ఐడియా ఉందా యువతేజ? నారో మైండ్ సెట్, నారో మైండ్ సెట్ అంటే ఏంటమ్మా, యువతేజ వాళ్ళ వైఫ్ వెజిటబుల్స్ కొండని బయటికి వెళ్ళారు, అలయాలతో చెప్పకుండా అన్నాడు. అంటే నారో మైండ్ సెటా కాదా? దాన్ని నారో మైండ్ సెట్ అంటారు. అర్థమవుతుందా? సో చెప్పకుండా వెళ్ళడానికి మనడేమో స్కూల్ ప్రిన్సిపల్ చెప్పి వెళ్ళడానికి. సో పాయింట్ ఏంటంటే ఇన్ఫర్మేషన్ ఓకే, అప్రూవల్ కాదు కదా. సో ద పాయింట్ ఏంటి, అక్కడ ఏమంటాం మనం, నారో అంటాం. నారో అంటే తెలుసు కదా మీకు. ఓకే, నారో రోడ్ అంటాం కదా. నారో అంటే ఏంటి, తక్కువ స్పేస్ ఉందని, అంటే మనం పెద్దగా ఆలోచించట్లేదని చెప్పి నారో. సో ప్రాఫిట్ మ్యాక్సిమైజేషన్ ఇస్ వాట్, నారో concept. So wealth maximization is considered as a appropriate object of an enterprise. Shareholders wealth is equal to, shareholders wealth ala calculate chesta number of shares into current market price per equity share. Current market price per equity share. Vijay. So due to wealth maximization, the short term money lenders get their payments in time. Ante kada. When wealth maximization is the only objective, we are not going to make a default to the creditors. అంటే ఇప్పుడు ప్రాఫిట్ మ్యాక్సిమైజేషన్ అనుకోండి, ఎగ్జాంపుల్ అభి హ్యాస్ టేకెన్ 100 రూపీస్ ఫ్రమ్ బాలాదిత్య. ఇఫ్ ద ఆబ్జెక్టివ్ ఈజ్ టు మ్యాక్సిమైజ్ ద ప్రాఫిట్, ఏం చేస్తాడు, హీ విల్ మేక్ అ డిఫాల్ట్, హీ విల్ నాట్ రీపే 100. ఓకే, నెక్స్ట్ హీ విల్ టేక్ 50 రూపీస్ ఫ్రమ్ మనోజ్, 100 రూపీస్ ఫ్రమ్ సంజయ్. సో హీ కీప్స్ ఆన్ మేకింగ్ అ డిఫాల్ట్ ఇఫ్ his objective is profit maximization. But if his objective is to maximize the wealth, ఏం చేస్తాడు, he will be giving back 100 rupees to Baladitya. Next time Baladitya will give 1000. Yes or no? Again he will give back on time. So that means due to wealth maximization, the short term money lenders get their payments in time. Okay. Next, the long time lenders to get a fixed rate of interest on their investment. The employees share in the wealth gets increased because company will take care of employees. Okay. Next, the various resources are put to economical and efficient use. రిసోర్సెస్ అన్నీ కూడా ఏం చేస్తాం మనం, ఎకనామికల్గా అలాగేంటి ఎఫిషియెంట్గా యూజ్ చేస్తాం. ఎప్పుడు, ఇఫ్ ద ఆబ్జెక్టివ్ ఈజ్ టు మ్యాక్సిమైజ్ ద వెల్త్. అంటే ఫర్ ఎగ్జాంపుల్ పుట్టింగ్ అ సోలార్ ప్యానల్స్ ఆన్ అ రూఫ్ ఈజ్ నథింగ్ బట్ వాట్, యూటిలైజింగ్ ద ఓకే, రిసోర్సెస్ ఎకనామికల్లీ అండ్ ఎఫిషియెంట్లీ. అలాగే కార్ పైన, సో ఆన్ కార్ ఎలక్ట్రిక్ కార్స్ వస్తున్నాయి కదా, ఎలక్ట్రిక్ కార్స్కి ఏం కావాలి? డీజిలా? ఎలక్ట్రిసిటీ కావాలి కదా. సో ఫర్ దట్ వాట్ ద సోలార్ panels may be okay arranged on a top of a car. So that is what efficient use of resources. Okay, but the disadvantage is it is socially undesirable. The gap between the rich and poor will get increased because the objective is only to maximize the wealth. Okay, and there is a conflict. మీ బుక్లో ఇదంతా ఉందా సార్? అక్కడ వరకు చాలు. ఇది నెంబర్ ఫస్ట్ టాపిక్. నెక్స్ట్ ఏముంది? ఫైనాన్షియల్ ఇన్స్టిట్యూషన్స్. ఫైనాన్షియల్ ఇన్స్టిట్యూషన్ is completely theory topic. Right now we are going to discuss the theory which is relevant for problem solving. Okay, so clear? So equity is costlier or cheaper? Equity is costlier than debt. Costlier than debt. Debt is cheaper than equity. Debt is cheaper than equity. Okay, let us start the chapter cost of a capital. Cost of a capital. Cost of a capital. So we have to discuss time value of a money. We shall discuss time value of a money after completion of cost of a capital. Okay, cost of a capital. So why are we learning this cost of a capital? Cost of a capital is nothing but what? Required return. It is nothing but required return. It is also called as opportunity cost of a capital, minimum return required, minimum return required, opportunity cost of a capital. Cost of a capital. Why are we learning this chapter? Because the reason is wealth. To find out the value, wealth depends upon two factors. One is the profit, one is the risk. Okay, risk, if risk increases, required return increases. Nothing but wealth depends upon two factors, profit and required return. Profit and required return. Okay, so in order to solve the questions in capital budgeting, to find out the plant and machinery value, first we should learn the cost of a capital chapter. Okay, cost of a capital. So cost of a capital means minimum required rate of a return. Minimum return required to be earned by the company to meet the expectation of the investors. Minimum return required to be earned by the company to meet the expectation of investors. Okay, write down the sentence. Minimum return required by the required to be earned by the company to meet the expectations of a company. Minimum return required to be earned by the company to meet the expectation of investors. Here company means includes sole proprietor firm, everything. I mean business. Here company means what? Business. Minimum return required to be earned by the company to meet the expectation of investors. So these investors can be what? These investors can be A, equity shareholders, or B, preference shareholders, or C, debt holders. Debt holders. If you see the sentence, minimum return required to be earned by the company to meet the expectation of investors. So equity shareholders will expect equity dividend. Yes or no? Preference holders will expect preference dividend. Debenture holders will expect interest. So nothing but cost of a capital means minimum return to be earned by the company to meet equity dividend, preference dividend, and interest. And what? Interest. So in this chapter we are going to learn first cost of a debt. First we are going to learn what? Cost of debt KD, cost of preference KP, cost of equity KE. Next, weighted average cost of a capital KO. Weighted average cost of a capital KO. And we are going to discuss KR also. KR means cost of a retained earnings. Cost of a retained earnings. Simple chapter. So compulsory question, 7 marks. KD, cost of a debt. KP, cost of preference. KE, cost of equity. KR, cost of retained earnings. Weighted average cost of a capital. Nothing but KD means expectation of a debenture holder. KP means expectation of a preference holder. KE means nothing but these are also called as specific cost. KE means minimum return required to be earned by the company to meet the expectation of equity shareholders. KE. KO means overall cost of a capital. KO means overall cost of a capital. Okay. So before discussing what is KD, KP, KE, KR, weighted average cost of a capital, let us write down income statement. Income statement. Note down the income statement. You know the income statement, right? In marginal costing, cost accounting, you might have discussed income statement. Costing income statement is different. Particulars, amount. Particulars, sales minus what? Variable cost, contribution. Income statement, income. Revenue means sales. Turnover, revenue means sales. Income means profit. Income statement. So cost can be categorized into variable cost and fixed cost. So sales minus variable cost, contribution minus what? Fixed cost. Earnings before interest and tax, or this is also called as profit before interest and tax. EBIT. In costing we write it as a profit, because in costing we does not consider financial expenses. Finance expenses like interest, preference dividend, equity dividend, tax are not considered in costing. So that's why straight away we write profit. But whereas in FM it is called as EBIT. EBIT means earnings before interest and tax. Minus. So this is earnings before reducing interest and tax. First we should reduce interest or a tax? Interest, because interest is allowed as an expenditure. Interest is allowed as an expenditure, so that's why minus interest. Then you will get earnings before tax. Then on this amount you pay tax. Minus what? Tax. Then you will get earnings after tax. After earnings, I mean earnings after tax. From this you will pay preference dividend. Name itself indicates preference. They will get preference over the equity shareholders. They will get preference over the equity shareholders. That means first preference dividend has to be paid. At the time of a liquidation also, first preference share capital has to be paid. Okay. So EAT minus what? Preference dividend. Then you will get earnings available to equity shareholders. EAES. Earnings available to equity shareholders. So clear? Earnings available to equity shareholders. So from this, equity dividend will be paid, and payment of equity dividend is not mandatory. First, board of directors has to recommend. Board of directors has to recommend payment of a dividend, and that has to be approved by the shareholders in a general meeting. You know the concept of general meeting, right? So shareholders, investors in a general meeting has to approve. Then only the equity dividend will be paid. So board of directors has to recommend. We are saying that board of directors has to recommend payment of a dividend. In that board of directors, one director might be a cost accountant who knows the financial management, especially dividend decisions chapter. He will be learning the dividend decision theories, whether to declare a dividend or not. He will be analyzing, and then he will recommend, if necessary, he will recommend the payment of a dividend. Okay, and if it is approved by the shareholders, then only the dividend will be paid. So the left out part is known as retained earnings. Retained earnings. Left out is known as what? Retained earnings. Next, earnings per share is equal to earnings per, here earnings per share, if nothing is mentioned here, share means equity share. Earnings per share is equal to earnings available to equity shareholders divided by number of shares. Earnings per share is equal to earnings available to equity shareholders divided by number of shares. Okay. Clear? This is the income statement. Income statement. So now cost of a debt. First part is cost of a debt. Cost of a debt can be two types: redeemable, irredeemable. Irredeemable means perpetual debt. Perpetual means continuous. Perpetual means continuous. Okay. Cost of a debt. Cost of a debt, KD. Cost of a debt, KD. So there are two categories. Ganesh, first category, irredeemable is equal to I into 1 minus T divided by NP. I into 1 minus T divided by NP. Next, KD. Redeemable, I into 1 minus T plus RV minus NP divided by N, all divided by RV plus NP divided by 2. Cost of a debt, KD, irredeemable is equal to I into 1 minus T divided by NP. Cost of a debt, KD, redeemable is equal to I into 1 minus T plus RV minus NP divided by N, all divided by RV plus NP divided by 2. Here I means interest amount, that is not a rate. I means what? Interest amount. T is equal to tax amount కాదు, tax rate. T is a tax rate. NP is equal to net proceeds, not sale proceeds, net proceeds. Net proceeds is equal to issue price minus flotation cost. Issue price minus what? Flotation cost. Net proceeds. We take net proceeds if it is a fresh issue. Be careful, if it is a fresh issue, we take a net proceeds. How do we get net proceeds? Issue price minus flotation cost. Okay, for cost of debt we take time for explanation, 15 minutes. Then for KP explanation is not required. Net proceeds. But instead of net proceeds, you might take market price. You might take market price. If it is existing issue, if it is what? Existing issue, MP is equal to market price. That means if debentures were issued 2 years back, then to find out the cost of debt, we take market price. If the debentures are issuing now, if debentures are being issued now, then we take net proceeds. Net proceeds. So clear? Next, RV. RV is equal to redemption value. N is equal to number of years. Number of, generally we should take number of periods. If interest is payable for every 6 months, we should count how many 6 months are there. Okay, interest might be paid quarterly, half yearly. So N means number of periods. So clear? Now let us discuss, why we are writing KD is equal to I into 1 minus T divided by NP, and the second formula is I into 1 minus T plus RV minus NP divided by N all divided by RV plus NP divided by 2. Okay. First point, what is the cost of a capital? Cost of a capital means minimum return required to be earned by the company to meet the expectation of investors. So let us take example 1. Loan 1 lakh rupees. Rate of interest 10%. Company is taking a loan. How much it is like taking a loan? Company is taking a loan of 1 lakh. What is the rate of interest? 10%. The rate of interest is 10%. Okay, clear? Now I should find out the cost of a debt, KD. KD. Let us understand. Cost of a debt means minimum return required to be earned by the company to meet the expectation of a investor. We are taking a loan 1 lakh. Investor means here the investor might be a bank. So to meet the expectation of a bank, what is the bank expectation? Bank will be expecting 10% on 1 lakh. Nothing but bank will expect what? Interest amount. What is the interest amount? 10,000. I am taking 1 lakh from the bank. I will be investing this 1 lakh in business, yes or no? So that means To meet the expectation of a banker, the business has to earn 10,000 on 1 lakh. Answer is 10%. If you observe the formula here, 10,000 is what I, 1 lakh is principal. 1 lakh is what? Principal. Clear? So this is simple example without any flotation cost. Nothing but if in the question they are not giving any flotation cost and there are no redemption value, there is no redeemability period, then cost of a debt is equal to interest rate when there are no taxes. When there are no taxes. Okay. Example 2. Example 2, same question, but I am adding processing charges 2%. Loan processing charges 2%. Processing charges 2%. Processing charges 2%. So if you are taking any loan, generally processing charges are levied by the bank. Processing charges are levied by the bank. Okay, if you are taking housing loan, personal loan, whatever the loan you take, bank will be taking a processing charges. Processing charges means bank has to collect the documents from the client customer. Okay, yes or no? And the credit manager has to analyze the credit worthiness of a customer. Okay, so all this involves some cost. So that's why the bank would be taking some charges. That means here, even though the loan amount is 1 lakh, the company is going to receive only 98,000 rupees. How much it is going to receive? 98,000. The bank is giving 1 lakh loan, but from 1 lakh they will be reducing 2,000. They will be paying only 98,000. So the promoter will be able to invest only 98,000 in the business. Only 98,000. Now tell me, cost of a debt KD is equal to minimum return. What is the bank expectation? Bank will be taking 10% interest on 1 lakh, not 98,000. They will be taking interest on 1 lakh. Okay, so that means what is their expectation? 10,000 divided by, I should not take 1 lakh. Why? Because I am investing only 98. I should generate 10,000 return on a 98,000. So that means what is the rate of a return to be earned by the company? Company should earn 10.2%. If you observe the point, if a flotation cost increases, the cost increases. If a flotation cost increases, cost increases. If you see the, points, cost of a debt is cheaper than cost of a equity. The third point is flotation costs are generally less in case of a debt. When flotation cost is less, then cost will also be less. Flotation cost. Flotation cost means cost of a issue. In this example, flotation cost is what? Processing charges. But in case of debenture, flotation cost might be the cost of issue of a prospectus. You know the concept of prospectus, right? Company, while making a public offer, has to issue a prospectus. For printing that prospectus has to incur some expenses. Yes or no? So those expenses are known as what? Flotation cost. Cost of floating the capital. Cost of floating, getting the capital. Clear? Are you getting my point? Okay. And if you observe the Companies Act 2013, underwriting commission, in case of debenture maximum allowed is 2.5 something, and in case of equity shares it is 2%. Underwriting commission. You have that in syllabus or not? Underwriting commission. In case of shares 5, in case of debentures 2.5. So maximum allowed is less in case of a debt, whereas high in case of a equity. So the point is, if a flotation cost increases, cost increases. So from I divided by P, we have developed this formula to I divided by NP. I divided by NP. Yes or no? How are we getting NP? Loan amount minus flotation cost. Okay. Nothing but in case of debenture, issue price is nothing but loan. Issue price is nothing but loan. We are taking loan from the investor, right? So, okay. Next example 3. Example 3. Tax rate 30%. Tax rate 30%. Okay. So on payment of interest we can save tax. On payment of interest we can save tax. Tax save chesukochu. So this example again we repeat in capital structure also. Let us take 2 scenarios. Case 1, case 2. Equity 1 lakh, here equity 2 lakhs. 10% is debt 1 lakh and nil. 2 lakhs and 2 lakhs. We are taking 2 scenarios. First scenario 2 lakhs capital, 1 lakh equity and 1 lakh debt. Second scenario 2 lakhs complete equity. Let us assume the 2 businesses are same. 2 businesses are same. Then obviously you will get same return. Same amount of sales, same variable cost, same fixed cost, and your EBIT will also be same. Return on a investment. Return on a investment means EBIT. Return on investment is nothing but what? EBIT. Earnings before interest and tax. Okay. Investment includes equity and debt. Investment includes what? Equity and debt. So let us assume EBIT. EBIT is equal to 40,000. I am taking an example to explain why we are taking a tax rate. EBIT 40,000 and 40,000. We are taking an assumption 2 businesses are same. The only difference is capital structure. Capital structure. Minus what? Interest. First case interest 1 lakh into 10%, 10,000. What about second case? Nil. Earnings before tax 30,000, 40,000 minus at the rate of 30%. Tax at the rate of 30%. First case tax 9,000. Okay. So next we do not require further calculation. If you see the tax amount, first case we are paying a tax of 9,000. Second case 12,000. Okay. Same businesses, same amount of capital, same amount of EBIT. But whereas the tax payable to the government is not the same. First case you are paying a tax of 9,000. Second case 12,000. That means you are paying a less tax. How much you are paying less? 3,000. So why you are paying a less tax in first case? Because you are paying an interest of 10,000. Due to payment of interest 10,000, you are saying a tax of 3,000. That means your cost is not 10,000. Your cost is what? Cost of a debt KD is equal to 10,000 interest. Just because you are paying 10,000 interest, you are saying a tax of 3,000. Yes or no? The reason for saving of tax is payment of interest. So 10,000 minus 3,000 divided by what is the amount? 1 lakh. Answer is 0.07. If you convert it into percentage, 7%. First of all, forget about the answer. If you take the common of 10,000, take common of 10,000, then you will get 1 minus 0.3 divided by what? 1 lakh. If you observe this formula, what is this 10,000? Interest amount into 1 minus what is this 0.3? Tax rate divided by 1 lakh is net proceeds. So therefore cost of a debt is equal to I into 1 minus T divided by net proceeds. I into 1 minus T divided by net proceeds. Clear, Rakesh? So clear. So why debt is cheaper than equity? We can save tax on payment of interest. Second reason is expectation of a debt holders is generally low. Third reason is flotation cost in case of a debt is generally low. These are the three reasons debt is cheaper than equity. Okay, so clear. Next, this formula can be applied when debentures are redeemable or irredeemable. When debentures are redeemable or irredeemable? When debentures are irredeemable. Debentures are irredeemable. But when debentures are redeemable, debentures are redeemable. So let us take another example. Example number 4. Debentures are redeemable. Prasanna, first class. Example number 4. I is equal to 100. Redemption value is equal to 1100. Net proceeds is equal to 1000. N is equal to 5. I is equal to 100. Redemption value is equal to 1100. NP is equal to 1000. N is equal to 5. And tax rate T is equal to 0.3. 30% tax. Now tell me KD is equal to. KD is equal to. What is the formula for when the debentures are redeemable? What is the formula? Nothing but 100 into 1 minus 0.3 plus 1100 minus 1000 divided by 5 divided by 2. So let us understand what is this. If you observe the formula, company is paying 100 rupees interest and saving tax at the rate of 30%. That means the net cost is only 70 rupees. Yes or no? And if you see the second part, 1100 and 1000. What is the 1000? Net proceeds. Net proceeds 1000. So what is the meaning of this? So company is taking 1000, but it is repaying 1100 at the end of a 5th year. Nothing but company is paying an extra amount, 100. In addition to interest, it is paying an extra of 100 principal. 100 principal over a period of 5 years. We are amortizing per annum. That means 100 divided by 5. Every year we are paying extra principal of 20. That means your cost is not just only the interest. In case of redeemable debentures, the difference between redemption value and net proceeds is also the cost. That can be positive or negative. Here we are getting positive. Okay. So the cost is 70 plus 70 plus 20, 90 rupees. So that means company should earn 90 rupees on. There are two principles. One is what we are taking. We are taking 1100. So we are taking 1000. Repaying 1100. We are taking a simple average of a capital. Simple average of a capital. Are you getting my point? Are you able to understand the logic for second part? RV minus NP divided by NN. RV minus NP divided by N. Nothing but we are amortizing the extra capital paid. Sometimes we might take 900 and we might sometimes we might take 1100 and repay 1000. Repay 1000. Then you will get minus 100 divided by 5. Nothing but minus 20. That means your net cost will be 50. 70 minus 20. Clear? So that's why our formula for redeemable debentures is I into 1 minus T plus RV minus NB divided by N all divided by RV plus NB divided by 2. Okay. So clear? So cost of a redeemable debt KD is equal to I into 1 minus T plus RV minus NB divided by N all divided by RV plus NP divided by 2. NP divided by 2. Okay. Okay. So this is cost of a debt KD. Next one is cost of a preference KP. Cost of a preference KP. So tell me cost of preference KP. So what do the preference holders expect? Preference holders expect cost of preference. Okay, sir. Charge. Cost of a preference. Cost of a preference. So preference holders will expect. Amma Indira Gandhi నీ పేరేంటమ్మా ఇందిరా గాంధీ శాలువా కప్పేసుకుందాం కాస్ట్ ఆఫ్ ప్రిఫరెన్స్ కేపీ ఈజ్ ఈక్వల్ టు సరే కాస్ట్ ఆఫ్ ప్రిఫరెన్స్ కేపీ ఈజ్ ఈక్వల్ టు పాస్ అయితే వేస్తారులే పాస్ అయితే స్టేజ్ మీద చాలు వేయట్లేదా ఓకే కాస్ట్ ఆఫ్ ప్రిఫరెన్స్ కేపీ ఈజ్ ఈక్వల్ టు ప్రిఫరెన్స్ డివిడెండ్ పీడి సో దే విల్ ఎక్స్పెక్ట్ వాట్ ప్రిఫరెన్స్ డివిడెండ్ సో విల్ దేర్ బి ఎనీ tax savings or not? No. If you see the income statement, preference dividend is reduced after payment of a tax. After payment of a tax. So KP is equal to preference dividend divided by net proceeds. If it is a fresh issue, net proceeds. If it is existing issue, market price. KP. Redeemable PD plus RV minus NP divided by N all divided by RV plus NP divided by 2. NP divided by 2. Okay. So clear? The only difference is there will not be any tax savings in case of a preference dividend. Okay. Bharat. So next what? Equity. Next equity. Cost of equity. Cost of a equity. In cost of equity there are different perceptions. There are different models. Cost of a equity. So what does the equity shareholder expect? Equity shareholder will generally expect equity dividend. So K is equal to D1. D1 means expected dividend. We should not take D naught, we should take D1, expected dividend. D1 divided by NP, net proceeds. If it is fresh issue, net proceeds. If it is existing issue, market price. D1 divided by NP. This is dividend model. This is dividend model. The second perception is generally equity shareholders will expect growth. Every year they will expect growth. So that's why the second formula is K is equal to D1 divided by net proceeds plus growth. Net proceeds plus growth rate. Growth rate. Yogita. Growth rate. అర్థమవుతుందా యోగిత? ధ్యానం అలా 2-3 నిమిషాలు చేస్తే రాదమ్మా వరాలు. సంవత్సరం 2 సంవత్సరాలు చేయాలి తపస్సులు. K is equal to D1 divided by NP plus G. G means what? Growth rate. G is equal to growth rate. So generally growth rate will be given in the question. Okay. But if it is not given in the question, growth rate is equal to B into R. B into R. Telsa? B into R. B is equal to retention ratio. R is equal to return on a equity. B is equal to retention ratio. R is equal to what? Return on a equity. Growth rate G is equal to B into R. B retention ratio. R return on a equity. Return on a equity. So growth depends on two components. Two components. ఏంటా two components? ఎవరు తెచ్చుకున్నారా బకెట్? B retention ratio. R return on a equity. R return on a equity. Okay. So growth depends upon two factors. Growth depends on two factors. So let us take example. So Bharat, an auto driver, he is earning 1000. He is earning 1000 rupees per day. 1000 rupees per day. Okay. So 1000 rupees per day. And he is not saving a single rupee. He is not saving even a single rupee. Okay. So he is not giving any money to wife. So entire 1000 rupees he is drinking. Okay. Will there be any growth in family or not? There will not be any growth in family. Okay. So because retention ratio is equal to 0. Retention ratio is equal to 0. అర్థమైందా? సో మీలో కూడా చాలామంది గ్రాండ్ ఫాదర్స్ రీటైన్ చేసి ఉండరు. సో దట్స్ వై దెర్ ఈస్ నో గ్రోత్ ఇన్ అ ఫ్యామిలీ. రిటెన్షన్ రేషియో 0 ఇన్ కేస్ ఆఫ్ అ భరత్. మీ తాతగారా అలా చేసింది? ఇట్స్ ఓకే, ఏం కాదు, అయిపోయింది కదా. సో రిటెన్షన్ రేషియో 0 అయితే గ్రోత్ ఈజ్ ఈక్వల్ టు 0. ఎగ్జాంపుల్ భరత్. ఓకే. So next second example, Pavan, he is earning 1000 rupees per day. Okay, he is giving 1000 rupees to his wife. Retention ratio 100%. Retention ratio 100%. But his wife, okay, she is not reinvesting that money. 1000 rupees. Okay. So she is accumulating that money and she is keeping that money in a almirah. Now will there be any growth or not? No. There will not be any growth. Example ki వాళ్ళ గ్రాండ్ ఫాదర్ అలాగే చేశారు, వాళ్ళ గ్రాండ్ మదర్ అలాగే ఏం చేశారు, షీ కెప్ట్ 1000 రూపీస్ ఓకే ఇన్ అల్మరా. ఓకే. సో ఏమయ్యేది డిమానిటైజేషన్ టైంకి? అవన్నీ కూడా ఏంటమ్మా, డిమానిటైజేషన్ టైంకి ఏమైంది అర్థమవుతుందా? సో దాట్స్ అండ్ దెర్ విల్ నాట్ బి ఎనీ రిటర్న్, గ్రోత్ ఉంటుందా? సో దెర్ విల్ నాట్ బి ఎనీ గ్రోత్. సో గ్రోత్ డిపెండ్స్ అపాన్ టూ ఫ్యాక్టర్స్. ఓకే, Abhi is earning 1000 rupees, he is giving 1000 rupees to his wife, retention ratio 100%, and his wife is also a cost accountant, she is reinvesting that money. Will there be a growth in family or not? Yes, there will be a growth in family. So that means growth depends upon a two components. One is retention ratio, second one is return on a equity. So retention ratio means example, for example retention ratio 100%, return on a equity is equal to 10%, then growth rate is equal to 10%. If only 50% is retained, then growth rate is 5%. If zero retained, growth rate 0, nothing but we are not retaining any earnings, entire amount is paid as a dividend. If entire amount is paid as a dividend, then there will not be any growth. So clear? Okay, so growth rate is equal to B into R, and return on equity is equal to earnings available to equity shareholders divided by equity. Later on again we discuss these formulas in ratio analysis. Return on equity is equal to earnings available to equity shareholders divided by equity. Equity means equity share capital plus reserves and surplus minus fictitious assets. Fictitious assets. Equity means what? Equity share capital plus reserves and surplus minus what? Fictitious assets. Fictitious means fictitious means unreal, imaginary. Fictitious means what? Unreal, imaginary. For example, Radha Krishna, he is getting married to Pooja Hegde. Fictitious, unreal. It is unreal, imaginary. It is what? Imaginary, fictitious. Likewise, preliminary expenses not written off. In balance sheet you might find preliminary expenses not written off. Preliminary expenses, you know the concept of preliminary expenses, right? Preliminary expenses not written off, so that will have a debit balance, but that doesn't mean that is an asset. So that is a fictitious asset. P&L debit balance, loss, P&L loss will have a debit balance, but that is not an asset. Are you getting my point? Goodwill is an asset, intangible asset. Trademark is an asset, but whereas, okay, so preliminary expenses not written off. Discount on issue of debenture, discount on issue of debenture, discount on issue of debenture. If you see the entry, discount on issue of debenture, you will write a bank account debit 90 rupees, discount 10 rupees, to debenture 100 rupees, to debenture 100, bank account debit 90, discount account debit 10. So discount is having a debit balance. This discount on issue of a debenture will be written off over a maturity period. If a debenture maturity period is 5 years, over a 5 years this discount is written off. Now the point is the discount on issue of debenture which is not at written off is a fictitious asset. It is not really an asset. It is unreal. It is unreal. Spider-Man, real or unreal? Unreal. Fictitious. Okay, so equity is equal to equity share capital plus reserves and surplus minus fictitious assets. So K is equal to D1 by P naught plus growth rate G. Next, another formula, K is equal to earnings model, K is equal to E1 by P naught. Some companies may not pay dividend. Yes or no? If a companies are not paying dividend, that means shareholders will not have any expectations or what? No. Shareholders will expect earnings per share. So K is equal to E1 by P naught or NP. E1 by P naught, or else you can take NP. Be careful, it is fresh issue. If it is fresh issue, net proceeds. If it is existing, market price. E1 by NP. E1 means earnings per share. D1 means dividend per share at the end of first year. Next, what K is equal to, they will be expecting growth as well. So that's why next formula is E1 by NP plus growth rate. E1 by NP plus growth rate. So clear? So this is earnings growth model. Earnings growth model. And there is one more final level concept also, CAPM. CAPM. Okay, in cost of equity we have a first formula D1 by NP, second one D1 by NP plus G, third E1 by NP, fourth E1 by NP plus G. Okay, and next CAPM. CAPM model, cost of equity K is equal to RF plus RM minus RF into beta. RF plus RM minus RF into beta. Beta is a final level concept. Okay, right now beta means risk factor. Beta means what? Risk. Beta is equal to risk factor. RF is risk-free rate of a return. RM means market return. RM minus RF is market risk premium. Next, RM minus RF into beta is known as security risk premium. So which formula should we apply? For example, if in the question RF and RM are given, then we apply last formula. If in the question dividend and growth rate are given, then D1 divided by NP plus G. That formula will be applied. So CAPM is equal to RF plus RM minus RF into beta. So let us understand this formula. This formula is used for finding out the value of equity share, market price of equity share. But right now, the entire concept we are not going to discuss, because beta calculation, how to calculate beta, that we are going to discuss in final level. Of course, the formula is given in your concept book also, beta calculation, but the logic behind beta calculation we are going to learn in final. Right now the beta is only the risk factor. So beta is a ratio. Beta can be 0, beta can be negative, positive, beta can be 1, 2. Okay. So for example, first, what is risk-free rate of a return? Risk-free rate of a return. Risk-free rate of a return. For example, our Indira Gandhi, she retired. She retired and she is having a pension fund, pension amount. She is getting a pension and provident fund amount is there. Provident fund amount is there. She is having around 50 lakhs. She is having around 50 lakhs. Okay. So these 50 lakhs she invested in RBI Treasury bonds. RBI Treasury bonds. Reserve Bank of India Treasury bonds. Okay. And she is getting 7% return. 7% return. Okay. Now the point is there any possibility of occurrence of a loss? Risk. Is there any risk? Risk means a possibility of occurrence of a loss, uncertainty. No, because entire provident fund amount 50 lakhs invested in RBI treasury bills or bonds, treasury bills. Now the point is there any risk or not? No risk. Without any risk, she is earning How much return? 7%. Without any risk, she is earning 7% return. Okay, 7% return earn చేస్తుంది. Clear? Now Vamshi, he gave a pitch presentation. He gave a pitch presentation. Pitch presentation means presentation given by the promoter. Presentation given by the promoter. So Vamshi, a promoter of a textile company, he gave a pitch presentation. So Shark Tank India program చూసుండొచ్చు. సో బిజినెస్ ఐడియా షేర్ చేస్తారు. అలా వంశీ ఏంటమ్మా, హీ గేవ్ అ పిచ్ ప్రెజెంటేషన్ టు ఆర్ పేరేంటమ్మా అమ్మ పేరు, మండేలనా, వందన. ఓకే ఓకే. సో Vamshi, he gave a pitch presentation to Vandana. He gave a pitch presentation. Pitch presentation, PowerPoint presentation ఇచ్చాడు. I mean, he shared his business idea, how the company is going to grow. He shared everything. Okay. So it was already existing from the past 10 years. He gave a presentation. He wanted to procure further funds. Now, our Vandana, she sold treasury bills and she invested that 50 lakhs in the company which was incorporated by Vamshi. Now the point is whether she is taking a risk or not. Ushasri, whether she is taking risk or not. She is taking risk or not? Yes. ప్రశాంతంగా ఉండేది, అవునా, హ్యాపీగా. బట్ without taking any risk, she is earning 7% rate of her return. But now she is taking a risk and she is making investment in the company which is incorporated by Vamshi. ఇద్దరు ప్రశాంతంగా ఉండేవాళ్ళు హ్యాపీగా. అట్లాంటి మనడు కంపెనీ పెట్టాడు, ఆ కంపెనీలో ఇన్వెస్ట్మెంట్ చేస్తే నౌ షీ ఈస్ టేకింగ్ రిస్క్. నౌ ద పాయింట్ ఈస్ హర్ ఎక్స్పెక్టేషన్ విల్ ఇంక్రీజ్ ఆర్ డిక్రీజ్? హర్ ఎక్స్పెక్టేషన్ విల్ ఇంక్రీజ్. సో దట్ మీన్స్ హర్ ఎక్స్పెక్టేషన్ విల్ బి జనరల్లీ బి 7 ప్లస్ ఆర్ మైనస్ 7 plus. 7 plus what? Premium for risk taking. Premium for risk taking. ఆ ఏజ్లో రిస్క్ తీసుకున్నాడు, షీ విల్ ఎక్స్పెక్ట్ రిస్క్ ప్రీమియం. సో RM minus RF into beta is nothing but what? Security risk premium. Security risk premium. Okay. So beta is a risk factor. Beta is a risk factor. For example, risk free rate is equal to 7. RM is equal to 14 and RF is equal to 7. Beta, let us assume beta is equal to 1. Then KE is equal to 14. That means she will expect extra 7. Extra 7. If a beta is equal to 2, then she will expect 14 minus 7 into 2. She will expect 21. If a beta is equal to 3, then she will expect 28. Vamshi company is having a beta of a 3. That means her expectation will be, so KE of a Vandana is equal to 28. Beta 3. What is the meaning of this beta? Beta 3 means for every 1% change in market, Vamshi company return changes by 3%. If a market changes by, market means Sensex. For the time being, market means Sensex. If a Sensex changes by 1%, security, company, Vamshi company changes by 3%. High risk. High risk. So that's why her expectation is also increasing. If risk increases, required return increases. Required return increases. Okay. Beta of a risk-free security is equal to 0. Beta of a risk-free security is equal to 0. So that means her expectation is equal to 7. So that means if she is investing in treasury bills, she will expect 7. Okay. If she is expecting in market, she will expect 14 because beta of a market is equal to 1. Beta of a market is equal to 1. If she is expecting in Vamshi company, if she is investing in Vamshi company, she will expect 28. 28. If she is investing in Bharat company, So let us assume beta is equal to 5. Then her expectation will be 42. Clear? So if risk increases, required return expectation increases. So that is a basic fundamental. BBA student and CMA student, who will have a high expectation? CMA student. High risk, high expectation. High risk, high expectation. Clear? So this is what cost of equity K. Okay. Next, cost of a retained cost of a retained earnings. Cost of a retained earnings. Prasu. Cost of a retained earnings. Generally, cost of a retained earnings KR is equal to KR is equal to KE. So generally KR is equal to what? KE, cost of equity. Cost of a retained earnings is equal to cost of a equity. Okay. Cost of a retained earnings is equal to cost of a equity. But there can be a personal tax. Personal tax. When there is a personal tax, then K is equal to, KR is equal to KE into 1 minus TP. TP means personal tax rate. There can be a brokerage. 1 minus brokerage. Cost of a retained earnings is equal to KE into 1 minus TP. TP means personal tax rate. B means, here B means brokerage. Here B means brokerage. Always take BR. So TP is equal to not the corporate tax rate. KD is equal to I into 1 minus T. That T is corporate tax rate. Here TP means personal tax rate. That means the tax rate which is applicable to the shareholders, investors. B is equal to brokerage. This is the cost of a retained earnings. Clear? Next comes weighted average cost of a capital. Weighted average cost of a capital KO. Weighted average cost of a capital KO. So weighted average. So till now we have learned how to find out the specific cost. Cost of equity, cost of debt, cost of a preference, cost of a retained earnings. So KO, overall cost of a capital is equal to, so W1 K1 plus W2 K2, W3 K3 and so on is equal to KO. Overall cost of a capital is nothing but weighted average of a specific cost. Weighted average of a specific cost. Clear? Amma bundi. ఇదేం అకేషన్ కాదు కదమ్మా. ఓకే. సోర్స్, అమౌంట్, ప్రపోర్షన్, specific cost, proportion into specific cost. Generally we take these columns for calculation of weighted average cost of a capital. యోగిత నిద్ర ఆపుకోలేవు నువ్వు, ఇంకా అగ్గిపుల్లలు పెట్టుకోవడమే. అదో ఉందా, అగ్గిపుల్లలు తెచ్చుకుని ఇలా పెట్టుకో. సోర్స్ ఈక్విటీ, సోర్స్ equity, preference, debt, retained earnings. Let us assume equity is equal to 50 lakhs, preference is equal to 20 lakhs, debt 20 lakhs, retained earnings 10 lakhs, overall 100 lakhs. Overall 100 lakhs is the capital. Overall 100 lakhs is the capital. Equity 50, preference 20, debt 20, retained earnings 10. Overall 100 lakhs. Okay, so what is the proportion of equity share capital? What is the proportion of equity share capital? 0.5, 0.2, 0.2, 0.1. So for every 1 rupee investment, 0.5 is contributed from equity share capital, 0.2 from preference share capital, 0.2 from debt, 0.1 from retained earnings. Retained earnings, Vasant. So specific cost. Let us assume specific cost is equal to 20%, 15, 10, and 20. This is an example, okay? So this 20% is calculated using the formula d1 by p naught, d1 by p naught plus g, rf plus rm minus rf into beta. 15% is calculated using pd divided by np and the other formula. Debt I into 1 minus t divided by np. Retained earnings kr is equal to ke, but if there is personal tax rate, kr is equal to ke into 1 minus personal tax rate. So proportion into specific cost, 0.5 into 20, 10%, 3%, 0.2 to a total 15, 15.2 a 17, 17 17. What is the answer? 17 is the answer. What is this 17? Overall cost of a capital. Minimum return required to be earned by the company to meet the expectation of an investor. To meet the expectation of investors, company should earn 17%. That means 100 lakhs into 17%, that is equal to 17 lakhs is the minimum return required to be earned by the company, so that we can meet the expectation of the investors. Equity shareholder expectation is 50 lakhs into 20%, 10 lakhs. Yes or no? Next, preference shareholders expectation, 20 lakhs into 15%, 3 lakhs. Next, debt expectation, 20 lakhs into 10%, 2 lakhs. Next, retained earnings expectation, 10 lakhs into 20%, so 0. So cost of a capital is minimum return required by the company to meet the expectation of the investors. So why it is relevant for FM? Before taking an investment decision, for suppose there is an investment proposal, are you going to accept that investment proposal? Yes, I am going to accept that investment proposal, provided if it is giving minimum of 17. From that investment I should get minimum 17, otherwise I cannot meet the expectation of the investors. So in capital bursting chapter, I compare this cost of a capital with IRR, internal rate of a return. IRR is nothing but return from the investment decision. Return from the investment decision. Are you getting my point? This is the minimum return required to be earned by the company to meet the expectation of our investors. So one more point to be discussed is this amount column. Generally, if nothing is mentioned in the question, we take book values. We take book values. Book values means balance sheet values. Balance sheet values. If a question is silent, If a question is silent, then we take what? Balance sheet values. But specifically, they might ask you to find out the weighted average cost of a capital using market value weights. Then I take market value. Then I should take what? Market value. So equity share capital, how should I get market? How do I get market value? Number of shares into market price per share. Clear? When I am taking a market value, so I should not take retained earnings separately, because already the market price includes the value for retained earnings also. Clear a point? Are able to understand? If a question is silent, I should take book value amounts. Book value means balance sheet value. That means the value is given in the question. Okay. But they might ask you to find out the weighted average cost of a capital using market value weights. How do I get market value weights? Simple. Number of shares into market price per share. If you are taking a market value weights, then you will be taking only equity. Retained earnings is not required. Why? Because already the market value of equity includes the value for retained earnings also. For example, face value 10, but market price per share is equal to 40. Okay. So that means what? Investor, in the market, investor is paying 40 rupees. He is paying 40 rupees for only equity share capital or what? No. If he purchases one share for rupees 40, he will get a share in equity share as well as retained earnings. That means that 40 rupees includes for both capital and retained earnings. Am I clear? That's the point. So clear? Okay. So now we can start questions. So directly come to question number 11, illustration number 11. Illustration number 11. June 24 7 marks and December 23 7 marks. You will get similar kind of questions from weighted average cost of a capital. Asian All Limited has the following capital structure. Capital structure means capital mix. Equity share capital 10 lakh shares, 100 lakhs. What is the face value? 100. 10 lakh shares, 100 lakhs capital means 100 lakhs divided by 10 lakhs. Face value 10. 12% preference share capital, 10,000 shares, amount 10 lakhs. What is the face value? 10 lakhs divided by 10,000, 100. Retained earnings 120 lakhs. Retained earnings 14% debentures, 70,000 debentures, 70 lakhs. 70,000, 70 lakhs. So what is the face value? 100. 14% term loan. దీనికేమి face value ఉండదు. Term loan. For term loan there will not be any face value. So total there are 5 sources. If they ask you to find out the weighted average cost of a capital, then first you should find out 5 specific cost. We should find out KE, KP, KR, KD, KTL, cost of a term loan. The market price per equity share is 25. The next expected dividend per share is 2 rupees and is expected to grow at 8%. The information is given to find out what KE, cost of a equity KE. The preference shares are redeemable after 7 years. Redeemable after 7 years at par. Redeemable at par. That means redemption value 100 and are currently quoted at 75 per share. Currently quoted at 75 per share. Market price as on today. So that 75 is taken as a net proceeds. So is it redeemable or irredeemable? Redeemable. So second formula has to be applied. Debentures are redeemable after 6 years at par. ఏం చేస్తున్నావు, రాఖీ కడుతున్నావా? Okay. And are currently quoted, I mean, debentures are redeemable after 6 years at par, and their current market quotation is 90 per debenture. The tax rate applicable to the firm is 50%. Okay. So we should find out what weighted average cost of a capital. So we shall find out weighted average cost of a capital using what? Two methods. First method, book value. So before finding out weighted average cost of a capital, first we should find out what specific cost. So cost of equity K, D1 is given. What is D1? 2 rupees. P0 is given 25. Growth rate 8%. So 2 divided by 25. You can do your own calculation. 2 divided by 25 plus 0.08. If you take 2 divided by 25, you will get 2 divided by 25. You will get 0.08. 0.08 plus 0.08. 0.16. Then multiply with 100. Okay. Else, otherwise, you take 2 by 25 into 100 plus what? 8%. So 16% is the cost of a equity K. Next, cost of a preference. Cost of a preference. So we should use first formula or second formula? Second. PD. What is the rate of a preference share? 12%. We have to apply the 12% on face value. Instead of taking the total amount, we find out the KP for one share. KP per one share. What is the dividend? 12 rupees. Dividend 12 rupees plus redeemable at par 100 minus net proceeds. Nothing but current market price 75 divided by 7. All divided by 100 plus 75 divided by 2. So what is the answer? 17.78. 79. So you should do proper rounding off also, otherwise you lose marks. So what is the exact number? 17.79. You take 3 decimal. 79580. Nothing but proper rounding off is 17.796. If the number is 5 or more than 5, you should go for next number. You will be losing marks because the valuation is done by a cost accountant who has, who have cleared cost accountancy 10 years or 20 years back. They will not be having any concepts. They will not be having a conceptual knowledge. So they will follow the suggested answer key. The answer has to match. So be careful. The answer is 17.796. Next, the cost of a debenture. M. Cost of a debenture KD. What is the debenture rate? 14%. So on 100, 14 rupees. 14 into 1 minus 0.5 plus redemption value. Redemption value 100. Redeemable at par, yes or no? Minus current market price 90 rupees divided by 6, all divided by 100 plus 90 divided by 2. What is the answer? 16.49, no. 0. ఏ నెంబర్లు అవి? 0.091. ఏంటిది 0.091. సో 9.1% ఆన్సర్. So 14 into 1 minus 0.5, 7, you will get 7, 0.07 plus 100 minus 90 divided by 6, 10 divided by 6, you will get 1.33. So 8.33 divided by 100 plus 90 divided by 2, 9 point 9.12%. Cost of a term loan. Cost of a term loan. Simple cost of term loan. In case of term loan, there will not be any redemption value, because in case of a loan, we pay the same amount. Redemption value and net proceeds will be same generally. So that's why KD is equal to I into 1 minus 3 divided by net proceeds. So we consider net proceeds as 100 for simple calculation. What is the interest? 14 into 1 minus 0.5, 7. Okay. So weighted average cost of a capital of Asiano Limited. So weights. Are you able to understand the specific cost calculation? Clear specific cost calculation. So specific cost will remain same whether you find out weighted average cost of a capital using book value weights or a market value weights. Prema, book value weights use chesna, market value weights use chesna, specific cost will remain same. Only the weights will change. So first part is book value weights. Book value weights. So what is the book value? 100 lakhs. Already given in the question. 100 lakhs. Book value means balance sheet values. 120, 70, 100. Total 400. Proportion 100 divided by 400. 0.250. 10 divided by 400. 0.025. 0.3, 0.175, 0.250. Okay, clear? Cost of a retained earnings is equal to cost of a equity. 16. What is the cost of preference share? 17.80. Nothing but 17.796 rounded off to 17.8. Okay, instead of 17.8 you might take 17.79. Okay, mistake also చూసుకోవాలి, రౌండింగ్ ఆఫ్ ప్రాపర్గా చేయాలి. 14% debentures, what is the rate? 9.12. Change and answer మరి. Change the answer. Take 9.12 and find out weighted average cost of a capital. So what is the change here? Instead of 8.25 we should take 9.12. So the answer is 1.596. The final answer is 12.592. 12.592. Clear? Okay, so clear. Next one is market value weights. Market value weights means only the weights will change, specific cost will remain same. So the one way of a calculation is, when market value weights are being taken, you should not take retained earnings. You should not take retained earnings because already the value of a retained earnings included in equity. So how many shares are there? How many shares? 10 lakhs. What is the market price? 25. That means straight away you take equity 10 lakhs into 25. 2 lakh, 250 lakhs. 250 lakhs. But in this question, they have segregated this 250 lakhs between equity shares and retained earnings. In the existing ratio, what is the existing ratio? Equity share capital 10 lakhs, 10 100 lakhs. Retained earnings 120 lakhs. So this 250 lakhs is segregated between equity and retained earnings. So 250 lakhs into 100 divided by 220 and 250 lakhs into 120 divided by 220. Clear? So instead of segregating, you can take simply equity 250 lakhs. So what about preference share capital? How many shares are there? Preference shares 70,000 into 70,000 10,000. 10,000 into market price 75. So 7 lakh 50. 14% debentures. There are 70,000 into market price per share debenture. Market price per debenture 90. 63 lakhs. 14% term loan. There will not be any market price for term loan. So same amount. Same amount. Clear? Only the weights will change. Specific cost will remain same. Clear? So what is the answer? So again here answer will change. Instead of 8.25 we should take 9.12. So clear? Change in answer. Change the answer. So tell me the change. Instead of 8.25 we should take 9.12. Here 1.3 double 6 367 1.367 total 12.87 12.876. $12.876. Clear? Next, see the 12th one. The following is the capital structure of ABC Limited as on 31st December 2021. Sources of finance. There are three sources: equity share, preference share and debenture. The market price of the company share is 110. Here share means equity share. It is expected that the dividend of rupees 10 per share would be declared for the year 2021. The dividend growth rate is 6%. So with this information we can find out KE 10 divided by 110 plus 6%. Okay. Next, if the company is in the 40% tax bracket, compute the weighted average cost of a capital. We should find out weighted average cost of a capital. Simple calculation, KE is equal to 10 divided by 110 plus 6%. What is the answer? 15.09. So to find out weighted average cost of a capital, we should find out KP. KP, no information is given about KP, preference share. That means it is irredeemable or redeemable? Irredeemable. So KP is equal to simple 10%. Market price is also not given. Market price is also not given. We assume that net proceeds is equal to 100. So 10 divided by 100, 10%. So KP is equal to 10%. KD is equal to market price of a debenture is also not given. So that's why we assume the face value is equal to 100. So 12 into 1 minus 0.4, we can save tax, right? So 12 into 1 minus 0.4 divided by 100. 12 into 1 minus 0.4 divided by 100, because we can save tax at the rate of 40%. So the answer is, what is the rate? KP 10%, KD 0.072, nothing but 7.2%. So they have taken 6%. 6% is not correct. 6% is correct answer if tax rate is 50. If tax rate is 50, either you should change the question. In question, take a tax rate as 50%. Then the answer is correct. 6. Clear? Soumya? మీకు అర్థమైందా ఇక్కడ మిస్టేక్ ఏంటో? ఓకే. So weighted average, what is the capital? So compute the weighted average cost of a capital. Compute the weighted average cost of a capital. So here the market value weights are used, but generally we should use what? Book value weights. So that's fine. So book value weights means 5 lakhs, 2 lakhs, 3 lakhs. Weights are 0.5, 0.2, 0.3. But here in the answer, market value weights are taken. Market value weights. So 5,000 shares into, what is the market price of equity share? 110. So 5 lakh 50,000. So clear? First part. See the second part. Assume that in order to finance an expansion plan, the company intends to borrow a fund of rupees 5 lakhs bearing 14% rate of interest. What will be the company's revised weighted average cost of a capital? One more source is getting added. What is the one more source? 14% loan. 14% loan means, what is the cost of a term loan? 14 into 1 minus 0.5 divided by 100. You will get 7%. One more source is getting added. One more source is getting added. Okay. So and what is the cost of term loan? Cost of a term loan 14 into 1 minus 0.5. 0.07, nothing but 7%. Okay. And see, this decision is expected to increase dividend from 10 to 12. However, the market price of equity share is expected to decline from 110 to 105. Actually, here the question is not correctly framed. It is a little bit confusing. The point is, existing source is 3. What are the 3 sources? Equity, preference, and debt. Second is, there is a revision. One more source is getting added. What is the one more source? 14% term loan is added. So actually this, what will be the weighted average cost of a capital, that has to be given at the end. Question has to be given at the end. Okay. So one more source is getting added, 14% term loan. What is that 14% term loan cost? 7%, because we can save tax at the rate of 50%. Tax at the rate of 50%. Okay. Generally what happens is, when the debt component is added in capital structure, the expectation of existing shareholders will increase. Why the expectation of existing shareholders will increase? Because the reason is, when the debt is added, new debt is added, the risk increases. The risk increases. Yes or no? For example, right now there is 100 lakhs debt, 100 lakhs equity, 100 lakhs equity. You are adding another 100 lakhs debt, then the risk is increasing. That risk is called as finance risk. Finance risk. Finance risk means risk arising due to the usage of a debt. Risk arising due to the usage of a debt. మీకు అర్థమవుతుందా? So finance risk increase అవుతుంది. The finance risk is getting increased, so that's why the expectation of equity shareholders will also increase. So that's why instead of 10 rupees dividend, they are expecting 12 rupees. So earlier they have expected 10 on 110, 10 on 110, yes or no? Now they are expecting 12 on 105, 12 on 105. If you see the KE, cost of equity KE, 12 divided by 105 plus 6%, 17.43. So their expectation has got increased because the risk has got increased. So basic fundamental adi, if risk increases, required return increases. Whenever the new source of a debt added, then the expectation of equity shareholders will also increase. So that is what happened here. So second part of the question, equity, cost of equity 17.43, cost of preference 10, cost of a debt 6, and cost of a new debt 7%. Okay. And the market value of equity changes. Market value of equity 5,000 shares into 105, 5,25,000. So generally we use a book value weights, but in CMA study materials I think they are using market value weights. If nothing is mentioned in question, they are using market value. I think in this question only market value weights are used. Okay, clear? Thirteenth, there are two 13s. Huh? See the second 13. Illustration 13, second 13. ABC Limited wishes to raise additional finance. Now we are going to discuss about weighted marginal cost of a capital. Weighted marginal cost of a capital means cost of a additional capital. Cost of a additional capital. Only the cost of additional capital will be considered. Here ABC Limited wishes to raise additional finance of rupees 20 lakhs to meet its investment plans. The company has rupees 4 lakhs in the form of retained earnings available for investment purpose. The following are the further details. Debt equity ratio 25:75. Cost of a debt at the rate of 10% before tax up to 2 lakhs, 13% before tax beyond that. Earnings per share 12 rupees. Dividend payout 50% of earnings. Expected growth rate in dividend 10%. Current market price per share rupees 60. Company's tax rate is 30%. Shareholders personal tax rate is 20%. Required calculate post-tax average cost of additional debt. Calculate the cost of retained earnings, cost of equity. Calculate the overall weighted average cost of a capital of additional finance. Nothing but this is WMCC, weighted marginal cost of a capital. They are asking you to find out the weighted average cost of a additional finance. Okay. So note down the solution. So what is the amount required? 20 lakhs. Illustration 13. Illustration number 13. What is the fund required? Working note 1. Pattern of raising funds. Pattern of raising funds. Pattern of raising funds. Fund required. What is the fund required? $20 lakhs is the fund required. What is the debt equity ratio? 25:75. So they are maintaining a debt equity ratio 25:75. Nothing but debt is equal to 5 lakhs. Debt is equal to what? 5 lakhs. How do we get this 5 lakhs? 20 lakhs into 25%, 5 lakhs. Next what? Equity 15 lakhs. That is given in the question. 15 lakhs. How do we get this 15 lakhs? 20 lakhs into 75%. Okay. And this debt, how do we raise this debt? So 10% up to 2 lakhs. Cost of a debt at the rate of 10% before tax. Before tax cost of a debt means nothing but interest rate. Interest rate. 10% debt up to 2 lakhs. So 10% debt up to 2 lakhs. 10% debt up to 2 lakhs. Next one is 13% debt. 13% debt 3 lakhs. Beyond, okay, total debt required is 5 lakhs. Up to 2 lakhs they are telling 10%. Beyond that 13%. So what is the beyond the borrowing? 3 lakhs. So whenever the amount to be borrowed increases, the rate of interest will also increase. See from the other side. See from the other side, I have already taken a 2 lakhs loan at the rate of 10%. If they are giving further 3 lakhs, they will be charging high rate of interest. If I have already a loan and I am applying for another loan, they will be taking higher rate of interest, because from the other side risk increases, so their required rate of return increases. Okay, clear? Equity. Equity, already we have an internal source. What is that internal source, Prasu? Retained earnings. Retained earnings. Retained earnings 4 lakhs. Next one is new equity. New equity. What is the new equity? 11 lakhs. That means in total we have 4 sources. 10% debt, 13% debt, retained earnings, new equity. Total 4 sources. We should find out specific cost for 4 sources. Clear, Bharat? So let us start. What is the first one? Cost of a, first part is they are asking you to find out the post-tax average cost of a debt. Post-tax average cost of a debt. First part. Yes or no? So write down A. Post-tax average cost of additional debt. post tax average cost of additional debt. Post tax average cost of additional debt. Clear? So simple calculation is KD is equal to KD is equal to. So we are taking debt of 2 lakhs, yes or no? So 2 lakhs into 10% interest. What is the interest amount? 20,000 plus 3 lakhs into 13%. This is the total interest we are paying. Yes or no? Into 1 minus tax rate. What is the tax rate? Corporate tax rate? 30%. I'm going to save tax at the rate of 30%. I'm going to save tax at the rate of 30% divided by, what is the total loan amount? 5 lakhs. Total loan amount is equal to 5 lakhs. Clear? What is the amount? 10.8.26. So this is one way of a calculation. Or KD of 10% debt. KD of 10% debt is equal to 10 into 1 minus 0.5. 5 or 3 na? 3. 10 into 1 minus 0.3 divided by 100. So that is equal to 7%. Ultimately I can save tax at the rate of 30%. Next, KD of 13% debt is equal to 13 into 1 minus 0.3 divided by 100. Answer 9.1%. Convert it into percentage. 9.1%. So they are not asking separately, they are asking average. Post tax average cost of additional debt. They are asking average. We cannot do a simple average because 10% debt amount is 2 lakhs, 13% debt amount is 13 lakhs. So that's why average cost of debt is equal to 3 lakhs. Average cost of a debt is equal to 7 into 2 lakhs divided by 5 lakhs. What is the 2 lakhs divided by 5 lakhs? Weight. Proportion. Plus 9.1 into evarna na premikudu 9.1 into 3 lakhs divided by 5 lakhs. So the answer is equal to answer is equal to 7 into 2 divided by 5 plus 9.1 into 3 divided by 5. What is the answer? Same answer all 8.26. You're getting the same answer or not? 8.26. The second way is find out the separate cost and then do a weighted average. First part. Clear? Manoj? 8.26% is the answer. Next, calculate the cost of retained earnings, cost of equity. కాస్ట్ ఆఫ్ రీటైన్డ్ ఎర్నింగ్స్, అలాగే ఏంటమ్మా కాస్ట్ ఆఫ్ ఈక్విటీ. కాస్ట్ ఆఫ్ ఈక్విటీ ఫైండ్ అవుట్ చేద్దామా? సెకండ్ పార్ట్ కాస్ట్ ఆఫ్ ఈక్విటీ. గణేష్ చెప్పమ్మా కాస్ట్ ఆఫ్ ఈక్విటీ. ఇచ్చాడా డివిడెండ్? అర్నింగ్స్ పర్ షేర్ ఇచ్చినట్టున్నారు కదా. ఎంతమ్మా అర్నింగ్స్ పర్ షేర్? అర్నింగ్స్ పర్ షేర్ 12 రూపీస్. దానిలో డివిడెండ్ పే అవుట్ 50%. తెలుసుగా డివిడెండ్ పే అవుట్ అంటే రిటెన్షన్ రేషియో ఎంత? రిటెన్షన్ రేషియో 6. రిటెన్షన్ చేసుకుంది 6 రూపీస్, పే అవుట్ 6 రూపీస్. అది మరి డివిడెండ్ పే అవుట్ రేషియో 50, రిటెన్షన్ రేషియో 50. ఓకే, సో డివిడెండ్ ఈజ్ ఈక్వల్ టు 12 into 50%. ఎంతమ్మా? 6. ఎక్స్పెక్టెడ్ గ్రోత్ రేట్ 10%. కరెంట్ మార్కెట్ ప్రైస్ 60. సో కే ఈజ్ ఈక్వల్ టు D1 బై, తీసుకోవాల్సిన కే ఈజ్ ఈక్వల్ టు D1 బై P0 ప్లస్ G. D1 తీసుకోవాలి. D1 అంటే ఏంటమ్మా? ఎక్స్పెక్టెడ్ డివిడెండ్. మరి 6 రూపీస్ ఏంటి? 6 రూపీస్ D1 ఏనా? 6 రూపీస్ అనేది D0. 6 రూపీస్ ఏంటమ్మా? D0. సో D0 కాబట్టి 6 ఇంటూ D0 ఇచ్చి D1 ఫైండ్ అవుట్ చేయాలంటే గ్రోత్ యాడ్ చేయాలి. వీ షుడ్ యాడ్ గ్రోత్. నథింగ్ బట్ D1 ఈజ్ ఈక్వల్ టు D0 ఇంటూ 1 ప్లస్ C. దట్ ఈస్ ఈక్వల్ టు D0 ఎంత? 6 into 1 plus 0.6.6. So 6.6 divided by 60 plus 0.1. So answer is equal to 21%. 21% is the cost of equity. Okay, clear? Next, cost of retained earnings. Cost of retained earnings is equal to పర్సనల్ ట్యాక్స్ రేట్ ఇచ్చారు కదా. సో కేఈ ఇంటూ 1 మైనస్ పర్సనల్ ట్యాక్స్ రేట్. సో 21 ఇంటూ 1 మైనస్ 0.2. ఆన్సర్ ఈజ్ ఈక్వల్ 16. ఓకే, సో వై we are reducing that personal tax rate? Because the reason is, first suppose the company, instead of retaining, it is paying to the investor. Dividend is paid out to the investor. So will the investor is going to get 21%? No, because out of 21 he has to pay 20% tax. Ultimately he is going to receive 16.8. Even though the company is paying 21, ultimately investor is going to get only 16.8. Yes or no? So that means investor is foregoing an opportunity of 16.8. So that's why KR is equal to 16.8. And students might feel that why there is a cost to the retained earnings. So cost to the retained earnings, simple. First suppose if I am not going to retain, what is the other option? I have to pay. If I pay dividend to the investor, investor can invest somewhere and can earn some rate of a return. Yes or no? But he is foregoing that opportunity. He is foregoing that opportunity to invest somewhere. So that's why there is a cost. Cost means here expectation, not the payment. Cost means what? Expectation. Investors will have a expectation on a retained earnings also. This retained earnings is also known as ploughing back the profits. Ploughing back. Ploughing back. Ploughing and తెలుసు కదా, దున్నడం. సో సో ప్రాఫిట్స్ మళ్ళీ ఏం చేస్తున్నాం, బ్యాక్ రీటైన్ చేసుకొని వీఆర్ రీఇన్వెస్టింగ్. ఓకే, ఆర్ గెటింగ్ మై పాయింట్? Retained earnings do have a cost, because if we pay dividend, investor can invest somewhere and can earn some rate of a return. As he is foregoing that opportunity, there is a cost. And why 1 minus TP? Even though we pay 21, investor will ultimately get what? 16.8. So that's why that is his opportunity cost of a capital. You know the meaning of opportunity cost, benefit foregone. What is the benefit foregone by the investor? 16.8. Clear? Cost of a retained earnings. Next one. So is there any other source? Next we should find out what? Cost of a capital. So what is the equity share capital? 11 lakhs. Retained earnings 4 lakhs, 10% at 2 lakhs, 16% at 3 lakhs total. So these are the weights. And specific cost of a capital: 21%, 16.8, 7%, 9.1. Instead of taking these two separately, you can take directly 5 lakhs. You can take directly 5 lakhs. Then you will get weight 0.25, 0.25. Here you will be taking 8.26, 8.26. So clear? So done. What is the final answer? 16.97. 16.97 is the answer. Done. So in this question, the special point is cost of a retained earnings KR is equal to K into 1 minus TP. TP means personal tax rate. Okay. Are able to understand why there is a cost to the retained earnings? What is the personal tax? Tax paid by the investor. Even though I give 21, investor will ultimately get 16.8 because he has to pay 20% tax. So the benefit foregone is 16.8. Okay. For suppose if there is a brokerage, even if I give 21, investor will ultimately get what? If a brokerage is also 20%, then 16 point into 1 minus 0.2. So 16.8 into 1 minus 0.2. 13.4. So ultimately investor will get what? 13.44, because there is a personal tax and there is a brokerage. The benefit foregone is 13.44. So that's why KR is equal to KE into. Why only KE? Because retained earnings belongs to equity shareholders. Retained earnings belongs to equity shareholders. So that's why equity shareholders will have a same expectation as he is having us in on equity share capital. Equity share capital పైన ఎంత అయితే ఎక్స్పెక్టేషన్ ఉందో సేమ్ ఎక్స్పెక్టేషన్ దేని పైన ఉంటుంది? రీటైన్డ్ ఎర్నింగ్స్ పైన ఉంటుంది. సో దట్స్ ఏ KR ఈజ్ ఈక్వల్ టు KE. బట్ ఇఫ్ దర్ ఈజ్ అ ట్యాక్స్ రేట్, పర్సనల్ ట్యాక్స్, KE ఇంటూ 1 మైనస్ TP ఇంటూ 1 మైనస్ బ్రోకరేజ్ B. క్లియరా? ఓకే. సో నెక్స్ట్ క్వశ్చన్, ఇంకా మీకు దీనిలో కాంప్లికేట్ అనిపించిన క్వశ్చన్స్ ఏంటమ్మా? First 13th question, try that question. If you have any doubt, let me know. See the illustration number 6. Illustration number 6. Using dividend growth model, calculate cost of a equity. Equity share capital, shares of rupees 10 each, rupees 2 lakhs. Earnings for 2021, 60,000. Current market price per share, 180. Dividend per share 2018 7, 2019 9, 8, 2020 10, 2021 11. We should find out what? Cost of equity KE. So what is the KE formula? D1 divided by P0 plus G. Here P0 is given. What is P0? 180. 180 is the P naught. Growth rate is not given, we have to find out the growth rate. So how do we find out growth rate? First, initially dividend is equal to 7, then dividend has got increased to 8. So increase is equal to 1. 1 rupee divided by 7, then you will get percentage. So 14.29 percentage is the growth rate for the first year. Next year, what is the growth rate? 10. From 8, dividend has got increased to 10. So that means 10 minus 8 divided by 8. 25%. Growth rate in 2019. 11 minus 10 divided by 10. 10% is the growth rate. So first year growth 14.29, second year 25, third year 10. On an average, growth rate is 16.43. Simple average. We are doing a simple average. 16.43 is the okay. So there is another concept, compounded annual growth rate. So that will be calculated using IRR method. Okay. So later on we shall discuss. So KE is equal to what is the expected dividend next year? 11. For 2021, 11 rupees dividend. So 11 divided by 180 plus growth rate. So 22.54 is the cost of equity KE. Clear? Done? Next, see the seventh one. If the risk-free rate of a return and market rate of a return are 14 and 18, risk-free rate 14, RM 18, cost of equity. If beta is equal to 1, then answer is 14 plus 18 minus 14 into 1. Yes or no? So the answer is 18%. If a beta is equal to 2 by 3, then 14 plus 18 minus 14 into 2 by 3. And next, the third, 14 plus 18 minus 14 into 5 by 4. Clear? Next, eighth question. From the following information, in respect of the company, you are required to calculate the cost of equity using CAPM. Risk-free rate 12%. Expected market price of the equity share at the end 1400. At the end 1400 market price. Initial price of the investment in equity share 1200. One is P naught, current market price at the beginning, P naught 1200. P1 is equal to 1400. Beta risk factor of the company is 0.7. Expected dividend at the year end is 140. Expected dividend at the year end is 140. So we should find out what CAPM return. RF plus RM minus RF into beta. RF is given 12. Beta is also given. What is beta? 0.7. 0.7. So we should find out what RM, market return. So market return has to be given, but not given in the question. So this answer is not completely correct because due to lack of information, we are using the share information to find out market return. Share information to find out market return. Generally, when you make investment in equity shares, you will get two types of returns. One is the capital appreciation, second is a dividend. Are you getting my point? Generally, so whoever makes investment in stock market, they will get return in the form of dividend and capital appreciation. So that's why the return formula is P1 minus P naught plus D1 divided by P naught. If you see the price at the beginning, what is the price at the beginning? 1200. Price at the end is 1400. That means investor is getting a benefit of 200 because initial investment is 1200. The price has got increased to 1400. So he is getting a benefit of 200 plus, in addition to that, he got a benefit of 140 dividend. 140 dividend. What is his investment? 1200. His investment is 1200. On that 1200, he is getting 200 plus 140, 340. 28.33%. So this we are going to discuss in portfolio management chapter SFM. So return is equal to P1 minus P naught plus D1 divided by P naught. P naught is the initial investment. Investor is investing 1200. The investment value is getting increased to 1400. That means he is getting a capital appreciation 200 plus dividend. Total he is getting a return of 340 on 1200. So the rate of return is 28.33. క్లియరా? స్టాక్ మార్కెట్లో ఇన్వెస్ట్మెంట్ చేస్తే మనకు వచ్చేది ఏంటి? షేర్ ప్రైస్ ఇంక్రీజ్ అవుద్దనే కదా. నథింగ్ బట్ నువ్వు ఎక్స్పెక్ట్ చేసేది ఏంటి? క్యాపిటల్ అప్రిసియేషన్. రెండోది ఏం రావచ్చు? డివిడెండ్ రావచ్చు. ఇక్కడేం డివిడెండ్ వచ్చింది 140, క్యాపిటల్ అప్రిసియేషన్ ఎంత? 200, ఓవరాల్ 340. క్లియర్? సో K ఈజ్ ఈక్వల్ టు 12% ప్లస్ 28.33 minus 12 into beta 0.7. So this is the final answer. Clear? 23.43. Next, illustration 9. Beta 1.4. The company has been maintaining 8% rate of a growth in dividend and earnings. The last dividend paid, paid means past. That is not a D1, that is D naught. The return on a government securities is 10%, while the return on a market portfolio is 15. The current market price of a one share is 36. What will be the equilibrium price? And would you advise for purchasing the share? Again, this is also a final level concept. So simple concept. K is equal to RF. What is RF here? 10% plus RM. RM already given in a question. 15 minus 10 into beta 1.4. So K is equal to 17%. K, cost of equity K. 17.7. 7.7 ఛాన్సే లేదు. Because without expecting any risk, without any risk, we are expecting 10%. 10% means you should take 10. 10 plus 5 into 1.4. Be careful. 17%. 7.1 వచ్చిందంటే మీరు 0.1 తీసుకున్నారు. 10%ని 0.1గా తీసుకున్నారు. అలాగలా ఇక్కడ 0.1 తీసుకుంటే ఇక్కడ 0.07 రావాలి. సో 0.1 plus 0.07, 0.17 into 100, 17%. క్లియరా? పర్సంటేజ్ 10ని అలాగే తీసుకోండి, లేదా ఏం చేస్తారు? 0.1. ఒకవేళ 0.1 తీసుకుంటే ఇక్కడ ఏం చేయాలి? 0.15, ఇక్కడ 0.1. క్లియరా? సో ఆన్సర్ ఏంటి? 17%. KE. So what is another formula for KE? Example, KE is equal to D1 by P naught plus G. Nothing but KE minus G is equal to D1 by P naught. Nothing but P naught is equal to D1 divided by K minus G. So this is the formula for equilibrium price. Formula for equilibrium price. P naught is nothing but what? Current market price. P naught is nothing but what? Current market price. So what is this model? CAPM, capital asset pricing, share price. By using this model we find out the share price. So P naught is equal to D1 divided by KE minus G. What is the D1? What is D1? Last paid dividend. 4 per share. 4 into what is the growth rate? 4 into 1 plus 0.08 divided by KE. What is KE? 0.17 minus 0.08. So what is the answer? 4 into 1 plus 0.08. 48 rupees, not percentage, that is rupees. 4 into 1 point, so 4 into 1 plus 0.08. You will get 4.32. 4.32. So remember this formula. Again we are going to give logic for this formula in time value of a money. P naught is equal to D1 divided by K minus G. So this formula is being derived from K formula. What is K formula? D1 by P naught plus G. Nothing but K minus G is equal to D1 by P naught. So that is P naught is equal to D1 divided by K minus G. So this is called as a equilibrium price, theoretical price. We have learned one theory and we have applied theory and we have calculated a price. What is the price? 48. So the price of a equity share in our perception is 48, but whereas in the market the price is 36. So am I going to buy that share or not? Yes? No? Yes, I will purchase the share. Why? Because in my perception the price is 48. 48. For example, in your perception, so the land on this bypass road, 1 acre 4 crores. 1 acre 4 crores. This is your perception. Okay, you have applied a theory and based on the theory, so the price of each acre is 4 crores. But in the market, the price of each acre is 2 crores. In market, the price of each acre is 2 crores. Are you going to buy or not? Double naslu. Yes, sir. Okay. Okay, if you have a money, then you are going to buy or not? Yes. Why? The reason is because it is undervalued. It is undervalued. Why? In our perception, the price must be 4 CR, but whereas in market it is 2 CR. So we are going to buy. Likewise here also, in our perception, the share price is 48, but in the market the price is 36. It is better to buy the share. Worth buying. అంతేనా కదా, వర్త్ బయింగే కదా. అదో ఇప్పుడు భరత్ అని ఉన్నాడమ్మా, భరత్ అని ఉన్నాడు. సో 9th one. నెక్స్ట్ ఏంటమ్మా 10th. So 10th one is simple. AKS Limited retains 10 lakhs out of its current earnings. Current earnings. Okay. AKS Limited retains rupees 10 lakhs out of its current earnings. The expected rate of return to the shareholders if they have invested the fund elsewhere is 10%. If they had invested elsewhere, what is the rate of return? 10%. Brokerage 2%. Shareholders comes in 30% tax bracket. Calculate the cost of a retained earnings. So simple calculation, 10% into 1 minus 0.3 into 1 minus 0.02. This is one calculation, one type of a calculation. So then you will get what? Answer 6 point. నేను చెప్పిన క్యాలిక్యులేషన్లో 5 రాదు. 6.86%. If you are applying this formula, the meaning is brokerage is 2%. That 2% is applied on net amount. That is 7%. 2% is applied on 7. That means 0.14. You will get 0.14. So 7 minus 0.14, you will get 6.86. But in study material, they are taking 10 into 1 minus 0.3. Straight away they are reducing 2%. Straight away they are reducing 2%. అంటే ఏంటి దాని అర్థం? 2% we are not applying on 7. We are reducing 2 from 7 directly. అంటే అక్కడ అజంప్షన్ ఏంటి? బ్రోకరేజ్ 2% on 7 కాదు. Straight away he is taking what? 2% from 7 అని అర్థం. అందుకే నీకు ఎంత వచ్చింది? 5. మీకు అర్థం అవుతుంది చెప్పింది. 7 పైన 2 తీసుకోవట్లేదు. 2 అజంప్షన్స్ ఉన్నాయి. 7% పైన 2% అంటే యూ విల్ గెట్ 6.86. బట్ వేర్ ఆర్ స్టడీ మెటీరియల్ ఆన్సర్ ఈజ్ వాట్? స్ట్రైట్ అవే ద బ్రోకర్ ఈస్ టేకింగ్ 2% ఫ్రమ్ 7. 2% ఫ్రమ్ 7, నాట్ ఆన్ 2%. సో నాట్ ఆన్ 7. So right away taking 2% from 7. That means 7 minus 2, 5. If it is 2% on 7, then the answer is 6.86. So clear? So next illustration 13. What is the special point there? Growth calculation. Okay. Growth calculation. So growth calculation. So do you know the compound interest shortcut? Compound interest. So here the dividend has got increased from 10.6 to 14.19. Yes or no? So we have to find out the growth rate. Let us assume 10.6 is the principal, 14.19 is the amount. 14.19 is the amount. So compound interest shortcut. In calculator first you take I, interest. Generally we take interest, add 1, multiply with 1, plus equal to n times. Press equal to how many times? N times. In 5 years, the principal has got, dividend has got increased from 14.9 1 14.19 to 14.19 to 10.6 to 14.19. to 14.19. So one way of a calculation is consider this 10.6 as a principal, 14.19 as a amount. Now we should find out what? Interest. Okay. So let us assume growth rate is equal to 10%. Growth rate is equal to 10%. In calculator take 0.1 first. 0.1. We are assuming that growth rate is equal to 0.1. So 0.1 plus 1 into 10.6. 0.1 plus 1 into 10.6. 11.6. Nothing but trial and error. We are assuming that the growth rate is 10%. Press equal to another 4 times. Press equal to another 4 times. 17. So 17.07 at 10% you are getting what? 17 point, but I should get 14.19. I should get 14.19. Yes or no? So 10% is not the right answer. 10% is not the right answer, because if I am applying 10% growth rate, by the end of 5th year I am getting 17.07. But dividend has got increased from 10.6 to 14.19. So that's why next second trial, 5% trial, 5%. In calculator take 0.05 plus 1 into 10.6 press equal to 5 times 13.5 3 13.53, but I should get what? 14.19. So that means growth rate is greater than 5, less than 10. Next trial, it is closer to 5, right? So next trial 6, 0.06 plus 1 into 10.6 press equal to 5 times 14.19. That means growth rate is equal to 6%. This is one way of a calculation. Okay, and the other way is IRR method, internal rate of a return. So in capital bursting or in time value for money, we are going to discuss IRR. So that method can be applied to find out growth rate. Any other doubt in illustration number 11? Any other special point? D point. Debentures. The company proposes to issue 11 years 15% debentures, but the yield on debenture of similar maturity and risk class is 16%. Flotation cost is 2%. Flotation cost is 2%. So what is the point? So see the question. The company proposes to issue 11 years 15% debentures, and again once again this is the special point. The yield of a debentures of a similar maturity and risk class is 16%. Okay. Similar a class of a debentures, okay, yield means return is 16%. When the yield increases, the value of a debenture decreases. Okay, when yield increases, yield means expectation 16%. The similar class of a company's yield is 16%. Our rate of a debenture is 15%. We are paying 15% rate of interest, but the other companies, okay, other investors are expecting 16. That means our investors will also expect what? 16%. When expectation increases, value decreases. When expectation increases, what happens to the value? Value decreases. Okay, are getting my point? Value decreases. So that's why what we are doing is we are following an approximation method. On 15% debentures, investors will have an expectation of a 16. So that's why the value will get decreased too. So 100 into 15 divided by nothing but 15 divided by 100 into 15 divided by 16. 100 into 15 divided by 16. 93.75. Generally the value of a debenture must be 100, provided if expectation is also 15. Debenture is paying 15% interest, but the expectation of investor is 16. So that's why the value of debenture is getting decreased. Whenever expectation increases, value decreases. So this is also a special point in this question. So that's why 93.75 minus what? Flotation cost 2 rupees, 91.75. So clear? if market interest rates increases, bond value decreases. Again, this is also final concept. If interest rates in the market increases, bond value decreases. Because if interest rates in the market increases, then our investors will expectations will increase. Expectation of our investors will increase. When expectation increases, value decreases. So that's why I am telling fundamentals are very important. The fundamental point is wealth maximization is the superior objective. Wealth depends upon two factors. One is the risk, profit and risk. If a risk increases, required return increases. If required return increases, if expectation increases, value decreases. So that is what happening here. If expectation increases, that is what I am saying. Present generation have a lot of expectation over a life. So that's why the value of a life is getting decreased. So that way, okay. So likewise, and value depends upon perception. Value depends upon perception. Advainda. If expectation increases, value decreases. Okay, so clear? Is there any other point to be discussed in cost of a capital? Sanjay? Baladitya? So yesterday's additional question number 2, cost of a capital. So some students might be having a doubt. So general formula KP is equal to cost of a preference is equal to PD plus RV minus NP divided by N whole divided by RP plus NP divided by 2. RV plus NP divided by 2. This is a general formula, right? But when a tax on a dividend is given, tax on a dividend, nothing but tax on a dividend distribution tax. The tax is paid by the company. Tax is paid by the company. If you see the additional question 2, in that additional question number 2, then formula will be PD into 1 plus dividend tax plus RV minus NP divided by N whole divided by RP plus NP divided by 2. So that is equal to, so first we shall find out the preference dividend into 1 plus dividend tax. 1 means nothing but preference dividend. The simple formula is we should consider preference dividend including dividend tax. So what is the preference dividend? 100 into 12%, that is 12 rupees. Yes or no? 12 rupees plus on 12 rupees, 12.5% is the tax on a dividend. So calculate 12% on a 12.5% on 12. 1.5 plus surcharge 2.5% that has to be applied on tax, that is 1.5. 2.5% you have to apply on 1.5. 1.57 1.5375 plus what? Education cess. What is education cess? 3%. Again that 3% has to be applied on 1.5. 0.045 0.045. So this is the total preference dividend plus what? Tax. What is the total? $12 plus 1.5 plus 1.5375 plus 0.045. I think this is not 1.5375. Second one, 1.5 On that you have to apply 2.5%. 1.5 into 2.5. 0.0375. Now take the total. 13.5825. So this is the total dividend including tax. Total dividend including tax. Am I clear? Okay. So in question bank, okay, the other way of doing is simple. In calculator take 12.5%, 12.5, 12.5, take 12.5, add 3%, 3%, 2.5 first, take 12.5 and then add 2.5%. You have to press percentage button and then plus 3 percentage, then you will get 13.1968. So that is given in the question bank, right? Okay, clear. So and one more point, beta. So beta means what? A risk factor. In exams they might mention, instead of mentioning beta, they might give it as a systematic risk. Beta is called as a systematic risk, and instead of giving a risk free rate, they will give a treasury bill rate. Treasury bill rate, like otherwise government bonds, government bonds, treasury bills. So government bonds, if you are investing in government bond, there is no risk. If you are investing in RBI treasury bills, there is no risk, because RBI will repay at any cost. RBI will repay at any cost. So generally if you are investing in a bank, if you are depositing money in a bank, then there is no risk, generally less risk, because if a bank doesn't have a money, it will charge some, it will levy some charges from the customers, it will collect extra charges from the customers and will repay the loans. So that's why less risk. If you are making any deposit in a bank, then means there is a less risk. Okay, clear? So beta is also known as what? Systematic risk. Beta is also known as systematic risk. Okay, next. So what is the basic object, two aspects of financial management? Procurement of fund, effective utilization of fund. Okay, procurement and effective utilization of a fund. So procurement, Vamshi, itra first bench ki. Radhakrishna, మీరు వచ్చేయండి ముందుకి. Procurement and effective utilization of a fund. So while procuring fund, generally we have two sources, equity, debt. For utilization we have two purposes, fixed assets, current assets. Investment in fixed assets, we have a capital bursting chapter. Investment in current assets, working capital management chapter. Working capital management. Okay, so now let us see the another basic FM. Basic financial management rule. Basic financial management rule. Yesterday I have discussed the cash requirement. Generally we maintain a cash for three purposes. What are the three purposes? Transactional need, safety need, speculation need. So speculation means, for example, the gold prices might increase. There might be a sudden increase in gold price or sudden decrease in gold price. If there is a sudden decrease in gold price, so we are going to buy gold or sell. We are going to buy. For that we need some money. So there might be a sudden decrease in land rates. Okay, there might be a sudden decrease in land rates. In that case also we are going to purchase the land. Okay, for that purpose we might maintain a cash. So speculation. So some students might be waiting for big billion day. That means they are waiting for what? Speculation. They are waiting for offers. Speculation. So for three purposes, any organization will be maintaining a cash. First purpose is transactional need. Second, safety need. Third, speculation. Third one is speculation. So what is the amount of cash to be maintained? That depends upon a size of an organization. Simple, when you are in 10th, you might have maintained 100 rupees. Now you are maintaining 500. So after 2 years or 3 years, you might maintain 5,000 rupees. Yes or no? So depending upon the size of an organization. If it is a small hospital, it will maintain a less amount of a cash. If it is a big hospital, has to maintain greater amount of a cash. You getting my point? So for example, Kirana store will maintain great cash, high amount of a cash, or a DMart. DMart has to maintain a high amount of a cash, not the not just cash. For example, if you compare the Kirana store and DMart, who is maintaining a high stock? DMart is maintaining a high stock. DMart is maintaining a high stock. Okay. So that means DMart is making a greater amount of investment in working capital. Working capital. So why do we maintain stock? That point we have discussed in cost accounting. So why generally we maintain a stock? In order to avoid a stock out situation. In order to avoid stock out a situation. What is stock out situation? For example, if you are going to a Kirana store and if you are asking for a pickle jar, you may not get it, yes or no? Okay. So then the image of that Kirana store will get increased or decreased? Decreased. Why we all prefer to go DMart or some metro something? Why? Because the reason you will be getting everything there. Okay. Yes or no? So doormats, t-shirts, pickle jar, whatever. Okay. So the reputation will increase when there is no stock out situation. If you are making an investment in stock, you can avoid stock out situation. Stock out situation. Okay. So before moving on to working capital management basics or something, basic fundamental rule, the money requirement can be for short term purpose or medium term purpose or long term purpose. So generally an organization may require money for three purposes. That can be a short term purpose, medium term purpose, or long term purpose. Okay. The basic fundamental rule of a financial management is, if a money is required for short term, that should be met firm. That should be met firm short term source. That should be met from short term source. And if you require money for medium term purpose, medium term means, for example, 1 to 5 years. 1 to 5 years. Then it has to be met from medium term source. And if you need money for long term purpose, that should be met from long term source. Short term purpose means less than 1 year. Less than 1 year. Medium term purpose means 1 to 5 years generally. More than 5 years means long term purpose. The basic fundamental rule is long term purpose must be met with long term source. Okay. So let us see an example. For example, Baladitya, he wanted to do a crackers business during a Diwali season. During Diwali season, he wanted to do crackers business, or else he wanted to do a Vinayaka statue business during Vinayak Chavithi. So these are what short term. So the point is he wanted to do a crackers business during those 4 or 5 days. Okay. Now, for suppose Baladitya he is planning to issue 12% debentures redeemable after 20 years. Is it a correct approach or not? He require money for how many days? 4 to 5 days. So now he is going to issue debentures which are redeemable after 20 years. So is it, so correct decision or not? This is not a correct decision. Why? The money is required only for 4 or 5 days. Unnecessarily, why to pay interest for 20 years? Yes or no? So the point is, this is not a correct option. Okay? He should go for a short-term loan, hand loan. He should take money from a friend, which has to be repaid in 4 or 5 days. Yes or no? So short-term purpose must be met from short-term source. Likewise, long-term purpose must be met from long-term source. For example, Radhakrishna, he got a contract. He got a contract, airport construction contract, Amaravati airport construction contract. So Amaravati airport construction contract means whether construction will get completed in 4 to 5 days or what? No. So first point, land acquisition has to be done. So land acquisition has to be done by the state government. Okay. So after land acquisition, then what? Work will start. Will the airport will be constructed within a 1 year or what? No. It is a short term or long term? Long term. It is a long term purpose. It is a long term. So now Radhakrishna, he has taken a hand loan of rupees 500 crores from Manisha. Okay, and he agreed to repay in 10 days. He agreed to repay in 10 days. 10 days lo repay chesta annadu. Okay. Purpose and what is the purpose of taking a loan? Construction of a airport. Okay. So 10 days, Radhakrishna he planned everything, how to spend, how to start construction of airport and everything. So Manisha started asking back money. Okay. So she, keep on asking the money, first point, and if he is not paying, then she will be filing a case under section 138 Negotiable Instrument Act. So check dishonor of a check. Yes or no? So now the point is whether reputation will get damaged or not, because Radhakrishna he is not repaying the debt on time. Debt on time. First point, he will be facing a liquidity problem. Liquidity problem. Liquidity problem means there is a short-term commitment, but there is no cash. Generally, in my perception, girls' liquidity position will be better than the boys' liquidity position. Are you getting my point? So boys might be having a short-term commitment. They might have to pay money to that canteen babai, but they may not have a cash. So that means these boys are facing what? Liquidity version. Okay. But generally girls will have a surplus cash. Generally. Surplus means I'm not talking about crores, at least 100 or 200. Okay. So the point is liquidity means what? Ability to meet short-term commitment. Ability to meet short-term commitment. Liquidity. Okay. So generally boys will face, okay, boys are unable. Okay, boys are unable. Nothing but they are not able to meet a short-term commitment. So that means they are facing a liquidity problem. Okay, clear? So the basic fundamental rule is, financial management rule is, short-term purpose must be met from short-term source. Long-term purpose must be met from long-term source. If you are meeting the long-term purpose with short-term source, then you will be facing liquidity problem. If you are meeting a short-term purpose with long-term source, then unnecessarily you have to pay interest. Unnecessarily you have to pay interest. Balaji. Okay, unnecessarily you have to pay interest. Okay. So clear? Next. So time value of a money. Time value of a money. Time value of money. So this is very important topic, and without time value of money, we cannot proceed to learn FM, financial management, or SFM, strategic financial management. So time value of money. Okay. So the value of money depends upon a time. Depends upon a time. Okay. Present 1 rupee will have a more value than a future 1 rupee. Present 1 rupee will have a more value than a future 1 rupee. For example, present Baladitya is having 100 rupees. At least he will get 2 Maggie. Yes or no? 2 Maggie. Right? For example, after 20 years, he is having the same 100 rupees. Okay. Will he get same 2 Maggies? Okay, he may not get 2 Maggies. Yes or no? For example, 20 years back. 20 years back. If a Baladitya had 100 rupees, Baladitya had 100 rupees, so 20 years back. So 20 years back, he might have got at least a 5 to 6 Maggies. Yes or no? So the point is, if he is having 100 rupees as on today, he will be getting 2 Maggies, but after 20 years, he may not get even a single Maggie also. So which rupee is having a greater value? Not future, present. If you think future 1 rupee is having a more value, then give 10 lakhs today. Take same 10 lakhs after 20 years. So then you will get to know the time value of money. Okay. So the point is, present 1 rupee will have a more value than a future 1 rupee. Okay. The bird in the hand will have a more value than a bird in the air. Bird in the hand. Bird in the hand will have a more value than a bird in the air. Why? Bird in the air is certain. Ushasri ante kada. Bird in the air is, bird in the hand is certain. చేతిలోనే ఉంది కదా, వండుకుని తినొచ్చు, అవునా? సో బర్డ్ ఇన్ ద ఎయిర్ అన్సర్టెన్. బర్డ్ ఇన్ ద ఎయిర్ అనేది దొరుకుతుందో లేదో తెలీదు, అవునా కదా, అన్సర్టెన్. సో బర్డ్ ఇన్ ద హ్యాండ్ ఈజ్ ఆల్వేస్ బెటర్ దాన్ వాట్? బర్డ్ ఇన్ ద ఎయిర్. సో present 1 rupee will have a more value than future 1 rupee. Present 1 rupee is certain. Present 1 rupee is certain. Present 1 rupee is certain. Are you getting my point? Present 1 rupee is certain. For suppose, if you are giving 1000 rupees, if you are giving 1000 rupees as on today, if you are giving 1000 rupees as on today, so after 25 years, after 25 years, I will give you 50,000. I will give you 50,000. After how many years? 25 years, I will be giving what? 50,000. So this number might be tempting, yes or no? Why? You are just giving 1000, but you are going to get 50,000 after how many years? 25 years. So let us see. Okay. So in calculator, take 0.24. What is the 0.24? For every 1 rupee, 0.24 is the interest per annum. Interest per annum. Okay. Nothing but 2 rupees interest. 2 రూపాయలు వడ్డీ అంటాం కదా. So that is the 0.24. 2% per month means 24% per annum. So you are taking 0.24, right? So 0.24 plus 1 into 1000 press 1 time equal to, you are getting 1240, right? So what is the meaning of this 1240? So future value of 1000 after 1 year. Okay, after 1 year the value of this 1000 is 1240. Okay, so 1 time equal to, so but I am saying you that after 25 years I am going to give 50,000. So press 24 times, another 24 times equal to, press equal to another 24 times. press equal to another 24 times. What is the amount you are getting? 2 lakh 2,60,000. Ardhavenda. So that means what? I'm just giving 50,000 rupees, but the value is 2,60,000. So generally, if a rate of interest is 24%, for every 4 years, the amount will get doubled. For less than 4 years only, it will get doubled. 4 years. So that means 1,000 will become 2,000 in 4 years, and in next 4 years, 4,000, and next 4 years, 12,000. That means in 12 years, sorry. So 1,000, 2,000. How many years? 4 years. And next 4 years, 4,000. Next 4 years, 8,000. 12. So by 16, 12 into, 12 plus 12, 8. 8. 8 plus 8, 16. Next 32. Next 64. 64. So this is a random calculation, but generally in less than 4 years, the amount will get doubled. In less than 4 years, the amount will get doubled. So in calculator, take 0.24. 0.24 plus 1 into 1 into 1. Press equal to. You're getting 1.24. One time. Again equal to 1 point. Again equal to 1 point. Nothing but approximately 3 point something years, the amount is getting doubled. So 1 rupee is almost equal to 2 in 3 years. Actually, I have told 4 years. In 3 years, the amount is getting doubled. If the rate of interest is 24%. For suppose if your grandfather has taken 1,000 rupees 50 years back at the rate of 24%. At the rate of what? 24%. Okay. How much amount you lost? You can count it. 50 years back. I'm talking about 50 years back. In calculator, take 0.24 plus 1 into 1,000. Press equal to 50 times. Press equal to 50 times. So 50 years back, for suppose, imagine if your grandfather has taken 1,000 rupees. The value of as on today. What is the value as on today? 5 crores something. We are considering 2 rupees interest. We are considering 2 rupees. 24% interest. 24% interest. అర్థమవుతుందా ఎంత? So okay, for suppose you will become someone's grandfather, right? Okay, if you're losing 1.95 lakhs in 1.95 lakhs in these next 6 months, how much your grandson is going to lose? In calculator, take 0.24 plus 1 into 1 lakh 90. 1 lakh 90. So I think there will be an error in calculator. So let us try. Press equal to how many times? 50 times. You will not get answer. You will get error in calculator. నెంబర్ చదవడానికి కూడా అవ్వదు. One thousand 1,104 crores your grandson is losing just because of your irresponsibility. Okay, 1,104 crores. So time value of money తెలియాలి మీకు. You should know the time value of money. మీకు చెప్పింది అర్థమైందా? Because of your grandfather you lost how much? 5 crore. Okay, మీ వల్ల 1100 crores వచ్చిందా? So 1100 crores. What is this 1,90,000 actually? The package you are going to lose, okay, in next 6 months. Okay, you're getting my point. So a time value of a money is very important. So but the point is, after 50 years that 11,004 crores will have a just this value only, 1,90,000. 1,90,000. So right now you might be feeling that is a great number, but after 50 years that 11,000 crores will be like what? Considered as a small number, I mean the regular amount only. Okay, am I clear? So now time value of a money, what is this? First, interest. Interest is paid by interest. What is this interest? Charges paid by lender or borrower? లెండర్ అయితే స్లైస్లో అప్లై చేస్తారు కదా, అదే పనిగా చార్జెస్ పెయిడ్ బై బారోవర్ టు లెండర్. చార్జెస్ పెయిడ్ బై బారోవర్ టు లెండర్. So generally in Islam and Christianity, payment of interest is considered as a haram, the papam. Okay, interest ki ivvakudu. Of course so many people will be doing outside, but generally what so interest cannot be taken because the person who is lending money is not doing anything. He is not doing anything, and the money is being given for some purpose. There might be a health reason, the purpose might be a business. If the other person is losing money, how can he pay interest? So that is the concept. Even in Hinduism also there, but still nobody follows. So interest means charges paid by borrower to lender. Okay, so why interest is charged? Why interest is charged? First reason why the interest is charged. Okay, interest is charged because first reason, opportunity cost. Opportunity cost. Opportunity cost. Soumya for example, okay, she is having 10 lakh rupees. She is having 10 lakh rupees, but she gave a loan to Karthik. She gave loan to Karthik. So now Soumya will be charging interest, right? Why the reason? Because opportunity cost. Opportunity cost means benefit foregone. Benefit foregone. She might have started pickles business, but still she foregone that benefit and gave a loan to Karthik. Benefit foregone. Okay, she needs some premium for benefit foregone. Ma Soumya. Soumya na ee parenti? Bundi. Gautamiya. Sare. Sare. Gautami. So sorry, my name change. Gautami. So why lender will charge interest? Because the first reason is opportunity cost, benefit foregone. Okay, so here Gautami, she is foregoing the benefit. What is the benefit? Investment opportunity. She can invest in business, yes or no? She can invest in a business, but she is foregoing a benefit. So that's why She will be charging interest. Opportunity cost. Second, risk. Risk means possibility of a occurrence of a loss. Possibility of occurrence of loss. So if you're giving money to someone, there is a risk. He may or may not repay the money. For suppose if Gautami is giving loan to Karthik, whether there is a risk or not? Yes. Okay. Karthik may say that I have not taken any money from you. Kaushik has taken. Yes or no? So there is a risk. He may not repay the loan. Okay? Risk. High risk, high interest. High risk, high interest. High risk, high interest. For example, Gautami is giving loan to Karthik, landlord. Landlord. She will be charging interest, yes or no? For example, Gautami is giving loan to auto driver Bharat. So the point is, okay, the point is, she will be charging interest or not? Yes. High rate or low rate? High rate. High rate. Why high rate? So understand the point here. Why high rate? Reason? Because the simple reason is high risk. Yes or no? First person is a landlord. Repayment capacity. He is having a repayment capacity. But the person, second person is a okay. So driver, that depends upon a business. Yes or no? High risk, high interest. If risk increases, required return will also increase. So why lender will charge interest? Opportunity cost, risk, and third, preference for or a premium for postponing present consumption. Present consumption. Premium for postponing present consumption. Present consumption. For example, she might have bought bundi and had eaten, yes or no? But instead of eating or consuming, what she is doing? She is postponing the consumption. Everybody want present consumption or later? For suppose if you have a chance to buy a car, Audi, are you going to buy car as on today or after 50 years? Today, yes or no? Why to come in bus, yes or no? So if you have a chance to buy an Audi car, are you going to buy as on today or after 20 years? As on today. Okay, if you have a chance to buy a gold, are you going to buy as on today or after 20 years? As on today. Yes or no? So generally we prefer a present consumption. If you have to give a loan to other person, you have to postpone your consumption. Ante kada? Consumption postpone చేసుకోవాలి. So that's why since I am postponing my consumption, so lender requires a premium. If I am postponing for 1 year, I will take less premium. If I am postponing for 10 years, I will expect high premium. Are you getting my point? So premium for what? Postponing a present consumption. So these reasons are enough. So these are the reasons for what? Charging interest. So there are two types of interest: simple interest, compound interest. Simple interest, which is not prevailing in the market. Simple interest. Simple interest is equal to P into T into R. Principal into time into rate. Okay. So let us take example. Principal is equal to 1 lakh. T is equal to 5 years. R is equal to తెలియదు కదమ్మా, అడగండి. 20%. R is equal to 20%. So example, simple interest, simple interest. So principal is equal to 1 lakh, T is equal to 5 years, R is equal to 20%. So principal is equal to 1 lakh, T is equal to 5 years, R is equal to 20%. Okay. So simple interest is equal to, simple interest is equal to, what is the answer? 1 lakh into 5 into 20%. Answer 1 lakh is the simple interest. Amount is equal to principal plus interest. What is the principal? 1 lakh plus 1 lakh. Amount is equal to what? 2 lakhs. Very good, Amma. Okay. So this is simple interest, which is not common in the market. Okay. So amount is equal to what? 2 lakhs. Amount is equal to 2 lakhs. So amount is equal to what? 2 lakhs. Amount is equal to 2 lakhs. Next. Okay, next. Compound interest. Next what? Compound interest. So in the market this is prevailing. Compound interest. Compound interest means interest on interest. Interest on interest. Okay. So let us take same example. Example 2. Same example. The only change is compounded annually. Compounded annually. Amount is equal to formula A is equal to P into 1 plus I power n. A is equal to P into 1 plus I power n. 1 plus I power n. నీ పేరేంటన్నా? శివ వాళ్ళ తమ్ముడు వినయ్. చూస్తే ఆన్ అవుతుంది. A is equal to P into 1 plus I power n. So compounded annually. Compounded annually. Okay. So instead of using the formula, we use a shortcut. Compounded annually. So shortcut. In calculator, first take I. What is the I? Interest rate. What is the rate of interest here? 20%. 20% means take 0.2 plus 1 into 1. Multiply with 1. Multiply with 1. You can multiply with principal also, but just multiply with 1. 0.2 plus 1 into 1. So press equal to, what is the number? 1.2. First understand this meaning. If you are giving a loan of 1 rupee as on today, after 1 year with interest, that will be 1.2. Again equal to 1.44. 1.44, not 1.4. 1.4 means simple interest. 1.44 compound interest. Nothing but interest is added to principal for every period. So again equal to 3 years. Again equal to 4 years. Again equal to 2.48832. అంత వచ్చిందా? ఒకసారి చూడండి. అగైన్ ఇన్ క్యాలిక్యులేటర్ టేక్ 0.2 plus 1 into 1 press equal to 5 times. Press equal to 5 times. Okay, 2.8832. The meaning is, if you are giving a loan of 1 rupee as on today, with interest that will be around 2.48832. Okay, clear? But the loan being given here is 1 lakh. So that's a multiply with 1 lakh. Very good, Amma. Amount is equal to 2 lakh 48 8 32. Vasant. 2,48,832 rupees is what amount at the end of 5 years. This is compounded annually. This is compounded annually. Compounded annually. Am I clear? Next, example 3. First, suppose if they are asking you to do a compounded half yearly. Compounded half yearly. If they are asking you to do a compounding half yearly, then you should take interest rate per half year. Interest rate for half year. What is the half year interest rate? Per annum 20%. Half year means 10%. In calculator take 0.1. When I calculator take 0.1 plus 1 into 1 plus equal to how many times? 10 times. For 5 years there are 10 half years. For 5 years there are 10 half years. N means number of periods, not number of years. 2 point into 1 lakh. 2 259 374. 259 374 rupees is the answer. Done. 259 374 rupees is the answer. Okay, this is compounded half yearly. For suppose if it is compounded quarterly, what is the quarter interest rate? Quarter for year, how many quarters? 4 quarters. Year ki any quarters untai? 4 quarters. 2 halves, 4 quarters. Okay, so what is the quarter interest rate? 0.05 plus 1. 0.05 plus 1 into 1 press equal to how many times? 20 times. 5 years means 20 quarters. 2.6952 into so example 4 compounded quarterly. ఎంత వచ్చిందమ్మా ఆన్సర్? 2,60,330. Amount is equal to 265,330 rupees. Clear? Compounded quarterly. Compounded monthly చేయొద్దులే, but how to do compounded monthly? We should take month interest. 0.2 divided by 12. Nothing but 0.01667 plus 1 into 1 press equal to how many times? 60 times. 30 కాదు, 5 into 12. ఇయర్కి ఎన్ని మంత్స్ ఉంటాయి? 12 months కదా. చెయ్యొద్దని చెప్పినా చేస్తారండి మీవి, అంత సరదాగా ఉందండి మీకు. ఓకే సరే, ఓకే. కాంపౌండెడ్ డైలీ, దెన్ చేయండి. కాంపౌండెడ్ డైలీ, కాంపౌండెడ్ డైలీ, then what? 0.2 divided by 365 plus 1 into 1 press equal to 5 into 365 times. Okay, so that is compounded daily. For example, compounded every minute, compounded every second, compounded every nanosecond, that is called as a continuous compounding. Continuous compounding. Mahesh, benchilenti rangeyalenti. So continuous compounding. So continuous compounding we are going to discuss at final level. Right now we are discussing only the compounding annually, half yearly, quarterly, mostly monthly. That's it. Okay, clear? So are you able to understand the shortcut? I plus 1 into 1 plus equal to n times, then what? We multiply with principal. Clear? Clear, Gautami? So this is amount calculation, compound interest amount calculation. So how do we get compound interest amount minus principal? So that is 2,65,330 minus what? Principal 1 lakh. You will get what? 1,65,330. That is compound interest. Clear, Vasant? Okay. Next. Next, so let us move on to the annuity concept. Annuity means same amount at same intervals. Same amount at same intervals. Annuity. Okay. Annuity means same amount at same intervals. In annuity, there are two: annuity regular, annuity immediate due. Same amount at same intervals. I'm not writing the example, but I will tell you the example. Same amount at same intervals. For example, Ashwant, he is giving 1 lakh rupees a gift to his wife on her every birthday. On her every birthday, he is giving 1 lakh rupees gift. Okay. Is it an annuity or not? Is it an annuity or not? It is an annuity because same amount at same intervals. Same amount at same intervals. Clear? Okay, same amount at same intervals. So Radha Krishna, he is giving. Okay. Okay. So Radha Krishna, he is giving what? 1 lakh to his wife. First year he is giving 1 lakh. Second year 2 lakhs. Third year 4 lakhs. Okay, his love is getting doubled every year. Okay. So is it an annuity or not? No, it is not an annuity. Why? Same interval but not same amount. Not a same amount. So Manoj, he gave 1 lakh to his wife for first year, second year 1 lakh, third year 1 lakh, fourth year he lost money in betting and he couldn't give. Fifth year he gave 1 lakh. Fifth year he gave 1 lakh. Is it an annuity or not an annuity? Not an annuity. Why? Why? Same amount, same intervals. So not interval is not same because fourth year no money. Okay, yes or no? For example, Manoj, he gave 1 lakh first year, second year 2, third year, okay, first year 1, second year 1, third year 1, fourth year 1, fifth year he got lot of amount in betting and he gave 10 lakhs to his wife. Annuity or not an annuity? Not an annuity. Amount is not same. Amount is not same. Clear? Okay. So annuity means same amount at same intervals. Annuity regular, annuity immediate. Annuity regular, annuity immediate. Annuity regular means at the end of the period. At the end of the period. Annuity immediate means beginning. Annuity immediate means what? Beginning. As on today. As on today. Am I clear? So first, principal amount. Amount is nothing but what? Future value. Principal is nothing but what? Present value. Present value. So annuity means annuity regular, annuity due. Annuity regular means what? At the end of the period. Annuity due or immediate means at the beginning. Amount is equal to what? P into 1 plus I power n. Amount is nothing but what? Future value, right? Amount, the amount we are going to get in future. So future value. Principal means present value. We are going to give as on today. So that means nothing but we can write it as a future value is equal to present value into 1 plus I power n. Nothing but present value is equal to what? Future value divided by 1 plus I power n. So for example, if in the question principal is given, present value is given, and if they are asking you to find out the future value amount, we are doing compounding. Compounding means multiply. If you observe the shortcut, 0.2 plus 1 into 1 press equal to n times, yes or no? So that means we are multiplying. So whenever in the question, if they are giving a present value and asking you to find out the future value, we do a compounding. Compounding means multiply. Okay, because future value is equal to present value into. But if a future value is given and we have to find out the present value, like in capital budgeting, future cash flows are given, but we should find out present value. We should go for discounting. Should go for discounting. For example, present value is equal to what? Future value divided by 1 plus I power n. Okay, you can see the chart. So present value is given in the question. If they ask you to find out the future value, we go for compounding. And if they are giving a future value and asking you to find out the present value, we go for discounting. Is it clear? So next, so these are the shortcuts for future value of annuity, present value of annuity, future value of annuity regular, present value of annuity regular. Generally in the question, if they are not mentioning anything, we assume the annuity as a regular. If a question is silent, we assume that annuity as a regular. Regular means end of the period. So okay, immediate means what? Beginning of the period. So see the shortcuts. Future value of annuity immediate. Okay, future value of annuity immediate. Annuity immediate means beginning, as on today. So in calculator, first you should take interest rate. Let us assume the interest rate is equal to 0.12. Understand the concept. 0.12 similar to compound interest. So take 0.12 plus 1 into 1 press equal to 1 time 1.12. What is this actually? If you are depositing 1 rupee as on today, in 1 year that will be equal to 1.12. Press equal to again 1.2544. 1 rupee is becoming 1.2544 in 2 years. Press again equal to 1.404928. So by third year, 1 rupee will become 1.404928. Now press grand total GT. So understand that number. Nothing but that is a total of that 1.12, 1.2544, and last number somewhat you told. So 1 point something. Nothing but that 3 total. Once again, okay, observe the calculation. 0.12 is nothing but interest for 1 rupee. 0.12 plus 1. 1 is a principal. 0.12 plus 1 into 1. Press equal to 1 time. You're getting 1.12. Press equal to again 1.2544. Press equal to again 1.404928. So 1. Now if in the question they give you a principal 1 rupee, n is equal to 3 years and rate of interest is 12%, then what is the amount? 1.40492. But if I am giving, okay, if I am depositing 1 rupee every year for 3 years, then what is the value? Then I should take a grand total GT, total of the 3 numbers. So press GT. 3.7. 793 something, okay, 3.79 something. So what is this number? If I am depositing 1 rupee every year for 3 years at the beginning, then the value is 3.7793. Okay, so first year beginning I am depositing 1 rupee, on that I will get 3 years interest. Second year beginning I am investing 1 rupee, on that I will get 2 years interest. Third year beginning I am investing 1 rupee, on that I will get 1 year interest. Clear? Okay, so grand total, this is called as a future value annuity factor. Future value annuity factor. So if I am depositing 1 rupee every year for 3 years, then the value is this, yes or no? But if I am depositing 1 lakh every year, then what is the answer? Multiply with 1 lakh. What is the answer? 3 lakh 77,933 is the answer. So this is the future value of a annuity immediate. Nothing but, if you see the shortcut, take I, add 1, multiply with 1, press equal to how many times? N times. Here n is equal to 3, so that's why 3 times. Press equal to n times and then press GT, grand total, then multiply with annuity. In our example, annuity is equal to 1 lakh. Okay, smile. Takku steps kabatti. For suppose if it is a future value of annuity regular, future value of annuity regular. See this one. Future value of annuity regular. So then the shortcut is, in calculator take 0.12 plus 1 into 1, press equal to only n minus 1 times, only 2 times. Why only 2 times? Annuity regular means at the end. If you are depositing 1 rupee at the end of a third year, you are not going to get any interest. And if you are investing 1 rupee at the end of a first year, you are going to get only 2 years interest. Only 2 years interest. So that's why what? Press equal to how many times? N minus 1 times. Press grand total 2 point and then add 1. That 1 is nothing but third year 1, because we are not getting any interest. So 3.3744. If I am depositing 1 lakh every year for 3 years at the end, then the value is 3,37,443. So this is the answer. So 337,440. Am I clear? Are you able to understand the shortcut? Clear? So this is very important. This chapter is having a link with capital structure and the capital budgeting. Okay. So I'm doing a compounding. If I have to find out the future value, I'm doing compounding. Clear? A shortcut, sir? Nothing but future value of annuity is equal to annuity into future value annuity factor. Yes or no? Future value of annuity is equal to what? Future value of annuity is equal to annuity into future value annuity factor. If it is immediate, I will press equal to n times. If it is regular, I will press equal to n minus 1 times GT and then add 1. Okay. Next concept, present value. So this is more useful actually. Present value. Present value means what? To bring the future value to the present value, we go for discounting. Discounting means divided by. Divided by. For this, the shortcut is, in calculator take 1. In calculator take 1 divided by 1 plus I. In our example, I is equal to 12%. So 1 divided by 1.12. 1 divided by 1.12. Tell me the number. 0.8928 0.8928. What is this? This is a present value factor. This is called as a present value factor. Okay, nothing but present value of a 1 rupee to be received at the end of a first year. If you are going to receive 1 rupee at the end of a first year, that 1 rupee value as on today is 0.8928. Are you getting my point? Press again equal to 0. So this is present value factor of a second year. Present value factor of a second year at the rate of 12%. At the rate of 12%. Press again equal to. So this is what a present value factor at the end of for the third year. Present value of a 1 rupee to be received at the end of a third year. Okay. So if it is 3 years and if it is present value of annuity immediate, present value of a annuity immediate, we should press equal to n minus 1 times only. So malli starting nunchi randi. 1 divided by 1.12 press equal to how many times? 2 times only. Only 2 times. Present value of a annuity immediate. Why only 2 times? Annuity immediate means beginning. First year beginning means as on today. First year beginning means as on today. That we need not do a discounting. Second year beginning means first year ending. Third year beginning means second year ending. So that's why if you are finding out the present value of annuity immediate, press equal to how many times? N minus 1 times. So 1 divided by 1.12 equal to how many times? 2 times. Grand total. Then add 1. 2.69. So the answer is into 1 lakh. 2 lakh 69,005 rupees. Clear? 2,69,000 rupees is the answer. So this is present value of annuity immediate. Be careful. Present value of annuity immediate means press equal to how many times? N minus 1 time. But generally the most useful one is present value of annuity regular. Present value of annuity regular. If it is present value of annuity regular, then take 1 divided by 1 plus I. Press equal to how many times? N times. Press equal to n times. Grand total. This time n times. Press equal to how many times? N times. Annuity regular means end. First year ending means 1 time discounting. Second year ending means 2 time discounting. Third year annuity means 3 times discounting. 3 times discounting. So 1 divided by 1.12 press equal to how many times? 3 times grand total. 2 into 1 lakh. 2 lakh. Clear? Are you able to understand the concept? So this is very important in SFM and business valuation. 150 marks totally dependent on this time value of a money topic. Without understanding, okay, it is very difficult. Are you getting my point? Are you able to understand how to bring it to the present value? So mostly you will be finding what? Annuity regular or immediate? Regular. Annuity regular, and mostly they will be asking present value of annuity regular. Present value of annuity regular. How do we get present value of annuity regular? Annuity into present value annuity factor. How can we find out PVAF? 1 divided by 1 plus I press equal to n times grand total GT. Okay. So sometimes they might ask you to find out the annuity. Be careful. In capital bursting I will ask you this question. They might ask you to find out annuity. Then how can we find out annuity? Present value of annuity divided by present value annuity factor. Nothing but loan will be given. they will be asking you to find out the installment. Okay. So they will ask you to find out what? Installment. So installment is equal to what? Loan amount divided by present value annuity factor. Clear? Okay, annuity is equal to present value of annuity divided by present value annuity factor. Am I clear? So generally they will be giving you what? Okay, loan amount. For example, n is equal to 20, I is equal to 0.1. Loan amount. What is the loan amount? Loan amount 5 lakhs. They are asking you to find out the installment. How can I find out installment? Simple. Annuity is equal to present value of annuity, that is loan amount. Loan is given as on today. Installments are paid in the future. So loan amount is nothing but present value of a annuity. So that's why if you see the calculation, this is the loan amount. I have to find out annuity. How can I find out PVA for present value annuity factor? 1 divided by 1.1 press equal to 20 times. 1 divided by 1.1 press equal to 20 times, because here n is equal to 20. 1 divided by 1.1 press equal to 20 times. And then grand total 8.513 3 6 5 6, so you can take 3 6, 8.5136. So the annuity is equal to what? 5 lakhs divided by 8.513. That is the installment you have to pay. The same concept in capital bursting, we call it as a equated annual cost. Are you able to recall that equated annual cost? Equated annual cost is equal to sum of a discounted cash outflow divided by present value annuity factor. So that is similar to this one. So again I am going to explain. Are you able to understand? If in the question present value is given and if they ask you to find out future value, we do compounding. If a present value is, future value is given and if they ask you to find out present value, we go for discounting. Discounting means divide. That's why in capital bursting most of the times we call discounted cash flows. Discounted means we are bringing the future cash flows to the present value. So clear? Okay. Next there are 5 examples, very important examples. Value of asset, last concept in time value for money. Value of a asset. From the asset you might get what? A single cash flow. So this is very important concept, value of a asset. So valuation of a asset, value of any asset depends upon what? Future economic benefit. Nothing but value of asset is equal to present value of a future economic benefit. Value of asset is equal to present value of a future economic benefit. Clear? So this is very important. So any asset, okay, will come under these categories. So asset might give a single cash flow, only one benefit. For example, okay, Pushpa Ganesh, red sandal. If he is growing a red sandal trees, so the point is, are we going to get a benefit every year? No. మీకు అర్థమవుతుందా? రెడ్ శాండల్ ఉషశ్రీ మ్యాంగోస్ ఏమైనా కాస్తాయా? కాయ కదా. ఎవ్రీ ఇయర్ రిటర్న్ వస్తుందా? ఎవ్రీ ఇయర్ వస్తుందా బెనిఫిట్? ఎవ్రీ ఇయర్ వీఆర్ నాట్ గోయింగ్ టు గెట్ అ బెనిఫిట్. ఎస్ ఆర్ నో? benefit will be received only one time. Only one time. So for example, red sandal. Okay. In our FM, the example is zero coupon bond. You know the zero coupon bond? Zero coupon bond means zero interest. The bond is issued at a discount, redeemable at face value. You might have got in DT, direct taxes. Zero coupon. Zero coupon means zero interest. The bond is issued at discount, redeemable at face value. Redeemable at face value. For example, company is issuing a zero coupon bond. Mahesh is purchasing a zero coupon bond. What benefit Mahesh is going to get? Mahesh is going to get a benefit of a face value. Zero coupon bond is issued at discount and redeemable at face value. For example, redeemable after 5 years. Redeemable after 5 years. Redeemable after 5 years and face value 10,000. Face value 10,000. Face value 10,000. So what is the benefit Mahesh is going to get? Mahesh is going to get a benefit of what? 50,000. Future economic benefit being derived by an investor. Enta 10,000. 50,000 ekkada Mahesh enchita. Sir, investor is going to get a benefit of what? 10,000. Are you getting my point? That too as on today or after 5 years? After 5 years. If a Mahesh purchases a zero coupon bond as on today, he is going to get a benefit of 10,000 after 5 years. Now we should find out the value of a zero coupon bond in the perception of a Mahesh. For example, Mahesh required rate of return is 20%. Mahesh required rate of return is 20%. 20% is the required rate of a return. Okay, for suppose, then what is the value of this bond? So calculator, take 1 divided by 1.2, 1 divided by 1.2 press equal to 5 times. 1 divided by 1.2 press equal to 5 times. 0.40. So understand the meaning of this. If a Mahesh is getting 1 rupee after 5 years, the value of that 1 rupee as on today is 0.4018. But Mahesh is going to get 10,000 rupees after 5 years. What is the value as on today? Discounted cash flow 4018. 4018. What is this 4018? 4018 is value of a zero coupon bond from the perception of a Mahesh. For example, Shiva Priya perception is time value of a money, that is required rate of a return is 15%. If her required rate of return is 15%, will the value remain same? Will the value remain same or not? No. In that case, what is the value? 1 divided by 1 point 1 divided by 1.15. 1 divided by 1.15 press equal to 5 times. Press equal to 5 times. 0.4971. So the answer is 4971. One thing here you have to observe is, from the perception of a Mahesh, the value of a bond is 4018. So I have told you value depends upon a perception. So that's why మీరు కొంతమందికి నచ్చుతారు, కొంతమందికి నచ్చరు. అర్థం? దాని మీనింగ్ ఏంటి? వాల్యూ డిపెండ్స్ అపాన్ అ పర్సెప్షన్. ఓకే. So here also the bond value from the perception of a Mahesh is 4018, but from the perception of a Shivapriya is 4971. 4971. Are you getting my point? For suppose in the market, the company is issuing zero coupon bond at the rate of 4,500. Company is issuing zero coupon bond at the rate of 4,500. Now the point is, Shivapriya is going to buy it or not? Yes, Shivapriya is going to buy it, because in her perception the value is 4,971. But whereas in the market she is getting it for 4018. 4018. Sorry, 4,500. 4,500. Whether Mahesh is going to buy it or not? Mahesh is going to buy it or not? No. Why? Because in his perception the value is 4018, but the market price is 4,500. So Mahesh is not going to buy it. Mahesh is not going to buy it. Clear? So value completely depends on perception. And two factors influence the value. Two factors. One is the profit, that is 10,000. One is the benefit. I have already told you, wealth depends on two factors. Benefit. What is this benefit here? 10,000. For suppose if benefit is 1 lakh, then obviously value will also increase. Yes or no? If a profit increases, wealth increases, no doubt. The next point is, wealth depends on risk. If risk increases, required return increases. If required return increases, value decreases. That is what happening here. For example, if required rate of return is 15%, the value is 4971. If required rate of return is 20%, the value is 4018. So nothing but if required return increases, value decreases. The primary objective of a financial management is to maximize the wealth. Maximize the wealth. So to maximize the wealth, profit has to be maximized, but risk should be minimized. Because if risk reduces, required return will also reduce. So this is the first category of asset. This is the first category of a asset. What is the first category? Single cash flow. Single cash flow. So wealth depends on two factors. What are the two factors? Benefit and then risk. Benefit and what? Risk. If a benefit increases, value increases. For example, instead of 10,000, take 1 lakh. What happens to the value? Increases. Okay. So what about risk? If risk increases, required return increases, value decreases. Clear? Okay, done. So this is a single cash flow. Next, second category. Even cash flow. Even cash flow, definite period. Even cash flow. So you might have got, okay, plant and machinery questions. I mean capital bursting questions. In capital bursting, if you are purchasing a bus might give a even cash flow for definite period. Equal cash flow for definite period. A plant and machinery might give a even cash flow for definite period. Okay. For suppose if you are purchasing a car and if you are leasing out this car to a software company, okay, to carry the employees, you will be getting what? Even cash flows for definite period. Even cash flows for definite period. So for example, there is an asset, so which is giving a benefit for 1 to 5 years, and benefit for every year is 10,000. Benefit for every year is 10,000. So there is asset, it is giving a benefit for 5 years. What is the benefit? 10,000 every year. 10,000 every year. Now I should multiply with present value annuity factor. Let us assume 20% is the required return. Why I am multiplying with PVF? This is present value annuity factor. Earlier I have multiplied with present value factor. So that is a single cash flow. This time what? I am getting multiple even cash flows. Same amount at same intervals. So then I should multiply with PVAF. How will I get PVAF? 1 divided by 1.2 press equal to 1 divided by 1.2 press equal to how many times? 5 times. Grand total 0.4 2.9906. So discounted cash flow 29906. Nothing but what is the meaning of this 29,906? If there is an asset which is giving a benefit of 10,000 every year for 5 years, and if your time value of money is 20%, then the rate, I mean the value of asset as on today is 29,906. So this is what we are doing in capital budgeting. We are bringing the future cash flows to the present value. And those cash flows can be even cash flows. Even cash flows. Are you getting my point? For suppose, third category, uneven cash flows. Uneven cash flows. Uneven means not equal. Even means equal. Even means equal. Previous example, cash flows are equal. Here cash flow, this time I should not take PVAF. I should not take PVAF. This time I should take PVF. Here cash flow, PVF at the rate of 20% discounted cash flow. For suppose there is an asset which is giving a benefit for how many years? 3 years. Benefit for 3 years, and the cash flow 10,000, 12,000, 14,000. 10,000, 12,000, 14,000. Again, for this category, we can take plant and machinery as an example, or a new project. New project. So 10,000, 12,000, 14,000. So PV factor. What is the PV factor? 1 divided by 1.2, 0.833, 0.6944. Next 0.5787. So 8330 6944. Next 8102 total. Second one, second one 8 double 333 total 24 24 765. Are you able to understand the meaning of this? If there is an asset which is giving a benefit of 10,000 first year, 12,000 second year, 14,000 third year, then the value of asset as on today is, value of that asset as on today is 24,765, provided required rate of return is 20%. If required rate of return is 10%, the value increases or decreases? Calculation is not required, just tell me. If required rate of return is 10%, the value is going to increase or decrease? The value is going to increase. Keep your expectations low. Expect a break first, okay? That's it. Keep your expectations low. So 20%, instead of 20%, if you are expecting 10%, then automatically value increases. Clearer? If required return decreases, value increases. Okay. నేను స్టడీ హాస్కి లేట్గా వస్తే 5 రౌండ్స్ కదా, ఈరోజు లేట్గా వస్తే 10 రౌండ్స్ అని మీరు ఫిక్స్ అయిపోయారు అనుకోండి, 7 రౌండ్స్ ఏమంటే చాలా హ్యాపీ ఫీల్ అవుతారు. కీప్ యువర్ ఎక్స్పెక్టేషన్స్ ఆల్వేస్ వాట్ లో, వాల్యూ ఇంక్రీజెస్. ఓకే పవన్, నాన్నగారు కొడతారని ఎక్స్పెక్ట్ చేయాలి, సో తిడితే హ్యాపీ ఫీల్ అవుతాం. సో దిస్ ఈస్ ద థర్డ్ ఎగ్జాంపుల్. These two categories you will be finding in capital budgeting. Next, fourth category. Write down the fourth category. Given cash flow. Infinite period. Even cash flows infinite. So year 1 to infinity, cash flow 10,000, required rate of return 20%. Okay, if it is 3 years, then 1 divided by 1.2 is equal to 3 times grand total. If it is 100 years, 1 divided by 1.2 is equal to 100 times grand total. If it is 1000 years, 1 divided by 1.2 is equal to 1000 times grand total. Yes or no? But here it is infinite. That means the asset is going to give a benefit for how many years? Infinite years. So generally plant and machinery will not have a infinite years life. Bus will not have a, vehicles will not have a indefinite period life. Humans will not have a indefinite period life. Yes or no? So what kind of asset will come in this category? No. So land, of course land will have an indefinite period, but still land will not be coming. Business will come in this category. Equity share will come in this category. There is a redeemability period for what? Debentures, preferences, but for equity shares there is no redeemability period. The basic concept of accounting, going concern, a business will have a indefinite period life. Okay, so my life might be limited, but BCCA life is indefinite. If I'm not there, someone will come and take the charge. Okay, always a firm or a company will have a indefinite period life. So that is a basic assumption. So 1 to infinite years of benefit. So in this category we will be getting equity share and what? Business. Equity share and business. And perpetuity bond means continuous. Indefinite period you will be getting interest. In this case, how can we find out value? This case is simple. Value is equal to benefit divided by required return. What is the benefit here? 10,000 divided by 0.2. 50,000 is the value. If there is an asset which is giving a benefit of 10,000 every year, for how many years? Indefinite period. So what is the value of that asset as on today? 50,000 is the value of asset as on today. For suppose if required return is 10%, then value is equal to 10,000 divided by 0.1, 1 lakh. If required return decreases, value increases. So this is not a, new one actually. So if it is a bond, perpetual bond, then I write interest divided by, because investor is going to get interest for indefinite period. Yes or no? Value is equal to benefit divided by required return. If it is a perpetual bond, investor is going to get interest for indefinite period. So that's why interest divided by interest rate. Interest divided by interest rate. Then you will get principal. Nothing but value of a bond. Value of a bond. Next, value of a firm. EBIT divided by KO. So the same logic. Value of firm is equal to EBIT divided by KO. Why EBIT divided by KO? The benefit is earnings before interest and tax. What is the required rate of a return of a firm? KO, overall cost of a capital. For suppose if it is equity, then earnings available to equity shareholders divided by KE, cost of a equity. Earnings available to equity shareholders divided by KE, cost of a equity. Are you getting my point? Why we are applying these formulas? Because investor is going to get a benefit for indefinite period. Clear? And if you observe the KE formula, KE is equal to D1 by P naught. That means P naught is equal to D1 by K. So that is also same. D1 is a benefit, KE is a required return. Clear? Okay. So this is the fourth category. And then Vamsi, fifth category. Fifth category, cash flow, infinite years, with growth, every year growth. Generally in business, in case of business, there will be a growth. Why do the benefit will remain same? For example, the cash flows of BCCA will remain same or what? Generally business will grow, and growth depends upon two factors, B into R, retention ratio, reinvestment rate, return on equity, reinvestment rate. కామన్ సెన్స్ అప్లై చేయండి. గ్రోత్ ఎప్పుడు ఉంటుంది? వచ్చిన ప్రాఫిట్స్ రీటైన్ చేసి రీఇన్వెస్ట్ చేస్తే, అదర్వైజ్ నో కదా. సో ఇఫ్ దెర్ ఈజ్ అ గ్రోత్, సేమ్ ఎగ్జాంపుల్ ఇయర్ cash flow. What is the 1 to infinity cash flow? 10,000. Required return 20%. Growth 10%. Growth 10%. Every year growth 10%. You are expecting 20% every year, but growth is 10%. So that will get offset and your net expectation is 10. So nothing but value is equal to benefit divided by required return minus growth. Benefit divided by required return minus growth rate. So nothing but answer is 10,000 divided by 0.2 minus 0.1. Nothing but if there is a growth, the value will increase, because that will reduce your required return. That will be reduced from required return. And the investor is expecting 20%. In that 20%, growth is 10%. Clear? So value is equal to benefit divided by required return minus growth rate. Next, so this is what yesterday we have discussed. P naught is equal to D1 divided by K minus C. Similar or not? Similar. P naught, current market price of a share, is equal to D1 divided by what? K minus G. D1 means dividend. What is the benefit equity shareholder is going to get? Equity shareholder is going to get a dividend for indefinite period. Yes or no? So P naught is equal to D1 divided by KE minus G. If it is a value of a firm, then EBIT divided by KO minus G. EBIT divided by KO minus G. Value of a firm. If it is value of equity, earnings available to equity shareholders divided by what? KE minus G. Valuation is a subjective concept. Subjective means depends on a perception. If you see the formulas, P naught is equal to D1. We are taking dividend. Value of equity, here we are taking earnings. Earnings available to equity shareholders. Clear? And we can find out per share value or overall value. So in last case I am writing overall value. Value of equity is equal to earnings available to equity shareholders divided by KE minus G. P naught means current market price per share. I will take dividend per share D1 divided by KE minus G. Growth rate. What about perpetual bond? No growth. Yes or no? If a person is giving a debt, if he is investing in a perpetual bond, there will not be any growth. Yes or no? Debenture holder or a bond holder cannot expect a growth. So that's why this is bond will not come under fifth category. Fifth category only business and equity. Business and equity. So whatever the asset, I mean whether it is a plant and machinery, generally plant and machinery will comes under second or third category. Yes or no? Capital budgeting questions. Capital budgeting questions. Capital budgeting all questions will come under either second even cash flows or third uneven cash flows. Capital budgeting questions. Okay. Capital structure, value of a firm, EBIT divided by KO. EBIT divided by KO. Okay. So value of a business, value of a equity comes under either fourth category or fifth category. First category only one, zero coupon bond. Zero coupon bond. Because plant and machinery will not give 1 year benefit. No plant and machinery will have a life of a 1. Yes or no? Clear? Okay. So 5 examples. These are very important examples. 5 examples. So clear? So time value of money. We are not getting much questions from time value of money. But this topic is very much relevant for capital bursting and capital structure. Capital structure, very much relevant. Okay. So for valuation also very much relevant. So they might ask final level questions. So in previous 3 question papers there are 1 or 2 final level questions, final level MCQs. So to solve those questions, first you have to understand this time value of money conceptually. Value of any asset depends upon what? Future economic benefit. Value means wealth. Okay, and wealth depends on what? Profit, required return. If you observe this P naught formula carefully, if D1 increases, what happens to P naught? What happens to P naught? If D1 increases, P naught increases. Nothing but if benefit increases, wealth, value increases. Yes or no? What about KE? If a KE increases, if K increases, P naught decreases. So yesterday we have learned one formula, K is equal to RF plus RM minus RF into beta. Beta means a systematic risk factor. Now tell me, if a beta increases, what happens to KE? If a beta increases, what happens to KE? Prakash Raj, Vinay. What happens to KE? If beta increases, what happens to KE? If a beta increases, KE increases. Yes or no? RF plus RM minus RF into beta. Okay? Nothing but if a beta increases, KE increases. If a KE increases, value decreases. Nothing but if risk increases, required return increases, and if required return increases, value decreases. So that is a simple common sense point. Common sense point. Wealth depends on two factors. You are taking risk, you are doing CMA, so your required return increases, value of a CMA decreases. But sir, CMA has a more value than a BBA, then your logic is different. I am telling value depends on two factors. What are the two factors? Benefit and risk. Due to increase in risk, the value of a CMA has to decrease. Yes or no? But there is a benefit also. When compared to degree, CMA, cost accountant, is getting a greater benefit. So that's why the value of a CMA is greater than what value of a BBA. Are getting my point? So value depends on what? To benefit and risk. Benefit and what? Risk. If a benefit increases, risk increases. If risk increases, నేను లాజికే చెప్పలేదు అసలు. బెనిఫిట్కి రిస్క్కి సంబంధం ఏముంది అసలు? ఇఫ్ అ బెనిఫిట్ ఇంక్రీజెస్, వెల్త్ ఇంక్రీజెస్. ఇఫ్ అ బెనిఫిట్ ఇంక్రీజెస్, వెల్త్ ఇంక్రీజెస్. దిస్ ఈజ్ వన్ పార్ట్. సెకండ్ పార్ట్ ఈజ్ if risk increases, required return increases, and if required return increases, value decreases. Value decreases. Wealth decrease అవుతుంది. Value decreases. క్లియరా? అర్థమవుతుందా? ఆ ఫండమెంటల్ లాజిక్ మర్చిపోకండి. ఇఫ్ రిస్క్ ఇంక్రీజెస్, required return increases. Required return means expectation. If expectation increases, value decreases. Value ఏంటమ్మా? Decreases. మీకు అర్థమవుతుందా? ఓకే. So see the illustration number 1, time value of our money. Time value of money, illustration 1. Suppose someone promises to give you rupees 1000 3 years hence. What is the present value of this amount if the interest rate is 10%? So asking the present value. So what is the calculation? Simple calculation. 1 divided by 1.1 equal to 3 times. 1 divided by 1.1 is equal to 3 times into what? 1000. Into 1000. Clear? ఏం చేయండి సార్, నేను చేయలేదు. వెళ్ళమను. సరే. ఇల్లిస్ట్రేషన్ నెంబర్ 2. Find the present value of rupees 1000 receivable after 6 years hence if the rate of discount is 10%. Receivable after 6 years అంటే ఏం చేద్దాం? 1 divided by 1.1 is equal to how many times? 6 times into 1000. So the answer is 564.5. 564 ఏనా? 564.5. Find the present value of rupees 1000 receivable 20 years hence if the discount rate is 8%. After 20 years. After 20 years means 1 divided by 1.08. 1 divided by 1.08 is equal to 20 times into 1000. 1 divided by 1.08. 1 divided by 1.08 is equal to 20 times. 214. Next illustration number 4. If a person invests rupees 1,50,000 in an investment which pays 12% rate of interest, what will be the future value? What is the shortcut? In calculator, first take interest rate 0.12, 0.12 plus 1 into 1 press equal to how many times? 10 times. 0.12 plus 1 into 1 press equal to 10 times into what? 1,50,000. So the answer is 4,65,900. Illustration 5. An individual deposited rupees 1 lakhs in a bank at the rate of 12% compound interest per annum. How much he would receive after 20 years? How much he would receive after 20 years? So calculator, again simple. First we should take 0.12 plus 1 into 1 press equal to how many times? 20 times. Into 1 lakh. Into 1 lakh. 9,64,600. Illustration 6. Find the future value and compound interest of an amount rupees 75,000, 8% compounded semi-annually for 5 years. Compounded semi-annually. Compounded semi-annually means take half year interest rate. Half year interest rate 4%. 0.04 plus 1 into 1 press equal to how many times? 5 or 10? 10. Compounded semi-annually press equal to 10 times. 0.04 plus 1 into 1 press equal to 10 times into what? 75,000. 1 lakh 11,018. Clear? Next, illustration number 7. How long it will take for rupees 20,000 to double at a compound rate of 8% per annum approximately? So this is simple. We can ignore 20,000 also. 20,000 is not relevant. In calculator take 0.08. In calculator take 0.08 plus 1 multiply with 1 time. Okay, you're getting 1.08. They are asking in how many years it will get doubled. You have to count equal to's. Already one time you have pressed equal to, right? You should count equal to's until you get 2. In calculator you should get 2. Until you get 2, count equal to's. So how many? 9. Nothing but in 9 years the amount will get doubled. 1 rupee is becoming 2 rupees in how many years? 9 years. So simple. Okay. Next 8. Apex Limited has an obligation to redeem rupees 50 crore bonds 6 years hence. After 6 years, 50 crores bonds has to be redeemed. How much should the company deposit annually in a sinking fund account wherein it earns 12% interest to accumulate rupees 50 crores in 6 years time? Are you able to understand this question? Sinking fund question. After 6 years, I have to repay bonds. What is the amount required? 50 crores. The question is, what is the amount to be deposited every year? What is the amount to be deposited every year? Every year, nth amount deposit cheyali. So, what is given in the question actually? What is given and what they are asking? So, 50 crore is the future value of annuity. 50 crores is the future value of annuity. 6 years. After 6 years, I want 50 CR. So what is the amount to be deposited every year? They are asking you to find out an annuity. They are asking you to find out an annuity. So future value of annuity is equal to annuity into future value annuity factor, not present value annuity factor, future value annuity factor. So that means annuity is equal to future value of annuity divided by future value annuity factor. What is the future value of annuity? 50 CR. 50 CR divided by future value annuity factor. How do I get future value annuity factor? If a question is silent, we should assume that annuity as a annuity regular. Annuity regular. Annuity regular means okay. So take I. In calculator take I. What is I? 12%. 0.12 plus 1 into 1. 0.12 plus 1 into 1 press equal to how many times? 5 times only, because it is annuity regular. It is annuity regular, so that's why press equal to how many times? 5 times. Grand total add 1. 8.1. Are you getting my point? Why equal to n minus 1 times? Because for last year annuity we are not going to get any interest. For last year annuity we are not going to get interest, so that's why okay, I plus 1 into 1 press equal to how many times? 5 times. Grand total plus 1. So what is the answer? 61 lakh 61,354. Clear? Okay. 61 lakh 61,354. Be careful, if a question is silent, assume this as what? Annuity regular or immediate? Regular. If it is annuity immediate, then what? I plus 1 into 1 press equal to 6 times. 6 times grand total. But this is annuity regular. So that's why press equal to how many times? 5 times grand total and then add 1. Ninth one. The ABC Limited Company expects to receive rupees 1 lakh for a period of 10 years from a new project it has just undertaken. ABC Limited Company expects to receive rupees 1 lakh for a period of 10 years from a new project it has just undertaken. Assuming a 10% rate of interest, how much would be the present value of a annuity? They are asking you to find out the present value of a annuity. Company is expected to receive what? 1 lakh for a period of 10 years from a new project it has just undertaken. Just now we have started a project. From that project we are going to get 1 lakh every year for how many years? 10 years. So we have to find out present value of a annuity. Capital bursting, we are finding out value of asset. That is, asset is giving a benefit of 1 lakh for 10 years. Simple. So present value means compounding or discounting? Discounting. That means 1 divided by 1.1. 1 divided by 1.1 press equal to 10 times. 1 divided by 1.1 press equal to 10 times. Grand total. Then multiply with 1 lakh. 6,14,476. Okay. Next, 10th one. Mr. X is depositing rupees 20,000 in a recurring bank deposit. Recurring means repeated. Recurring bank deposit which pays 9% per annum compound interest. How much amount Mr. A will get at the end of the 5th year? Recurring means what? RD, recurring deposit means every year he is making a deposit of 20,000. Pays 9% per annum. How much amount he will be having at the end of a 5th year? So what is given in the question? Annuity is given. What is annuity? 20,000. They are asking you to find out the future value of a annuity. future value of a annuity. In calculator, take 0.09 plus 1 into 1, press equal to how many times? 4 grand total plus 1, then multiply with 20,000. 1 lakh 19,694. Clear? If a question is silent, that is annuity regular. Regular means at the end. Am I clear? 11th, a person is required to pay annual payments of rupees 8,000 in his deposit account. Required to pay annual payment of 8,000 in his deposit account. Annual payments, that means every year he is paying 8,000 into deposit account. Find out the future value of annuity. Same question again. Numbers change ante. In calculator, take 0.1 because rate of interest is 10%. 0.1 plus 1 into 1, press equal to 4 times grand total, multiply with 8,000, sorry, take 0.1 plus 1 into 1, press equal to 4 times grand total plus 1 into 8,000, 48,841. Clear? Next, 12th. An investor expect a perpetual sum. Perpetual means indefinite. Perpetual sum of rupees 5,000 annually from his investment. Every year he is going to get 5,000. What is the present value of a perpetuity if interest rate is 10%? Simple. Perpetual 5,000 divided by 10%. Similar to fourth example. Okay. So 50,000 is the answer. 13. A bank offers 12% compound interest payable quarterly. If you deposit now 2,000, how much it will grow at the end of 5 years? Simple question. Compounded quarterly. Compounded quarterly means if we should take a quarter interest rate. So what is the interest rate for quarter? 0.03. 0.03 plus 1 into 1. Press equal to how many times? 5. 5 into 4, 20 times. 5 into 4, 20 times. Because for 1 year there are 4 quarters. 1.8061 into what? 2000. 3612. So okay, but here in this question future value factor is given. You can directly multiply. Okay, clear? Done. So 14th, if the nominal rate of interest is 10% per annum and the frequency of compounding is 4, that is quarterly compounding, the effective rate of interest will be effective rate of interest is nothing but what? Conversion of a simple interest into compound conversion of compound interest into simple interest. For example, if you are paying 10% per annum compounded quarterly, that means you are paying effectively higher rate of interest, not 10%. You are paying more than 10% because quarterly compounding. So this is simple. We have to find out effective rate of interest. So 10% is the rate of interest compounded quarterly. Take the quarterly interest rate 0.025. 0.025 plus 1 into 1, press equal to 4 times because for 1 year there are 4 quarters, right? 0.025 plus 1 into 1, press equal to 4 times. So what you are getting in your calculator? 1.0 1.1038. What is this meaning? If you are depositing 1 rupee or if you are taking a loan of 1 rupee, after 1 year you have to pay 1.1038. You have to pay 1.1038. Nothing but extra 0.1038 is interest, right? So minus 1, 1 is principal, right? Remaining is the interest. Multiply with 100. 10.38% is the effective rate of interest. 10.38% is the effective rate of interest. You are not paying 10%. You are paying more than 10. That is 10.38. Clear? If it is compounded half yearly, then how to do it? If it is compounded quarterly, 0.05 plus 1 into 1 plus equal to 4 times or 2 times? 2 times. For a year there will be 2 half years. 0.05 plus 1 into 1 plus equal to 2 times. Minus 1 into 100. 10.25. If it is compounded half yearly, effective rate of interest is 10.25. Compounded quarterly means 10.38. If it is compounded monthly, effective rate of interest will increase. Simple common sense. Okay. Next, 15th. Okay. If annual effective rate of interest is 10.25% per annum, effective rate of interest is given, and the nominal rate of return is 10% per annum, what is the frequency of a compounding? What is the frequency of a compounding? So frequency of compounding is quarterly annadu, not quarterly, that is half yearly. Ippide chesam manam. Just now we have done it. So it is compounded half yearly. We can check. So take 0.05 plus 1 into 1 plus equal to 2 times minus 1 into 100. 10.25. That means frequency of a compound is not quarterly, frequency of compound is half yearly. 16th question. A student takes a loan of rupees 50,000 from SBI. The rate of interest being charged by SBI is 10% per annum. What would be the amount of equated annual installment if he wishes to pay it back in 5 installments, and first installment he will pay at the end of the year 5. So are you able to understand the question? So what is the present value annuity factor? What is the rate of interest? First of all, try to understand the question. Loan is taken as on today and installments are paid in the future. The loan amount is present value of a future installments. Loan amount is present value of a future installments. Okay, in previous class we have discussed that loan amount. Loan amount is nothing but present value of a annuity. Installment is what? Annuity. If you have to find out annuity, that is installment, how can we get it? Loan amount divided by present value annuity factor. Loan amount divided by present value annuity factor. So present value annuity factor, how can we get it? 1 divided by 1.1, 1 divided by 1.1 plus equal to how many times? Plus equal to 5 times. If it is annuity regular, 1 divided by 1.1 plus equal to 5 times, grand total 3.7907. So the installment is equal to 50,000 divided by 3.7908. 13,190. Okay. So 13,190. Clear? So if they ask you to find out the loan installment, how can we get it? Loan amount divided by present value annuity factor. Next 17. How much amount should an investor invest now in order to receive 5 annuities starting from the end of this year of rupees 10,000 if the rate of interest offered by bank is 10% per annum? How much amount he should invest now? Now, present value. Now, in order to receive 5 annuities starting from the end of this year of rupees 10,000. How much annuity you want to receive? 10,000 every year. For how many years? 5 years. Rate of interest 10% per annum. Simple. So if you want to pay, take a loan from bank. If you want to receive, deposit amount in a bank. So the question is what? They are asking how much amount to be deposited as on today. Okay, annuity is given. The question is they are asking present value of a annuity. They are asking present value of a annuity. Simple, 10,000 into 3.7908. 37,910. Present value of annuity is equal to annuity into PVAF. So we can find out that 3.7908. How can we get it? 1 divided by 1.1 press equal to 5 times grand total. Clear? 18. A company wants to repay a loan of rupees 50,000. So 5 lakhs. 10 years from today. 10 years from today. What amount should it invest each year for 10 years? If the fund can earn 8% per annum, the first investment will be made at the beginning of this year. First investment will be made at the beginning of this year. Understand the question. Company has taken a loan. Company has taken a loan. So 5 lakhs. Previously we have done one question. Bond redemption 50 CR. Similar question. So we have to repay the loan. What is the loan amount to be repaid? 5 lakhs. After 10 years. So the question is what amount to be invested each year for 10 years. What amount to be invested each year for 10 years means they are asking you to find out annuity. They are asking you to find out annuity. Rate of interest is 8% per annum. So future value of annuity is given. Future value of annuity is given. That 5 lakhs is nothing but what? We have to pay after 10 years. That is future value of annuity. I have to find out annuity. Present value kada. I have to find out annuity. Nenu annuity find out cheyali. Question li ichindi enti? 5 lakhs is the loan to be repaid after 10 years. After 10 years I have to pay 5 lakhs. What is the amount to be deposited every year? So the question is future value of annuity is given and they are asking you to find out what? Annuity. So how can we find out? Simple. Future value of annuity 5 lakhs divided by future value annuity factor. So already given in the question 14.487. So 5 lakhs divided by 14.487. So the answer is 34,000. Okay. So how we are going to find out the future value annuity factor? In calculator take 0.08. Take 0.08 plus 1 into 1. Press equal to how many times? 9 or 10? 10 times. Because the first investment will be made at the beginning of the year. Beginning of the year means annuity. Regular or immediate? Annuity immediate. Future value of annuity immediate means press equal to how many times? N times. మీకు అర్థమవుతుందా? ఇదేంటమ్మా బిగినింగ్లో ద ఫస్ట్ ఇన్వెస్ట్మెంట్ విల్ బి మేడ్ అట్ ద బిగినింగ్ ఆఫ్ ద ఇయర్. ఫస్ట్ ఇన్వెస్ట్మెంట్ విల్ బి మేడ్ అట్ ద బిగినింగ్ ఆఫ్ ద ఇయర్. బిగినింగ్ ఆఫ్ ద ఇయర్లో చేస్తే ఇమీడియట్ అంటాం. అంటే ఫస్ట్ ఇయర్ బిగినింగ్లో ఈరోజు ఇన్వెస్ట్మెంట్ చేస్తే హౌ మెనీ ఇయర్స్ యూ ఆర్ గోయింగ్ టు గెట్ ఇంట్రెస్ట్? 10 ఇయర్స్. అదే యాన్యుటీ రెగ్యులర్ అనుకోండి, అట్ ద ఎండ్ ఆఫ్ ద పీరియడ్ అయితే, అట్ ద ఎండ్ ఆఫ్ ఫస్ట్ ఇయర్ అయితే యూ విల్ బి గెటింగ్ ఇంట్రెస్ట్ ఫర్ 9 ఇయర్స్ ఓన్లీ. సో దట్స్ వై యూస్ టు ప్రెస్ ఈక్వల్ టు 9 times. కానీ ఇక్కడ యాన్యుటీ ఇమీడియట్ కాబట్టి హౌ టు ప్రెస్ ఈక్వల్ టు హౌ మెనీ టైమ్స్? 10 times. నథింగ్ బట్ 0.08 plus 1 into 1 press equal to how many times? 10 times. Later on GT, grand total 0.08 plus 1 into 1, 0.08 plus 1 into 1 press equal to how many times? 10 times, grand total. సో 15 పాయింట్ వచ్చిందా? అయితే ఇక్కడ తప్పు ఉంది. 14 పాయింటేనా? 0.08 plus 1 into 1 press equal to how many times? 10 times, grand total 15.645 is the right one actually. But since the future value annuity factor is given in the question, you should take that only. అదే తీసుకోండి. నథింగ్ బట్ అక్కడ ఏంటి, దే హ్యావ్ కన్సిడర్డ్ దిస్ యాన్యుటీ యాజ్ యాన్యుటీ రెగ్యులర్. 14.487. If you are taking 14.487, what does it mean? You are making investment at the end. మీకు అర్థమవుతుంది? అక్కడ ఫ్యూచర్ వాల్యూ అనేది ఫ్యాక్టర్ 14.487 కాదు, మనకి 15 పాయింట్ సంథింగ్ ఇచ్చి ఉండాలి, కానీ ఇవ్వలేదు. కాబట్టి ఎగ్జామ్లో ఏం చేస్తారు మీరు? ఇచ్చిందే తీసుకోవడమే. అర్థమైందా? ఎగ్జామ్లు ఇచ్చింది తీసుకుంటాం, బట్ దట్ ఈస్ నాట్ కరెక్ట్. మీకు అర్థమైందా? ప్రెస్ ఈక్వల్ టు ఎన్నిసార్లు చేయాలి? ప్రెస్ ఈక్వల్ టు 10 times, గ్రాండ్ టోటల్, బికాస్ ఇట్ ఈస్ యాన్యుటీ ఇమ్మీడియట్. అర్థమైందని చెప్పింది. బిగినింగ్ అంటే ఎప్పుడు? ఈరోజు నువ్వు డిపాజిట్ చేస్తే ఆఫ్టర్ 10 years కదా లోన్ రీపే చేసేది. హౌ మెనీ ఇయర్స్ యూ ఆర్ గోయింగ్ టు గెట్ ఇంట్రెస్ట్? 10 years. దట్ మీన్స్ ప్రెస్ ఈక్వల్ టు హౌ మెనీ టైమ్స్? 10 times. If I am depositing at the end of the first year, at the end of second year, at the end of first year, if I am depositing my first annuity, I am going to get interest for how many years? 9 years. And for the last year annuity, the annuity which is deposited at the end of 10th year, I am not going to get any interest. So that's why if it is annuity regular, press equal to n minus 1 times. If it is annuity immediate, press equal to n times. That too if it is the future value. Present value exactly reverse. Okay. 19th. Mr. P deposited rupees 1 lakh on January 2015 in a fixed deposit scheme with a nationalized bank for 5 years. How much he deposited? 1 lakh. The maturity value of a fixed deposit is rupees 2 lakhs. Compute the rate of interest compounded annually. So this concept in capital bursting we call it as a IRR, internal rate of a return. P deposited 1 lakh, he received after 5 years 2 lakhs. They are asking you to find out the rate of interest. So let us do a trial and error. Let us assume the rate of interest as 10%. In calculator take 0.1. Plus 1 into 1 press equal to 5 times. Into 1 lakh. You're getting 1,61,000. So 10% is not the right answer because you should get 2 lakhs. That means we should increase the rate or decrease? Increase. Okay, so take 15. So that means in calculator take 0.15 plus 1 into 1 plus equal to 5 times into 1 lakh. 2 lakh 1000. That means approximately the answer is 15%. 15% is the answer. Okay. So while in capital bursting we do it in the other way. So okay. So in capital bursting I will discuss. Right now trial and error. Pilchara. 20. A company has issued rupees 50 lakhs to be repaid after 7 years. Similar question already done. Company has issued debentures rupees 50 lakhs to be repaid after 7 years. How much should the company invest in a sinking fund? Earning 12% in order to be able to repay debentures. How much should the company invest in a sinking fund? Sinking fund ante idea on the sinking fund. For example, after 7 years we have to repay 50 lakhs, right? So 50 lakhs ఒక్కసారిగా తీసుకొని రావాలంటే కష్టం అవుతుంది కదా. We cannot bring 50 lakhs at once. So that's why what we do is we invest every year a part of a amount so that that amount will accumulate to 50 lakhs. We withdraw the deposit and we repay the debentures. So sinking fund can be created for redemption of debentures or purchase of a plant and machinery assets. If you want to buy an asset purchase cheyali. Asset purchase cheyalana, you cannot bring a lump sum amount at once. So that's why there is a concept of sinking fund. We are going to deposit a part of amount every year. So in this question also they are asking you to find out what how much should the company invest in sinking fund. How much amount sinking fund? How much amount to be invested in sinking fund? What is this 50 lakhs actually? Future value of a annuity. 50 lakhs is the future value of a annuity because this is to be paid after 7 years. This is to be paid after 7 years. So future value of annuity is equal to annuity into future value annuity factor. Annuity is equal to future value of annuity divided by future value annuity factor. Future value of annuity is 50 lakhs divided by what should I find out? Future value annuity factor already given in the question 10.0890. So the answer is 495,589. So how to find out future value annuity factor? In calculator take 0.12 plus 1 into 1 plus equal to 6 times only. If a question is silent, assume it as a annuity regular. 0.12 plus 1 into 1 plus equal to 6 times grand total. Add 1. 10.0890. So that is already given in the question. Clear? XYZ Limited has borrowed 5 lakhs to be repaid in 5 equal annual installments, interest and principal both. The rate of interest is 16%. Compute amount of each payment. Again they are asking installment. They are asking installment. We have taken a loan 5 lakhs and it is to be repaid in 5 equal annual installments. అర్థమవుతుందా క్వశ్చన్? లోన్ తీసుకున్నాం, ఆ లోన్ ఎలా రీపే చేస్తున్నాం మనం? 5 ఈక్వల్ యాన్యువల్ ఇన్స్టాల్మెంట్స్లో. ఈసారి ఏమి ఇచ్చాడు? వాట్ ఈస్ గివెన్ ఇన్ ద క్వశ్చన్? present value of a annuity is given 5 lakhs. లోన్ ఇప్పుడు తీసుకుంటున్నాం, లోన్ ఇప్పుడు తీసుకొని ఇన్స్టాల్మెంట్స్ పే చేస్తున్నాం. సో ప్రెసెంట్ వాల్యూ ఆఫ్ యాన్యుటీ ఈజ్ ఈక్వల్ టు annuity into present value annuity factor. Annuity is equal to, that is equal to 5 lakhs divided by, what is the factor? 3.2743. So the answer is, how can we get PVA, present value annuity factor? 1 divided by 1.16 press equal to 5 times. 1 divided by 1.16 press equal to 5 times. Grand total 3.2743. Clear? Questions అర్థం అవుతున్నాయా? You might get confused between present value of annuity and future value of annuity. Be careful. If you are taking a loan as on today, that loan is present value of a annuity. Okay, this is one category. If you see the 20th question, what is the 20th question? The company has issued debentures of rupees 50 lakhs to be repaid after 7 years. After 7 years means future value. I have to pay 50 lakhs after 7 years. Future value of a annuity. At once I cannot get 50 lakhs. So that's why the question is, what is the amount to be deposited every year so that comfortably you will be able to pay 50 lakhs loan. Nothing but future value of annuity is given and they are asking you to find out the annuity. Clear? Sanjay, ఒకసారి చూడండి. See the next concept, leverages. See the next concept, leverages chapter. Leverage chapter. So yesterday we have seen the income statement, right? What is the income statement? Okay. So earnings per share is equal to earnings available to equity shareholders divided by number of shares. Okay, income statement. Okay, so clear? Karthik. Leverages. So first, leverage chapter simple. So this chapter is simple chapter. Leverages. So in capital structure, leverage means debt. Leverage means debt. In capital structure, leverage means debt. Okay. And leverage can also be defined as relation between two interrelated variables. Relation between two interrelated variables. Relation between two interrelated variables. Okay. So first, risk. Already we told risk. Risk means what? Possibility of occurrence of loss. Yes or no? Possibility of occurrence of a loss. So objective of a financial management is to minimize the risk, maximize wealth, maximize wealth. So to maximize wealth, the risk has to be minimized or maximized? Minimized. Yes or no? Because if risk decreases, required return decreases. If required return decreases, value increases. So the primary objective of financial management is wealth maximization. So in order to maximize the wealth, we should minimize the risk. Risk means what? Possibility of occurrence of loss. So primarily we can categorize the risk into two types: business risk and finance risk. Business risk, finance risk. Business risk and finance risk. So business risk can also be called as operating risk. Business risk can also be called as operating risk. So business risk. Business risk is uncertainty. Risk means a possibility of occurrence of loss. Possibility. It doesn't mean compulsorily we are going to get a loss. There is a possibility. High risk means high possibility. High risk means high possibility. Okay. So business risk means uncertainty about future operating income. Uncertainty about future operating income, that is EBIT. So operating income is nothing but what? EBIT. EBIT can also be called as operating income. Operating income. Okay. So finance risk is risk arising due to usage of the debt funds. Risk arising due to the usage of a debt funds. Risk arising due to the usage of a debt funds. Okay. Nothing but this is arising due to fixed financial charges. Fixed financial charges. Financial charges mean charges paid on procurement of finance. Charges paid on procurement of a finance fund. Fund is procured from equity, debt. On equity we pay equity dividend, which is not fixed. That is variable. That is variable. But whereas on debenture we have to pay interest. Interest is a fixed financial charge. Preference dividend is also interest and what? Preference dividend. These two are fixed financial charges. Fixed financial charges. And the name itself indicates financial. So the charges paid on procurement of a finance fund. Fund can be procured from preference share capital, equity share capital, or debt. On equity you pay equity dividend, which is not fixed. On preference share capital you pay preference dividend, which is fixed. On debenture you pay interest, which is fixed. So fixed financial charges means interest and preference dividend. So finance risk means risk arising due to fixed financial charges. Possibility of occurrence of a loss due to interest and preference dividend. Okay. Next, write operating risk. Generally, business risk itself is an operating risk, but write it separate also. Operating risk. Operating risk arising due to use of fixed cost. Fixed cost means like rent, salaries, etc. Yogita. So arising due to what? Use of a fixed cost. ధ్యానం అప్పుడప్పుడు చేస్తే రాదు, వరం. అర్థమైందా? చెప్పా, కంటిన్యూస్గా 10-20 సంవత్సరాలు చెయ్యి. సో ఆపరేటింగ్ రిస్క్ అరైజింగ్ డ్యూ టు వాట్? యూజ్ ఆఫ్ అ ఫిక్స్డ్ కాస్ట్. So arising due to the usage of a fixed cost, rent. Example what? Rent. So let me take example. Risk means what? Possibility of occurrence of loss. So income statement, sales minus variable cost contribution. Yes or no? Okay. So income statement. First, suppose let us assume ఓకే ఏంటమ్మా ఆ పేరేంటి? యశ్వంత్, సీను. సీను, he started a supermarket. Okay, supermarket, and around 4 floors. Okay, what is your name? Sirisha went to that supermarket. Okay, went to that supermarket, and so Sirisha, she got stalked. I mean, after seeing Seenu there in supermarket. Seenu ఏంటి ఇక్కడ సూపర్వైజర్ అంది. Seenu told, no, I'm not a supervisor, I'm a owner. I'm the promoter of this supermarket. Okay, so Sirisha, she got shocked. Okay, because 4 floors supermarket, and so high-end furnishing, everything is there. Okay, so she got shocked. So first question she asked is, Seenu, is this own building? Seenu, can you please let me know whether it is a own building or a rented? So Seenu told, yes, this is my own building. Obviously, what is, I mean, Sirisha, I mean, what Sirisha will say? Yes or no? What is the intention behind that? What is the intention actually? Intention is here the intention is, see, no, you don't have any risk. You don't have any operating risk. You do not have any operating risk. So whether customers comes or not, whether there are sales or not. For example, sales 0, variable cost obviously 0, contribution 0, fixed cost 0, own building, fixed cost 0. Okay, and she asked, who, I mean, staff and all, my wife and children, no fixed cost. That means simple. What is the intention behind that? I mean, what is the intention? Intention is there is no operating risk. There is no uncertainty about, I mean, there is no possibility of negative EBIT. There is no possibility of negative EBIT. Yes or no? Because own building, staff also own. So the intention behind Sirisha calling like that is, the reason is what? No operating risk. No operating risk. So next is Sirisha. Sino, one more question. What is the investment? What is the investment in the entire, I mean, this business? He told 20 crores. Sino, apde kaadu. Again, Sirisha, next question. So tell me what is the next question of Sirisha? I mean, what is next question? Uh, Sino, is this 10? Sino, is this 20 crores own or a loan? Own or a loan? Sino answer. It's my own. It's my own. So we call again. I mean, so what is the intention? What is the intention behind that? I mean, own fund. Own fund. Again we say A and all. Okay. So why? అంతే కదా సీను నీకేంట్లు అంటావునా సో దాని రీజన్ ఏంటమ్మా నో ఇంట్రెస్ట్ దట్ మీన్స్ ఈబిఐటీ జీరో ఇంట్రెస్ట్ జీరో ట్యాక్స్ జీరో there is no possibility of a negative earnings per share. There is no possibility of negative earnings per share. Yes or no? Okay. Clear? Clear? For example, so Bharat, he started non-veg pickles. Yes. Non-veg pickles business. Okay. Okay. Bharat Chitti pickles. So pickles business. Okay. He started pickles business and in city he has started a pickles business. So hi-fi furniture and all, hi-fi furniture for display and all, hi-fi furniture, everything is there. Okay. So Bharat, okay. Ushasri, she went to that pickles store. Her first question is, okay, Bharat ఆటో ఏమైంది so okay, so Bharat answer, I sold auto and I started this pickles business. Okay. So next question, is this building your own? Own. Okay. So Bharat told no, it is rented. Now Usha said, oh, ayyo. Yes or no? So ayyo, that means okay, she's showing sympathy. Why? Okay. So if youth cannot, I mean, if youth they are not focusing on career, if I mean they cannot afford what non-veg pickles, yes or no? And if nobody comes to store and if nobody is buying pickles, then what happens to the business? Loss. Here the point is, there is a possibility of occurrence of loss. There is a possibility of occurrence of loss. Visualize the income statement. Sales 0, variable cost 0, contribution 0, but fixed cost will be there. Fixed cost, let us assume 10 lakhs. That means EBIT negative 10 lakhs. EBIT negative 10 lakhs. Okay. The next question, Ushashri. So you have invested a lot of money, right, in this, okay, furniture and all. So whether it is own or a loan, he told loan. Again you say, ఏంటి బ్రో అంటది అవునా ఏంటి బ్రో I mean that means she is again showing a sympathy because the reason is if customers are not coming to the store, okay, sales 0, contribution, sorry, variable cost 0, contribution 0, okay, fixed cost will be there. Okay, fixed cost, let us assume 10 lakhs, EBIT negative 10 lakhs, interest has to be paid, let us assume interest at 10 lakhs, then earnings before tax 20 lakhs negative, the possibility of occurrence of loss will increase. Okay. This rented building means there is a operating risk. If a fixed cost increases, operating risk increases. Okay. If interest increases, then finance risk increases. Finance risk increases. For unlevered firm, finance risk is equal to 0. For unlevered firm, finance risk is equal to 0 because there is no finance risk. 100% equity. If it is 100% equity, then what? There is no finance risk. Okay, clear? If it is own building, there will be less operating risk because somebody staff will be there. Okay, we have to incur some amount of fixed cost. We cannot completely avoid operating risk. Okay, completely avoid operating risk. Okay, so 100% equity company will have a no finance risk. Clear? So in this question, simple, in this chapter, we are going to measure operating risk, finance risk and total risk. Prakash Raj, ladies version. Lady version amma Prakash Raj. Pokri. So clear, in this chapter, the object of learning this chapter is to how to measure operating risk, finance risk and total risk. Operating risk is measured using operating leverage. Finance risk is measured using finance leverage, and total risk is measured using combined leverage. Combined leverage. Okay. So clear. Combined leverage. Clear. So leverage refers to relation between two interrelated variables. And business risk means what? Uncertainty about future EBIT. For example, right now our company is having a EBIT, but in future we may or may not get the EBIT. That uncertainty is called as a business risk. For example, in farming there is a high uncertainty. In cinema field there is a high uncertainty. If PVR Inox theaters, there is a high uncertainty because there is a alternative OTT. Yes or no? So theaters will get affected by OTT. So theaters business will have a high risk. Real estate will have a low risk comparatively. Low uncertainty. Okay. So business risk is risk inherent with that particular business. Inherent with that particular business. Uncertainty about the future operating income. అంటే ఇప్పుడు వచ్చిన ఈబీఐటీనే ఫ్యూచర్లో వస్తుందో రాదో తెలియదు. ఆ వస్తుందో రాదో అంటాం కదా, అన్సర్టనిటీ. దట్ అన్సర్టనిటీ ఈస్ కాల్డ్ యాజ్ అ బిజినెస్ రిస్క్. బిజినెస్ రిస్క్. క్లియర్? సో లివరేజ్ రిఫర్స్ టు వాట్? రిలేషన్ బిట్వీన్ two or more interrelated variables. So write down leverage refers to relation between two or more interrelated variables. Refers to relation between two or more interrelated variables. Refers to relation between two or more interrelated variables. Okay. So for example, operating leverage. It denotes the relationship between sales and EBIT. Sales and what? EBIT. So generally EBIT depends on what? Sales. EBIT is called as a dependent variable. Sales is called as an independent variable. So that is not relevant actually here. So operating leverage denotes relationship between what? Sales and EBIT. Financial leverage denotes the relationship between EBIT and EBT / EAT / earnings per share. financial leverage denotes the relationship between EBIT and EBT or EAT or EPS. Combined leverage. Combined leverage. Combined leverage denotes the relationship between sales and EBT slash EAT slash earnings per share. Earnings per share. So let me take one example so that you will understand this concept. Operating leverage formula. Operating leverage is equal to contribution divided by EBIT. Simple, this formula you can retain it easily. Operating leverage, it measures operating risk. Operating risk arises due to fixed cost, and fixed cost is the difference between the numerator and denominator. The reason is also fixed cost, and that reason is the difference between numerator and denominator. Or percentage change in EBIT divided by percentage change in sales. So this is also simple. In the above, operating leverage denotes the relationship between what? Sales and EBIT. So always independent variable comes in the denominator, dependent variable comes in the numerator. Here the dependent variable is EBIT, percentage change in EBIT divided by percentage change in sales. This is the formula for operating leverage. Okay. For example, operating leverage you are getting 1. Operating leverage you are getting 1. What does it mean? If a sales increases by 1, EBIT increases by 1. Nothing but if sales increases by 100%, EBIT increases by 100%. For suppose if operating leverage is 2, that means if a sales increases by 100%, then EBIT increases by 200%. Operating leverage is a ratio, not a percentage, ratio, 2 times. 2 times means what? EBIT changes 2 times of a sales. 2 times of a sales, nothing but if sales changes by 100%, EBIT changes by 200%. If operating leverage is 3, what does it mean? Okay, if a sales increases by 100%, EBIT increases by, let us take an example. I'm taking example. So these are actually problems only. Okay, after listening to these examples, you can solve all the questions. Example. Particulars. Particulars. Case 1, case 2, case 3. I'm taking 3 cases. Okay. So sales, let us assume sales is equal to 10 lakhs. Sales is equal to what? 10 lakhs. Okay. So case 1, fixed cost is equal to 0. Case 1, fixed cost is equal to 0. Am I clear? So sales 10 lakhs minus variable cost 5 lakhs. Let us take variable cost what? 5 lakhs. Tell me the contribution. 5 lakhs. So let us assume the fixed cost is equal to 0. Then what is the EBIT? 5 lakhs is the EBIT. Clear? So okay, let us calculate operating leverage. What is the operating leverage? Contribution divided by EBIT. So when fixed cost is equal to 0, you will get operating leverage 1. Operating leverage 1. You will get operating leverage 1. Are you getting my point? What is the meaning of this 1? For every 1% change in sales, EBIT changes by 1%. Nothing but if sales increases by 100%, sales increases by 100%. Sales increases by 100% means nothing but 20 lakhs. 20 lakhs. Then variable cost 10 lakhs. Yes or no? If a sales gets doubled, then variable cost will also get doubled. Divided by contribution 10 lakhs. Fixed cost 0. EBIT. So now the operating leverage is not relevant actually. So if you observe the point, here there is an increase in sales by which percent? 100%. EBIT also has increased by 100%. Sales got doubled. EBIT has got doubled. Yes or no? So clear? First suppose if a sales getting reduced by 100%. Sales getting reduced by 100%. Sales getting reduced by 100% means nothing but what? 0. Yes or no? Getting reduced by 100% means sales what? 0. What about variable cost? 0. Contribution 0. Fixed cost 0. EBIT 0. So this is getting reduced by 100%. Is there any possibility of occurrence of loss? There is no possibility of occurrence of loss. There is no chance. There is no chance of a negative EBIT. Negative EBIT. Nothing but we can say there is no operating risk. There is no operating risk. When operating leverage is equal to 1, when operating leverage is equal to 1, we say there is no operating risk. No fixed cost, operating leverage 1, that indicates no operating risk. Am I clear? First suppose if fixed cost is equal to 1 lakh. So fixed cost is equal to 1 lakh. Let us take the original sales. What are the original sales? 10 lakhs. 5 lakhs variable cost. Contribution 5 lakhs. Fixed cost 4 lakhs is the EBIT. What is the operating leverage? Contribution divided by EBIT. So 1.25. What is the meaning of this 1.25? If a sales decreases by 100%, EBIT decreases by 125%. Yes or no? Are you getting my point? 1.25 times. If a sales decreases by 100%, then EBIT decreases by what? 125%. Nothing but EBIT will become negative. EBIT will become negative. If a sales increases by 100%, EBIT increases by 125%. Clear? Okay. First, suppose if I take fixed cost 4 lakhs, then 10 lakhs, 5 lakhs, 5 lakhs, 4 lakhs, 1 lakh. What is the operating leverage? 5 lakhs divided by 1 lakh. 5. What is the meaning of this? If a sales decreases by 100%, EBIT decreases by 500%. 500 percentage. Or otherwise, if a sales decreases by 20%, if a sales just decreases by 20%, let us assume instead of 10 lakhs, we are able to sell only 8 lakhs. Sales decreased by 20%, 8 lakhs. Minus what? Variable cost, 4 lakhs. Proportionate. Contribution, 4 lakhs. Fixed cost, 4 lakhs. EBIT, 0. That means if a sales decreases by 20%, your EBIT decreasing by 100%. 20 into 5. 20 into 5. 5 times. So which is the high risky? There are 3 cases. Which is high risky? First, second or third? Third one is high risky. High fixed cost, high operating risk. High fixed cost, high operating risk. The possibility of occurrence of a loss increases. The possibility of occurrence of a loss increases. Clear? Am I clear? Advain. So what is the operating leverage formula? Contribution divided by EBIT. Percentage change in EPS divided by percentage change in sales. For example, here the percentage change in EBIT is 100%, percentage change in sales is 100%. You will get operating leverage 1. Clear? Done. Next, financial leverage. Financial leverage. So financial leverage is equal to EBIT divided by EBT. So financial leverage, what is the reason? Financial leverage measures finance risk arising due to debt funds, interest and preference dividend. If you see the formula, the difference between the numerator and denominator is interest. Yes or no? The finance risk is arising due to the interest and the difference is interest. Or percentage change in EPS divided by percentage change in EBIT. Percentage change in EPS divided by percentage change in EBIT. So clear? Next, combined leverage. Combined leverage is nothing but it measures total risk. It measures total risk. We cannot add the ratios always. We should multiply the ratios. Multiply ratios. So that's why operating leverage into financial leverage, that is contribution divided by EBT. Contribution divided by EBT, earnings before tax. Or percentage change in sales divided by percentage change in EPS divided by percentage change in EPS divided by percentage change in sales. Percentage change in EPS divided by percentage change in sales. Clear? Percentage change in EPS divided by percentage change in sales. So if a fixed cost is equal to 0, there is no operating risk. You will get operating leverage 1, 0 కాదు 1. Okay, am I clear? Vasant, let us assume interest is equal to what? Interest is equal to 0. Interest is equal to 0. So minus interest, earnings before tax. So let us assume interest is equal to 0. Then EBT is equal to 0. Here EBT is equal to 5 lakhs. Here 0 is equal to what? 10 lakhs. Okay. So that what is the financial leverage? Financial leverage is equal to EBIT divided by EBT. That is 5 lakhs divided by 5 lakhs. 1. What does it mean? There is no finance risk. Nothing but if EBIT changes by 100%, your earnings before tax or earnings per share changes by 100%. 100 percentage. Your EPS changes by what? 100%. Your EPS will also changes by 100%. So for example, minus tax at the rate of 50%, 0, 2 lakh 50, 5 lakhs. 0 is the earnings after tax, 2 lakh 50, 5 lakhs. Let us assume number of shares is equal to 10,000. Tell me the earnings per share. 0, because earnings available equity showed as 0 divided by 10,000, 0. Next 2,50,000 divided by 10,000, 25, 50. So this 25 is the base, right? If you see the EBIT, if EBIT decreases by 100%, it becomes 0. Then earnings per share is equal to 0. If EBIT gets doubled, then earnings per share will also get doubled. Nothing but both will change in the same ratio when there is no interest. When there is no interest. Okay. However, if there is an interest, let us assume interest is equal to 50,000. Interest is equal to what? 50,000. Then what? 3 lakh 50,000. Yes or no? Or otherwise take 2 lakhs. 2 lakhs interest. Then 2 lakhs is the earnings before tax. Tax is equal to 1 lakh. Earnings after tax 1 lakh. And your earnings per share is 10. 1 lakh divided by 10,000, 10. Your earnings per share is getting decreased. Okay. So now tell me the financial leverage. Financial leverage is equal to EBIT 4 lakhs divided by EBT 2 lakhs. 4 lakhs divided by 2 lakhs. 2. Financial leverage 2. What does it mean? If your EBIT changes by 100%, your earnings per share changes by 200%. Nothing but if EBIT decreases by 100%, EBIT ఒకవేళ 100% తగ్గితే earnings per share decreases by 200%. Decreases by 200% means EPS will become negative. EPS will become negative. Negative అయిపోద్ది EPS, earnings per share. So what does it mean? High interest indicates high finance risk. High interest indicates what? High finance risk. Clear? అర్థమవుతుందా? If interest is equal to 0, then you will get financial leverage 1. Financial leverage 1. Clear? Combined leverage means what? Contribution divided by EBT. 5 lakhs divided by 5 lakhs. 1. Or else financial leverage into operating leverage. 1 into 1. So for example, in this case, operating leverage is 5 lakhs divided by 4 lakhs, 1.25 is the operating leverage. And financial leverage is 4 lakhs divided by 2 lakhs, 2. So 1.25 into 2, 2.5. So what is the other way of calculation? Contribution divided by EBT. So what is the contribution? 5 lakhs divided by what? 2 lakhs, 2.5. So clear? So what I am saying is simple operating leverage, no fixed cost, no operating risk, no interest, no finance risk, no fixed cost and no interest, no total risk, no total risk. You will get operating leverage 1, financial leverage 1 and combined leverage 1. Okay. If a fixed cost increases, if a fixed cost increases, operating leverage increases. If interest increases, finance risk increases. If both fixed cost and interest increases, okay, combined leverage increases. Combined leverage increases. Clear? Sir, our formulas meeku gurtunna saripotadi. And there is one more category. When there is preference share capital, the formula will get complicated. When there is preference share capital, financial leverage is equal to, what is the financial leverage formula, general formula? EBIT divided by EBT. But when there is a preference share capital, the formula is EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. EBIT divided by EBT minus preference dividend, because preference dividend is also a fixed financial charge. If you see the notes, finance risk means risk arising due to the fixed financial charges, that is interest and preference dividend. 99% you will not get preference shares, you will not get preference share capital in question. But if there is a preference share capital also, then preference dividend is also a fixed financial charges. So that's why, so for the difference between the numerator and denominator must be interest, and in addition to interest there must be a difference of preference dividend also. Preference dividend. But we should take pre-tax preference dividend. Pre-tax preference dividend. Because preference dividend is reduced after payment of a tax. Yes or no? Income statement. Earnings after tax minus preference dividend. So that's why we should reduce pre-tax preference dividend. And combined leverage formula is equal to contribution divided by EBT minus preference dividend divided by 1 minus tax rate. So this is a special case. Be careful if preference share capital is given in the question, and if they ask you to find out the financial leverage, then the formula is different. We cannot apply the same formula, that is EBIT divided by EBT. If you are taking EBIT divided by EBT, that means you are considering only interest. But finance risk means risk arising due to fixed financial charges, that is both interest and preference dividend. So that's why the difference must be interest and preference dividend also. So that's why from the denominator we are reducing preference dividend, pre-tax, PD divided by 1 minus tax rate. Okay. These are the formulas. With these formulas, with this background, we can solve leverages question. Okay. Clear? And we have a link between margin of safety and leverage also. Margin of safety. Do you remember margin of safety? profit divided by PV ratio, or total sales minus break even sales. Break even sales. Clear? So break తీసుకొని స్టార్ట్ చేద్దాం. Clear? 15 minutes అమ్మా. See the next question. Illustration number 1, leverages. So operating leverage measures operating risk, right? Financial leverage measures finance risk. Combined leverage measures total risk. Vinay, what is the formula for operating leverage? Contribution divided by EBIT. Financial leverage formula EBIT divided by EBT, earnings before tax. Next, combined leverage formula contribution divided by EBT, operating leverage into financial leverage, operating leverage into financial leverage. So see the illustration number 1. From the following selected operating data, determine the degree of operating leverage. Which company has a greater amount of a business risk? Why? So business risk is also called as what? Operating risk. So simple, sales is given for A limited and B limited. Variable expenses as a percentage of sales are 50% for firm A and 25% for firm B. So we have to find out what degree of operating leverage. Degree of operating leverage. How do we get operating leverage? Contribution divided by EBIT. So how do we get contribution? Sales minus what? Variable cost. Contribution 12 lakh 50,000. 12 lakh 50 minus what? Fixed cost 7 lakh 50. So EBIT 5 lakhs. Okay. So degree of operating leverage is equal to 12 lakh 50,000 divided by 5 lakhs. 12 lakh 50,000 divided by 5 lakhs. Answer is 2.5. B limited 30 lakhs minus 25% variable cost 7 lakh 50,000. 22 lakh 50,000 is the contribution minus fixed cost 15 lakhs 7 lakh 50 EBIT. So 3 rupees is the 3 is the operating leverage ratio. So which company is having a high business risk? B limited is having a high business risk. High business risk. Clear? Done? Manoj? Clear? Next, illustration number 2. Calculate the operating leverage for each of the 4 firms A, B, C and D. From the following price and cost data, what conclusions can you draw with respect to the levels of a fixed cost and degree of operating leverage? Explain. Assume number of units sold is equal to 5,000. Again simple. For 4 firms we take sales. How do we get sales? Units sold is equal to 5,000. So 5,000 into 20, 1 lakh. 5,000 into 20, 1 lakh. One lakh. 1 lakh 60. 2 lakh 50, 3 lakh 50. Clear? So sales 5,000 into 20, next 5,000 into 32, next Amalapuram 5,000 into 50, 2 lakh 50, next 5,000 into 70, 3 lakh 50,000. So for these small calculations, stop using calculator. Okay. So this is a phi table, right? Phi table. For phi table, we should not use calculator. Okay. Clear? Sales minus what? Variable cost. 5,000 into 6, 5,000 into 16, 5,000 into 20, 5,000 into 50. Okay. Clear? Contribution. In question bank, contribution is not separately calculated, but you should write contribution. What is the contribution first case? 70,000. Emma, Sonia Gandhi. 70,000 contribution. Next, 80,000. Next, 1 lakh. 1 lakh 50. 1 lakh. So 70, 80, 1 lakh 50 and 1 lakh. Okay. Here less what? Fixed cost. Less fixed cost. You will get EB IT minus 10,000, 40,000, minus 50 and 1 lakh. So what is the operating leverage? 70,000 divided by 10,000, 7. Next, 80,000 divided by 40,000, 2. Next, 1 lakh 50 divided by 50,000, 3. Next, 1 lakh divided by 1 lakh, 1. So they asked you to find out the operating leverage. So which company is having a high operating leverage? A is having a high operating leverage. Okay. And operating risk is no operating risk for firm D. Firm D operating risk is equal to 0. Operating risk 0. Operating leverage 1, but operating risk 0. Why? Because there are no fixed cost. There are no fixed cost. Company is having a high fixed cost. So that's why A is getting a high operating leverage. C is having a high fixed cost, but C selling price is 50. Greater sales, so greater fixed cost. That's okay. Clear? Next, illustration number 3. Illustration number 3. Illustration number 3. Sonia Gandhi. A firm's sale variable cost and fixed cost amount to rupees 75 lakhs, 42 lakhs, 6 lakhs. Sales 75 lakhs. Babu, Mahatma Gandhi. Okay. Sales 75 lakhs, variable cost 42 lakhs, and fixed cost 6 lakhs. It has borrowed 45 lakhs. It has borrowed 45 lakhs at 9%. Its equity capital totals 55 lakhs. What is the firm's ROI? ROI. Return on a investment. Return on a investment. Investment includes both equity and debt. Investment includes both equity and debt. Investment or capital employed is equal to equity plus long-term debt. Here equity is equal to 55 lakhs, debt is equal to 45 lakhs. So 100 lakhs is the investment. Return on a investment. What is the return on investment? EBIT is the return on investment because investment includes both equity and debt. What is return on equity? For equity shareholders, return is earnings available to equity shareholders. Yes or no? What is the return to the equity shareholders? EAES, earnings available to equity shareholders. Earnings available to equity shareholders. What about the return on a investment? Return on investment. Okay, EBIT. Clearer? In interviews, they will be asking questions. Why only EBIT? Why not EBT? Earnings before tax. Why only EBIT? Because denominator investment includes both equity and debt. We should consider return on a debt also, that is interest. So that's why EBIT. So return on investment formula is EBIT divided by investment. So this is the pre-tax, before tax, EBIT divided by investment. EBIT is equal to 75 minus 42 minus 6, that is equal to 27. So 27 lakhs divided by 100 lakhs. 27%. 27% is the ROI. This is a small calculation. We should not use calculator. Yes or no? 27 divided by 100. 27%. చెప్తూనే ఉన్నా క్యాలిక్యులేటర్ కొడుతూనే ఉంది అమ్మాయి. ఏం చెప్పాలి? Okay, next second part. The second part. Does it have a favorable financial leverage? Does it have a favorable financial leverage? Favorable financial leverage. So this point we haven't discussed. Favorable financial leverage. Financial leverage is said to be favorable. Gautami. Financial leverage is said to be favorable if return on investment is greater than rate of interest. Okay, financial leverage is said to be favorable if return on investment is greater than rate of interest. For example, these are equity shareholders and boys debt. What is the rate of interest? 9% is the rate of interest. Okay, yes or no? On every rupee invested, we are getting 27% return. Yes or no? Company is taking amount from equity, company is taking amount from debt. The entire amount is invested in business and the business is getting 27% return. Yes or no? But whereas the rate of interest is 9%. That extra 27 minus 9, 18% will be enjoyed by the equity shareholders. Nothing but here I am discussing the favorable financial leverage concept here itself, Vinay. Okay. So next, favorable financial leverage. Favorable financial leverage. Financial leverage is said to be favorable if return on investment is greater than return on investment is greater than return on investment. 90 years na answer radamma. Okay. Return on investment is greater than rate of interest. Return on investment is greater than what? Rate of interest. Okay, financial leverage is said to be favorable if return on investment is greater than rate of interest. Greater than rate of interest. Here return on investment is 27%, which is greater than what? 9%. Okay, so now the equity shareholders will get benefited because equity shareholders, they are taking money from debt holders, they are making investment, they are getting 27% but paying only 9%. So that extra benefit is enjoyed by equity shareholders. This is called as a favorable financial leverage. Okay, so we can call it as a trading on equity. Trading on equity. So now, if you see the return on equity, what is sales here? 75 lakhs minus variable cost 42 lakhs. Contribution 33 lakhs. Next, minus what? Fixed cost 6 lakhs. 27 lakhs is what? EBIT minus interest. Babu, HM interest 4,05,000. Earnings before tax 22 lakh 95,000. Is there any tax rate is given or not? Tax rate? No. Okay, right. This earnings before tax itself is what? Earnings available to equity shareholders. So nothing but return on equity is equal to 22 lakh 95,000 divided by what is their investment? 100. Equity investment is 55. 45 invested by boys, debt. So equity shareholders investment is only 55, but they are getting a benefit of 22 lakh 95,000. So what is the rate of interest return? I mean return on equity? 41.73. On every rupee invested, they are getting 27. Yes or no? But whereas equity shareholders are getting 41.73. How they are getting 41.73? Simple. So we can use the another formula. Return on equity is equal to on every rupee invested by equity shareholders, they are getting 27 plus in addition to that they are getting 27 minus 9. What is this 27 minus 9? Uh-huh. 27 is a return on a investment. Only 9% is paid to the debt holders. Only 9% is paid to the debt holders. So that means that extra 18 will be added to what? Equity shareholders. But directly we should not add 18. If you are adding 18 directly, 27 plus 18, you are getting 45. That is not the correct answer. So into what is the debt proportion? 45. What is the equity? 55. D by E. You will get 41.73. Nothing but the formula is return on investment plus return on investment minus KD, cost of debt, pre-tax, interest rate, into what? Debt by equity. Again this concept I will be discussing in capital structure. Favorable financial leverage. If return on investment is less than rate of interest, then financial leverage is said to be unfavorable. For example, if return on investment is 8%, so on every 1 rupee invested we are getting only 8, but we have to pay 9 to the debenture holders. Okay. When financial leverage is favorable, if you are increasing the debt proportion, the return on equity increases. For example, here 27 plus 27 minus 9 into, we are increasing the debt proportion. For example, we are taking debt 95, and equity only 5. Out of 100 lakhs investment, 95 is debt and 5 is equity. Then what happens to the return on equity? Increases. Answer? 369. Are you getting my point? 369. The return on equity keeps on increasing if debt proportion increases. When financial leverage is favorable. When financial leverage is favorable. Clear? Simple common sense. On every rupee invested, we are getting 27. The interest payable to the debt holder is 9. If you are increasing the debt proportion, what happens to the return on equity? Increases. That is what happening here. Clearer? But at the same time, risk will increase. Risk will increase. No doubt profit is getting maximized, but risk increases. Risk increases or not? 5 equity, 5 lakhs equity, 95 lakhs debt. With 5 lakhs equity, we have to pay 95 lakhs debt, means too much of risk. Clear? Okay? Done? So financial leverage is said to be favorable if return on investment is greater than rate of interest. Rate of interest. Done? So does it have a favorable financial leverage? Yes, the firm has a favorable financial leverage. Why? Because ROI is greater than the rate of interest. Next question, C part. If the firm belongs to an industry whose assets turnover is 3. So before moving on to the ratios itself, we are discussing few formulas like return on investment, EBIT divided by investment. Investment is equal to equity plus debt. Asset turnover. So whenever the turnover ratio is given in the question, turnover ratio, whatever the turnover ratio it is, asset turnover, inventory turnover ratio, working capital turnover ratio, fixed asset turnover ratio, whatever the turnover ratio it is, always the turnover will be the numerator. Turnover will be the numerator. Here asset turnover ratio 3. That means turnover divided by assets. Sales divided by assets 3. What does it mean? By investing 1 rupee in assets, we are able to generate a sales of 3 rupees. For suppose asset turnover ratio 10. What does it mean? We are efficiently using our assets. By investing 1 rupee in asset, we are able to generate a sales of 10. Generate a sales of 10. For example, if we are conducting classes after 11 also for another batch, okay, so that means what happens to the turnover ratio? Increases. We are efficiently using our assets, efficiently using without making an extra investment in assets, we are generating a sales. So turnover ratio is calculated to know how efficiently are we using our assets. Okay, clear? See here, asset turnover ratio is what? 3. Okay, does it have a high or a low asset leverage? Does it have a high asset or a low leverage? So asset turnover, sales divided by total assets. What is sales? 75 lakhs. What is the investment? 100 lakhs. 0.75. Okay, 0.75. So here the company turnover ratio is what? 0.75. But whereas industry turnover ratio is, a firm belongs to an industry whose asset turnover is 3. In industry, everybody turnover ratio is 3, but our company turnover ratio is 0.75. That means we are not using our assets efficiently. We are able to generate only 0.75 sales for 1 rupee investment. So the company is having a higher low asset. Okay. Next, what is operating financial and operating leverage? Operating leverage, how do we get it? Contribution divided by EBIT. 33 lakhs divided by 27. 33 divided by 27. 1.22. Next. Financial leverage. 27 divided by 22 lakh 95,000. Yes or no? 1.176. 1.176. Next. Combined leverage. 33 lakhs divided by 22 lakh 95,000. Answer? 0.4. 4. So 1.44. 1.44. Clear? 1.44. Pavan. Next part. What is the next part of the question? If a sales drops to 50 lakhs, what is the new EBIT? If a sales drops to 50 lakhs, Indira. So sales drops to 50 lakhs. So 50 lakhs minus variable cost. So what is the variable cost? Variable cost will remain same or what? No. Changes proportionately, right? So what is the calculation? Sales 50 minus variable cost, cross multiplication, right? Yes or no? So 42 lakhs divided by 75 lakhs into 50, 28 lakhs. So contribution 22 lakhs minus what? Fixed cost 6 lakhs. EBIT 16 lakhs. New EBIT 16 lakhs. Clear? So clear? Amma Bangartali. Clear? The next. At what level will the EBIT of the firm equal to 0? EBIT of the firm equal to 0. One thing we can do is working back. Working back. EBIT must be equal to what? 0. Pursue. EBIT must be equal to what? 0. So last part of the question, what is the last part? At what sales amount EBIT equal to 0? EBIT equal to 0. So sales, first you should take heading calculation of sales at which EBIT is equal to 0. EBIT is equal to 0. Okay, Barastana. Note cheskoma. Okay. Calculation of sales at which EBIT is equal to 0. Particulars amount. Particulars amount. Mahatma. Particulars amount. So sales. Sales. What is the sales amount? Yes, that we have to find out. Very good, Amabalatya. Minus what? Variable cost. Telsa? Yashwant Telsa? Ella? Contribution. Minus what? Fixed cost. EBIT. Minus what? Fixed cost we know, right? What is the fixed cost amount? 6. Interest. We know the interest amount also, 4 lakh 5,000. Earnings before tax, 0. Earnings before tax must be equal to what? 0. So to get earnings before tax 0, EBIT must be equal to 4 lakh 5,000. Yes or no? So then entire amount will be paid as a interest. Okay. So to get EBIT 4 lakh 5,000, contribution must be equal to 10 lakh 5,000. 10 lakh 5,000. So now sales cross multiplication. Yes or no? So contribution, earlier what was the contribution? 75 lakhs minus 42, 33 lakhs. For 33 lakhs contribution, what is the sales amount? 75 lakhs. Now the question is 10.05 lakhs. For 10.05 lakhs, what is the sales amount? For 33 lakhs, sales amount is 75 lakhs. For 10.05 lakhs, what is the sales amount? 22 lakh 84,091. So variable cost is equal to, tell Manoj. So 33 lakhs is the previous contribution, right? 33 lakhs is the contribution when sales are 75. So what is the variable cost? 12 lakh 17 079 1279 091. Clear? So this is working back. If you are not putting this arrow, then you will not be able to understand. Okay, working back upward. ఆరో లేకపోతే ఏమనుకుంటారు? క్యాలిక్యులేటర్లో సేల్స్ తీసుకుంటారు 22,84,091. దాని నుంచి ఏం చేస్తారు? మా వేరియబుల్ కాస్ట్ మైనస్ చేసుకుంటే లాస్ట్కి 0 వచ్చిందో లేదో చూస్తారు. క్యాలిక్యులేటర్ ప్రాక్టీస్ అది అర్థమైందా? వర్కింగ్ బ్యాక్, దట్ ఈస్ వర్కింగ్ బ్యాక్. So the other way of calculation, completely conceptual, the other way of a calculation. So what is the combined leverage? What is the combined leverage? Already? What is combined leverage? 1.44. I have already told what does it is 1.44. Combined leverage denotes the relationship between sales and EBT, EAT, EPS. Yes or no? What does it indicate? Sales, EBT. If a sales changes by 1%, EBT changes by 1.44%. Yes or no? Okay. Here EBT is changing by 100%. EBT changing by 100% because we want EBT 0. Earnings before tax 0. Nothing but EBT has to decrease 100%. Clear up? So question mark. That means sales should change by 100 divided by 1.44 into 1. 69.44. That means sales should decrease by 69.44. That means new sales is equal to 75 lakhs into 1 minus 69.44%. 69.44% means you should write it as a 0.6944. Sales should get reduced by, sales should change by 69.44%. 22 lakh 90. So that is what we got actually. Okay. Clear? So this is the other way of a calculation. Completely conceptual. Combined leverage. Using the combined leverage. అర్థమైందా? Combined leverage. Clear? Combined leverage. Second method. Are you able to understand? See, no? Clear? 22 lakh 92,000. Next, illustration number 4. That is also a basic question. Balance sheet is given. ABC Limited has the following balance sheet and income statement information. When question is lengthy, some might feel panicked, okay, but lot of information will be given in question itself. So that, okay, so we need not take a lot of stress, okay. So this question number 4, for example, balance sheet is given. That means entire information is given there itself. The ABC Limited has the following balance sheet and income statement information. Balance sheet as on March 31st, 2021. Liabilities, assets. Equity share capital 10% debt, retained earnings, current liabilities. Income statement is also given. Generally we used to prepare income statement, right? But here the income statement is given. Sales, operating expenses, including 60,000 depreciation. 60,000 depreciation is a fixed cost or a variable cost? Depreciation, fixed cost or variable cost? Fixed cost, depreciation. EBIT, less interest. Earnings before tax, less tax. EAT, earnings after tax. Determine the degree of operating leverage, financial leverage, combined leverage at the current sales level if all operating expenses other than depreciation are variable cost. The only special point in this question is all operating expenses other than depreciation are variable cost. That means what is the variable cost amount? 1,20,000 minus 60,000. 60,000 is the variable cost, 60,000 is the fixed cost. So the only, okay, so simple, sales 3,40,000 minus variable cost 60,000. So contribution is equal to 2,80,000. Contribution 2,80,000 minus fixed cost 60,000. EBIT 2,20,000. So operating leverage formula, contribution divided by EBIT. What is the contribution? 2,80,000 divided by 2,20,000. So the answer is 1.27. Financial leverage. EBIT divided by EBIT. 2,20,000 divided by 1,60,000. 1.37. Combined leverage. 1.7. Clear? Next, if a total assets remain at the same level, but sales increases by 20%, sales increases by 20% and decreases by 20%. There are two cases. Sales increases by 20, decreases by 20. What will be the earnings per share in the new situation? In new situation, we should find out the earnings per share. We should find out earnings per share. Okay. So how can we find out this earnings per share? Simple. Okay, why the balance sheet is given? The only purpose of balance sheet is to find out the number of our shares. So what are the number of shares? 80,000. Interest is given in income statement only. Earnings after tax 1,04,000. So number of shares 80,000. So earnings per share present. What is the current earnings per share? 1,04,000 divided by 80,000. 1.3 is the present one. But they are asking new EPS. New EPS. If sales increases by 20%, right now the sales are 3,40,000. Increase the sales by 20%. 4,08,000. And next, decrease the sales by 20%. 2,72,000. Clear? Minus variable cost. Variable cost is the cost which changes with the change in sales proportionately. If a sales increase by 20%, variable cost will also increase by 20%. That's why we are taking 72,000. Next, 60,000 minus 20%, 48. So here you should take contribution. So tell me the contribution. 4,08,000 minus 72. 3,36,000. Second, 20 contribution minus what? Fixed cost minus interest, earnings before tax minus tax, earnings after tax divided by what? Number of shares. So EPS is equal to 1.75, 0.84. So there is the other way of a calculation also. The other way of a calculation is using the combined leverage. What is the combined leverage? 1.75. For every 1% change in sales, EPS changes by 1.75. But here sales changes by 20%. Sales changes by 20% means EPS changes by 20 into 1.75. So this is completely conceptual. 20 into 1.75. 35. EPS changes by 35%. Okay. What is the EPS right now? 1.3. 1,04,000 divided by 80,000. 1.3. So EPS decreases by 35 or increases by 35. So 1.3 minus 35%. 0.845. 1.3 minus, sorry, plus 35%. 1.75. So the second one is completely conceptual, okay? Using the combined leverage. So clear? Clear, Vamshi? So go through the next question, illustration number 5. 5, 6, 7. I mean, all the questions you can do. 5, 6, 7. 15 minutes time. Shivapriya. Is there any special point in question number 5? Sales, okay. So degree of operating leverage is given, financial leverage is given, income tax rate is given. Prepare income statement. Variable expenses are given. Okay. So how can we approach this question? First we can start with what? Financial leverage. So financial leverage formula, EBIT divided by EBT. EBIT divided by EBT. That EBT can be written as EBIT minus interest. So that is the special point. You should write financial leverage formula EBIT divided by EBT. That EBT should be written as EBIT minus interest. You know the interest, right? By substituting interest 200, you can find out what EBIT. If you know EBIT, you can find out what earnings before tax. If you know EBIT, using the operating leverage formula, you can find out what contribution. Okay, so that starting point is important. Clear? Any special point in 6th? Asset turnover ratio. What is the meaning of asset turnover ratio formula? Sales divided by assets. Total assets is equal to 6 lakhs. So sales is equal to 6 lakhs into 4. Is there any other special point in this question? Is there any special point? No. If EPS has to be 1, 2 or 0, that is working back again. Working back. First part is okay, but second part is working back. If you want earnings per share 1 rupee, then profit after tax must be 18,000. 18,000. Tax rate is 30%. Tax rate 30% means profit before tax is equal to 100. Profit before tax 100, tax 30, and profit after tax 70. That means this 18,000 is equal to what? 70. 18,000 is equal to 70. We require 100. Yes or no? 18,000 is equal to 70. We require what? 100. So 100 divided by 70 into 18,000. Then you will get earnings before tax. Clear? The difference is tax. You know the interest, 24,000. So earnings before interest and tax. The only special point is working back, and that too you should know how to find out earnings before tax. Clear? Done? 7th, any special point? Again asset turnover ratio, right? So asset turnover ratio. So asset turnover ratio. So sales is equal to 48 into 48. Question wrong. 10 to 28, 8. So what is the correction? Debenture 20. Debenture 20. What? Debentures 200. So equity share capital 10 CR. 100 CR. 100 CR. Okay. So equity share capital 100 CR. So question, make corrections. Reserves and surplus 20 CR and 15% debentures 200 CR. Current liabilities 80. Overall 400. Fixed assets 250. 250 CR. Current assets 150. Total 400. And this is 80 CR. 65%. 2.5. 40%. So make these corrections, okay? Asset turnover ratio 2.5. That means 400 crores into 2.5. So you will get 500 crores are the lakhs. 500 lakhs. The amount is in lakhs. Amount is in lakhs, not crores. Sales 500 lakhs minus variable cost 300 lakhs. 300 answer code change chesara. Okay, accordingly do the answer, okay? So 400 crores into what? 2.5. Then you will get 1000 crores. 1000 crores, I'm sorry, 1000 crores. 1000 crores, not 500 lakhs, 1000 crores. Okay, accordingly do the question. So simple question, asset turnover ratio 2.5. That means sales is equal to 400 crores into 2.5, 1000 crores. Minus variable cost 65%. Contribution minus fixed cost. Clear? Any special point? No. So with this we have completed what? Leverages topic, okay? So kindly do practice last 3 attempts past questions. Done? Next topic, risk and return. Next topic, risk and return. Small topic, risk and return. So this is a final level topic, but so simple topic. You have a basics only, risk and return. Risk and return. So every investor require return, right? Every investor require a return. Return. Yield, return. What is the return expected by the equity shareholder? Equity shareholder will expect dividend and what? Capital appreciation. Dividend D1, capital appreciation P1 minus P0. This already we have discussed. P1 means price at the end, P0 means price at the beginning. Okay, clear? If a person is a bond holder, debenture holder, then he will expect interest. He will expect interest. Clear? So return. And there are two types of returns, realized return. Realized return. So it can be called as ex post return also. Ex post return. Ex post return. Ex post return means historical return. The return which already received. For example, when I already purchased Reliance shares, from the past 5 years he is getting a return. That return is called as what? Realized return or ex post return or historical return. Historical return. Next, expected return. So based on this past, okay, expected return, it is also called as ex ante return. Ex ante, ANTE, ex ante return. This is a prediction, future return. Ex ante return, this is a prediction of a return. Prediction means all the IPL bettings are made on predictions, right? Okay, say no to betting. So prediction of a returns. How do we predict return? Based on a past, based on historical returns, we what predict the future, yes or no? For example, if you get 50 marks in FM, we expect the marks in main examination, yes or no? Based on your costing past marks, we predict the future in FM, right? So prediction of a return. Next, risk. Next what? Risk. Risk already we told risk. Risk means what? Possibility of occurrence of loss. It is measured using standard deviation. I'm not explaining the entire concept, Charan. Risk can be measured using standard deviation, variance, or coefficient of a variation. Coefficient of a variation. Coefficient of a variation. Okay. So risk of a security. We are talking about risk of a security. Security means share or a debenture. Risk can be measured using standard deviation or variance or a coefficient of a variation. Okay. So coefficient of a variation is equal to standard deviation divided by mean. Mean means average. Standard deviation divided by mean. Mean means what? Average. Mean means average. Okay, clear? And the standard deviation. Risk is called as the possibility of occurrence of a loss, possibility of deviation from the mean. Possibility of deviation from the mean. So that's why we write a standard deviation formula, square root of risk means possibility of deviation from the mean. X bar is mean. X minus X bar is a deviation. X minus X bar is deviation square into probability. Probability is nothing but weighted average. We are doing a weighted average of a deviation. So this is not a small concept actually. It will take in final itself, it will take 3 hours time. Standard deviation, square root of P into X minus X bar square. Standard deviation. Variance is equal to simple square of a standard deviation. Square of a standard deviation. Nothing but P into X minus X bar square. One thing is missing, summation sigma. Summation sigma, square root of summation sigma P into X minus X bar square. If it is a variance, then square of a standard deviation. Clear? Done? Next, total risk is equal to systematic risk plus unsystematic risk Total risk is equal to systematic risk plus unsystematic risk. Systematic risk examples: market risk, purchasing power risk, and interest rate risk. Interest rate risk. Unsystematic risk means business risk, finance risk, already we discussed in leverages. And next what? Default risk. The systematic risk is denoted with beta. What? Systematic is denoted by what? Beta. Default risk means nothing but the third party may make a default. For example, bank is giving a loan to Shivapriya. If a Shivapriya makes a default, there is a possibility that she may make a default. That is called as a default risk. Counterparty risk. That is also called as counterparty risk. Default risk. So this unsystematic risk can be diversified, that can be reduced, but systematic risk cannot be diversified. Example, in stock market, okay, so Reliance and Tata, if you are making investment in Reliance and Tata, then the risk will get diversified. So you might lose money in Reliance, but you might get benefit in Tata. If you lose money in Tata, you might get benefit in Reliance. Okay. So generally that is called as portfolio investment. Portfolio investment means investment in 2 or more securities. If you are investing in 2 or more securities, even if you lose money in 1 or 2 securities, you will get gain in other securities. Nothing but your possibility of occurrence of loss will get reduced. So, but only unsystematic risk can be diversified. Only unsystematic risk can be diversified. Systematic risk cannot be diversified. That cannot be reduced, because market risk. Market includes all the companies. If a market falls, then all the companies are going to lose money. Okay, so systematic risk cannot be diversified. Okay. So this is a big concept, entire portfolio management chapter, but I am trying to give a basics. So total risk is equal to systematic risk plus what? Unsystematic risk. And next, how do we find out return percentage? Return percentage is equal to P1 minus P naught plus D1 divided by P naught. Yesterday we have discussed, right? Okay. And next, average return. Average return either we can do simple average or weighted average. Simple average or weighted average. Average return either we can do simple average or weighted average. Simple average or weighted average. Okay, average return. And next, return of a portfolio. Portfolio means 2 or more securities. Okay. So return of a portfolio. So write down this. I have seen MCQ. Return of a portfolio. Return of a portfolio is nothing but portfolio means 2 or more securities. Okay. So return of a portfolio means weighted average of security return. Weighted average of what? Security return. Weighted average of security return. Wx means weight of a security x. X bar is return of a security x plus weight of y bar, and so on. If there are two securities, we take x and y. Three securities, x, y, and z, and so on. So clear, this is what? Return of a portfolio. I seen one MCQ, they will give a return of a portfolio and weights. So we have to do weighted average. Okay. And next, beta calculation. Beta calculation. So this is almost half of the portfolio management chapter. So just remember these formulas. Beta. Systematic risk is denoted by beta. How do we calculate beta? Beta is equal to covariance of security and market divided by sigma m square. Sigma m square means variance of a market. Sigma m square is variance of a market. Covariance of a S comma M, S and security, M means market. Covariance of S comma M divided by sigma m square. Sigma m square is equal to variance of a market. This is one formula. The other one is or sigma Sm into sigma S divided by sigma M. Sigma Sm into sigma S divided by sigma M. Here sigma S means standard deviation of security. Sigma M, standard deviation of market. Standard deviation of market. And sigma Sm is equal to correlation coefficient. Correlation coefficient. Correlation coefficient. Okay. Correlation coefficient. And one more formula is given for you. Covariance of S comma M is equal to sigma S, sigma M, sigma S, sigma M, sigma Sm. Sigma S means standard deviation of security, sigma M means standard deviation of market, sigma Sm is correlation coefficient of security and market. Okay. But this you can understand now itself. Beta can be negative or positive or 0. Beta can be negative, positive or 0. Beta denotes relationship between market and security. Market and security. Market means Sensex, Nifty. Okay. So for example, beta of a Reliance company is equal to 2. Beta of a Reliance company is equal to 2. What does it mean? If a market changes by 1, Reliance changes by 2%. If a market changes by 100%, Reliance changes by 200%. High beta indicates high risk. High beta indicates high risk. Beta of a risk-free security is equal to 0. Because even if market changes, risk-free security return is not going to change. Not at all related to the market. So that's a beta of a risk-free security is equal to 0. That means no systematic risk. No systematic risk. Okay. So beta can be 0. Beta can be negative. Beta can be positive. Okay, beta positive means market and security both are moving in same direction. Market and security, for example, beta of Reliance is equal to 2. Market increases, Reliance increases. Market increases by 1, Reliance increases by 2%. If a beta is negative, that means market and security are moving in opposite direction. If a market decreases, our security increases. If market increases, security decreases. If a beta is negative, beta negative indicates opposite direction. Positive indicates same direction. Beta 0 means no relation. No relation between the market and security. For example, beta of a risk-free security is equal to 0. That means no relation between the market and risk-free security. Okay. So the basics are given in risk and return chapter, but we cannot explain a logic for everything in just half an hour. Okay, if you want, you can watch portfolio management chapter uploaded in YouTube. Okay, clear? SFM. So this is a topic, risk and return. Risk and return topic. So clear? Next topic, capital budgeting, capital bursting. So what is the weightage of this chapter? Compulsory you will get 2 into 7, 14 marks descriptive, and capital bursting is asked in 5A and 5B. 5A and 5B. Am I clear? 5A and 5B. Capital budgeting. So the two aspects of financial management are procurement of fund, effective utilization of fund. Effective utilization of fund. We procure fund from two sources, equity and debt. We utilize the fund for two purposes, fixed assets and current assets. Nothing but we take two types of investment decisions. One is the short term, second one is long term. Investment decisions we are going to, short term investment decisions we are going to discuss under working capital management. Long term investment decisions we are going to discuss in capital budgeting. So okay, so capital bursting comes under what? Effective utilization of a funds. Effective utilization of a funds. Effective utilization of a funds. So what is the primary objective of financial management? Objective? Wealth maximization. Wealth maximization. Okay. So we have already completed what? The cost of a capital chapter, right? Cost of a capital. So cost of a capital, for example, answer 20%. What is the meaning of this 20%? Minimum return required to be earned by the company to meet the expectation of the investors. So ultimately we should meet the expectation of investors. That is the objective. When we meet expectation of the investors, the value of a firm increases. Value of a firm increases. Okay. So maximum we try to keep the expectation of the investors low. Here the minimum return required is 20%. Generally we determine a capital structure, okay, best capital structure where a cost of a capital is minimum. Cost of a capital will be minimum. We try to minimize the cost of a capital. Yes or no? By changing the capital structure. By changing the capital structure, we haven't discussed capital structure. So then you will get to know. So right now the cost of a capital is 20%. What is the meaning of this 20%? Minimum return required is 20. Now I am discussing about capital budgeting. So the other name for capital budgeting is investment decision. Investment decision. Before making an investment, one thing you have to keep in your mind. The minimum return required is 20%. What is the minimum return required? 20%. I will be accepting that investment decision only if it give more than 20. Yes or no? For example, minimum salary required 50,000. If a company is offering 60, then you accept the offer. If a company is offering only 30,000, will you accept the offer or not? No. Same kind. So 20% is the minimum return required. Minimum return required. Okay. So before taking any investment decision, you should keep in this mind. You should keep this in your mind. Okay. So cost of a capital. So very much relevant. So in capital bursting, we consider this cost of a capital as the time value of a money, opportunity cost of a capital, rate of interest. Okay. And we have discussed time value of a money also. Time value of a money yesterday. So time value of a money, present value of annuity is equal to what? Annuity into present value annuity factor. Future value of annuity is equal to annuity into future value annuity factor. So present value, that can be what? Regular or immediate. Regular or immediate. If it is regular, I will press equal to how many times? N times. If it is immediate, I will press equal to n minus 1 times. Grand total and then add 1. Why? What is the reason? Regular means end of the period. Regular means end of the period. So for example, first year ending. First year ending means I should bring first year ending to 0. 0 means as on today, present. I have to find out the present value. First year annuity. First year annuity means first year ending. I should bring at the end of the first year annuity to present value. So that means I have to discount one time. I have to discount one time. What about immediate? Immediate means first year beginning. First year beginning means as on today. Already it is at 0. So I should discount it or not? No. I need not discount. Yes or no? So here I have to discount one time, but here I need not discount first year annuity. First year annuity. I need not discount first year annuity. So that's why I am pressing equal to how many times? N minus 1 times grand total and adding the first year 1 rupee. First year 1 rupee. But if it is regular, press equal to how many times? N times. And to find out the present value, we do discounting. We do discounting. Yes or no? Next, future value. Future value regular, immediate. So future value means if a present value is given and they are asking you to find out the future value, how to do compounding. How to do compounding. If it is regular, I will press n minus 1 times because this time I am finding out what? Future value. For example, last year annuity. Last year annuity. Am I going to get interest on a last year annuity? I am not going to get interest on a last year annuity. This time I am finding out future value. I am not going to get interest on last year, nth year annuity. I am not going to get any interest. So that's why press equal to how many times? N minus 1 times. Grand total and then add last year 1 rupee. Clear? If it is immediate, press equal to how many times? N times. Why n times? Because immediate means beginning. Last year beginning means you will get 1 year interest. Yes or no? First year beginning means as on today. You will get interest for n years. Interest for n years. So that's why press equal to how many times? N times. Is it clear? So now let us talk about the capital bursting decision. Capital budgeting decision. First, What is the capital budgeting decision? So the investment decision can be a long term or a short term. So the long term decisions are considered as a capital budgeting decision. Capital expenditure. Okay, so long term decision is considered as a capital budgeting decision. So for example, PVR. So PVR cinemas, PVR cinemas, theaters. Okay. So PVR is engaged in what? Theater business. Do you know PVR? PVR, Inox. PVR has already acquired Inox. Acquired, mergers and acquisition. Mergers and acquisition is also part of a financial management. Financial management includes financing decision, investment decision, dividend decision, and portfolio also. If it is SFM, strategic financial management. Okay. So now the point is PVR and Inox. What is their business? Theaters. Yes or no? So they will be starting a theater, multiplex theater. Multiplex theater. So multiplex theater means what? First, construction has to be done. Construction has to be done, or else they will be taking a space on a lease. In a, I mean, malls, shopping malls. In shopping malls, top floor, generally top floor, because theater need not be in a ground floor, right? And why a theater will be on a top floor? That is a strategy. People, everybody likes to watch movie, yes or no? So if it is in a ground, nobody will come for shopping, right? So that's why generally, if you observe the shopping mall, okay, escalators, generally escalators also nowadays, okay, first floor escalator will be, for example, on east, and from first floor to second floor, so the escalator will be on a west, so that people will be walking throughout the shopping mall. They will be walking throughout every shop. They can see each and every shop. Okay, so that every shop owner will get a customer. Yes or no? And while going to a movie, so they can what? Do a shopping, and then what? They can have a food and then go to movie. That is a strategy. So the point is multiplex theater. Multiplex theater. Multiplex theater means they will take a space on a lease, and thereafter what they have to do? So that theater work, yes or no? Projector. So nowadays projector is not required. Satellite. So okay, speakers and all, everything has to be arranged. The seating, everything has to be arranged. Yes or no? Now, this is a capital budgeting decision. Why this is a capital budgeting decision? Because, for suppose, PVR and Inox has constructed a multiplex theater in Nujivedu, and they have invested 10 crores on a theater. 10 crores on a theater. Are they going to get benefit within a year? Are they going to get a benefit within a year or what? No, they are not going to get a benefit within a year. Yes or no? So the theater life will be more than 1 year. Theater life will be more than 1 year. So that's why whether to construct a theater or not is a capital budgeting decision. Whether to construct a theater or not is a capital budgeting decision, because the benefit from the theater will be for more than 1 year. Yes or no? And you have to visualize how the theater owner will get a benefit. What is the benefit he is going to receive? First of all, theater was constructed. Okay, fine. How the theater owner is going to get a benefit? How the company is going to get a benefit? Tickets revenue. Tickets revenue. And next, snacks. Parking, no. Parking, they have to provide parking for free. They have to provide parking for free. So if they are collecting parking charges, that is illegal. Because while getting a permission for shopping mall, they have to show the place for parking. Okay, already one person has filed a public interest litigation pill and he won the case, okay, on in orbit mall. Okay, so the point is here, parking they have to provide, they have to provide parking in shopping mall. So that is not the correct answer. So ticket revenue, snacks revenue, and one more revenue is advertisement. One more revenue is advertisement. Yes or no? As a finance manager, your role is to estimate the benefits, estimate the investment. How much are you going to invest in the theater? The next one is estimate the benefits. Estimate the benefits. Estimate how much benefit the company is going to get. Okay, so theater will get a benefit in the form of three: ticket revenue, snacks, and advertisement. And advertisement. Three. Okay, so clear. So this is a capital bursting decision. If a PVR Inox, so they are planning to start a multiplex theater in Nujvidu. So this is a capital budgeting decision for them, because theater will give a benefit for more than 1 year or less than 1 year? More than 1 year. More than 1 year. Am I clear? Next, Metro Rail project. Metro Rail project. Metro Rail was constructed by L&T, Larsen and Toubro. So that Metro Rail project is a capital budgeting decision for L&T. So generally these days, roads, metro rails, airports are constructed in public-private partnership. So okay, this approach is called as build, operate, transfer approach. Build, operate, transfer. Build, construct, operate, and then transfer. Public-private partnership. So what is this public-private partnership? Public means government. Public means what? Government. Private means example L&T. So in case of Hyderabad airport, private means GMR company. Okay. So public means government, private means what? GMR in case of airport, in case of metro, L&T, Larsen and Toubro. Okay. So now the point is, airport concession contract is a capital budgeting decision to GMR. For GMR, it is a capital budgeting decision. Public-private partnership. Public-private partnership means government will be giving us some part of investment, and some part of investment will be made by the GMR, private company. Okay, generally land acquisition is the duty of a state government. Okay, because land comes under state list as per the Constitution of India. So state government is responsible for acquisition of a land. So state government will acquire the land and will give it to the central government. Now the central government will enter into a public-private partnership. So from central government, Airport Authority of India is a government organization which will enter into a partnership with what? GMR. For what? Construction of a airport. So Airport Authority of India is operating under central government. So now the point is, for GMR, construction of airport is a capital budgeting decision. Now tell me, how GMR is going to get a revenue? How GMR is going to get a revenue? Because GMR is making a part of investment, right? Okay, so build. So airport is built by GMR. They will operate the airport. They will maintain the airport. So for 15 or 20 years until they recover their investment, and then transfer it to the government. So metro rail also same approach. L&T will construct the metro rail, then operate for 15 to 20 years to recover the investment, and then what? Transfer it to the government, public. So that will become a public property. And next what? Likewise roads construction. Roads, highways. These also constructed, operated, and then again transferred to what? Government. So when these roads are transferred to the government, no toll taxes must be collected generally. Okay. So build, operate, transfer. Now tell me how the GMR is going to get revenue out of our airport. Landing charges. Landing charges. Okay, GMR will be getting revenue in the in the form of landing charges. So landing charges means, for example, Indigo Airlines. Indigo Airlines. Indigo Airlines is a different company. They are operating aircrafts. They are operating aircrafts. Okay, they cannot leave the passengers in the air. Yes or no? They have to land in the airport. So that's why what they will be collecting. GMR will be collecting what landing charges from Indigo Airlines, Jet Airways, etc. Okay. So is that only the revenue landing charges? No. In airport there are, you will find so many shops, stores, yes or no? They will be paying rentals. They will be paying rentals and parking income. Airport is not bound to provide free parking. Parking fees. Parking fees. So these are the, and advertisement. If you go to Hyderabad airport, you will be finding lot of advertisements. So advertisement revenue, landing charges, parking and rents. Okay, this is the benefit. In capital bursting, most important is not learning the methods. The most important thing is identifying the benefits. What benefit the asset is going to give. So for example, next third one, L&T Metro Rail project. How the benefit is going to be received by L&T? What is the benefit L&T is going to receive? What is the benefit L&T is going to receive? Ticket revenue. So remember, the airport is not going to get ticket revenue because ticket revenue is received by airlines, Indigo Airlines, SpiceJet, etc. Okay. So now here, okay, the point is Metro Rail project. How the Metro Rail project is going to get a revenue? Dharmateja, Metro Rail project is going to get a revenue in the form of what? In the form of ticket revenue, stores rent, yes or no? Advertisement and advertisement. These are the revenues, yes or no? So L&T is going to get a revenue only for 1 year or more than 1 year? More than 1 year. Life of Metro Rail project is less than 1 year or more than 1 year? More than 1 year. So construction of a metro rail, construction of airport, construction of a roads, and commencement of a new project. Like PVR and Anox starting a new project. Okay. And purchase of plant and machinery. So purchase of plant and machinery is also a capital budgeting decision. Spending money on research. Spending money on advertisement. Because if you are spending money on research, are you going to get a benefit only for 1 year or more than 1 year? More than 1 year. For example, pharmaceutical companies will be spending lot of money on research. Yes or no? So they will find some new formulas. Time to time they will be finding new formulas. Yes or no? And they will get a patent registration for that new formula. Patent registration. And that is valid for 20 years. Nothing but no other company can copy that formula. That is called as patent. Patent is an intangible asset. So spending money on research is a capital budgeting decision. Spending money on advertisement. Spending money on advertisement means, for example, BCCA is entering into contract with Mahatma Vijay. Okay. He is a brand ambassador. So Are getting my point? So he is our brand ambassador, and we are entering into a contract with Vijay, and we are spending a lot of money on advertisement. First thing, we have to pay money to Vijay Mahatma. We should pay money to Mahatma. And second, ad, we should direct one ad, yes or no? Okay, ad direction has to be done. Ad direction has to be done. And we should give some advance to some money to what? A director, Pressu. Okay, he's a director. He is a director. Okay. So nothing but advertising agency. Advertising agency will be there. So advertising agency. Nothing but they will be getting a brand ambassador. They will be contacting with the director. They will be contacting with a cameraman. So they will give us an ad. They will be contacting with TV channels, hoarding owners, everything, and so they will be organizing everything. We have to pay money. Okay. So now spending money on advertisement is also a capital budgeting decision. For suppose if we are spending money on advertisement, advertisement means, for example, you remember Lalita Jewelers ad, Double. So still you remember that Gundu uncle, yes or no? Why? Why? Nowadays too much of ads are telecasted on a TV channel or not? Nowadays less actually. In initial days what? In every hoarding, FM radio, TV channel, everywhere he used to come, yes or no? Okay, so that effect, still you feel that, okay, he's coming on a TV. Okay, so when you spend money on advertisement, you will get benefit for more than 1 year. More than 1 year, yes or no? Okay, you might be still remembering Nirma ad, washing powder Nirma. Washing powder Nirma. Santur, obviously you will remember that ad until you die, yes or no? Mummy. Okay. So some ads, why you are able to remember OLX ad, Allu Arjun OLX ad. So now OLX is not there, but OLX ad. Likewise, Mahesh Babu Byju's ad, Shah Rukh Khan Byju's ad. So thumbs up. Okay. So the point is what? So advertisement, if you are spending money on advertisement, you will get benefit for more than 1 year. So these are the examples for capital budgeting decision. For example, BCCA is purchasing a bus. Is a capital budgeting decision because bus is going to give a benefit for more than 1 year. Okay, BCCA purchasing a car is a capital budgeting decision because car life is more than 1 year. Okay, if a BCCA is purchasing a paper bundles, A4 sheets, that is not a capital budgeting decision. We are not going to get a benefit for more than 1 year. So capital asset, capital expenditure. Nothing but capital expenditure. Manoj, tell me. Huh? So these are the examples for what a capital budgeting decision. Are you able to understand what is the capital budgeting decision? Here the crucial point is, in capital budgeting decision, generally we keep money, we invest money in 0 year. For example, if a BCC is purchasing a bus to carry the students, so this is a capital budgeting decision, no doubt. So now the amount, okay, with respect to bus has to be paid as on today or after 10 years? After 10 years. After 10 years ఉండే 10 buses ఆర్డర్ ఇవ్వమ్మా, తెలిసిన వాడు ఉండే చెప్పు, కష్టం అయిపోతుంది. సో we have to pay that bus cost amount as on today or after 10 years? As on today, as on today, as on today. Okay. If I pay money as on today, I'm going to I'm going to get benefit in the future. I'm going to get benefit in the future. More than 1 year, yes or no? Bus life might be, if it is a new bus, life is 1 to 15 years. Bus life is what? 1 to 15 years. Bus life is what? 1 to 15 years. If it is new bus. If it is old bus, depends, depending upon a model, whether it is a 2015 model or 2020 model, depends on that. Okay. So BCCA purchasing a bus is a capital budgeting decision. Here, time value of money is very important. We have to consider time value of money while taking a capital budgeting decision. Why we should consider a time value of money? Because the rupee as on today is not equal to the rupee to be received in the future. Present 1 rupee will have a more value than a future 1 rupee. Bird in the hand is better than bird in the air. Yes or no? So, for example, bus cost is 25 lakhs. So, as on today, you have to pay 25 lakhs. As on today, you have to pay 25 lakhs. As on today, you have to pay 25 lakhs. Okay. And the benefit you are going to receive from first year. You are not going to get benefit immediately unless you sell the bus immediately. So our purpose is not to purchase and sell buses, or no? We are not operating in that. Okay. So ours is a college. So the purpose of purchasing a bus is to use it, yes or no? So the benefit we are going to receive from first year. Immediately we are not going to get benefit. We are going to get benefit in first year, second year, third year, and up to 15 years. Okay. So for example, 0 year 25 lakhs is the investment, and every year I am going to get a benefit of 5 lakhs. Let us assume every year I am going to get a benefit of 5 lakhs in the form of fee collected from students. Okay. Example. So 1 to 15 years, 5 lakhs. Now tell me, Basha, okay, we should consider time value for money or not? I cannot multiply 5 lakhs with 15. 5 into 15, 75. Bus cost is 25. Profit is equal to 50. Can I say like that? No. Why? As on today I am spending 25. I am getting, so will I get 75 lakhs at once as on today? No. I am going to get 5 lakhs at the end of first year. At the end of second year, 5 lakhs. Likewise, I am going to get 5 lakhs every year for 15 years. So Charan, so I should consider what? Time value of money. So time value of money. Am I clear? Time value of money. Okay. So if you see the concept book, so capital bursting decision. Capital budgeting decision. So the key decisions falling within the scope of a financial strategy: financing decision, investment decision, dividend decision, and portfolio decision. Investment decision may relate to long term or short term. Long term investments are known as capital budgeting decision, and these capital budgeting decisions are very important. Capital budgeting decisions are very important for the following reasons. Why it is important? Why it is important? Let us see why the capital budgeting decision is important. Okay. So capital budgeting decision is very important. For example, Bharat. Okay. He is operating 100 autos. 100 autos. Okay. In Amravati. Okay. In Amravati capital. So he is operating 100 autos. Okay. Clear? So he is generating profits. Everything is going well. Now he thought of to start airlines. He thought of to start what? Airlines. Okay. If you want to start airlines, so whether it is a new project or not, New project. Whether it is a capital bursting decision or not. As it is a capital bursting decision. Okay. He bought one aircraft. He bought one aircraft. And he wanted to start what? Airlines business. So first thing, it is very crucial, important. Why it is very important? Because the reason is it is irreversible. It is irreversible. So he bought aircraft, not passion plus. If it is passion plus, you will find number of buyers to buy it. Okay, yes or no? Yes or no, Ganesh? Passion plus anukondi. If it is passion plus enti, we can sell it to someone. But if it is aircraft, passion plus bike. Passion plus bike. If it is passion plus bike, it can be sold to someone because you will find number of buyers. But he already bought what? Aircraft without taking an approval from Airport Authority of India. So now the point is, so whether it is irreversible or not? Irreversible. Capital bursting decision once taken, generally it cannot be reversed. అదో అదన అది ఆటో కాదు కొనడానికి ఇంకొకళ్ళు ఎయిర్క్రాఫ్ట్ కొనాలంటే ఏంటి మళ్ళీ ఒక పొటెన్షియల్ బయర్ కావాలి దట్ ఈస్ నాట్ సో ఈజీ ఓకే ఎస్ ఆర్ నో ఇర్రివర్సబుల్ సో లెట్ us take one more example. So Vinay he wanted to start a power project, thermal power project, power generated using coal or gas, thermal power project. So if he want to start a thermal power project, first he should purchase land. Thermal power project, land required or not? First he should buy land. Next what? Whether he will directly purchase plant and machinery or what? No. So first purchase of a land. Generally agricultural land will be purchased. Agricultural land. Whether agricultural land will be suited for heavy constructions or not? No. So second step is to what? Do leveling. Site leveling. Okay, site leveling. You can observe our site. The space opposite to our building, it is not leveled. If you want to start any construction, first site leveling has to be done. You can imagine. Okay, so okay, Vinay has done a site leveling, land acquired, agricultural land. Okay, site leveling has been done. After site leveling, next step is to buy plant and machinery or what? No. What is the next step? Construction. Before he proceeds for construction, first he should construct the boundary wall. He should construct boundary wall. Before starting a construction, first boundary wall has to be constructed. Why boundary wall? You might have seen Kalesha movie. Bus. What happened to bus? In Rajasthan, what happened to bus? The same thing happens. If you are not constructing a boundary wall, and if you are acquiring the materials which is required for construction, so people will, so ఏ సైడ్ నుంచి వస్తారో తెలీదు, people will take away the material. Yes or no? Public will take away the material. Are you getting my point? Okay, so people will take away the material. So that's why first construction of a boundary wall. After construction of a boundary wall, construction of a building. After construction of a building, then what? Purchase of a plant and machinery. Purchase of plant and machinery. Then the project will commence. As or no, this is the procedure. For suppose he acquired agricultural land, site leveling was done, boundary wall was constructed. Thereafter he felt that this capital bursting decision is not feasible. Capital bursting decision is not feasible. Not feasible means it will not work out. Whether it is irreversible or not. Whether it is irreversible or not. Boundary wall cannot be sold to someone. Okay, agricultural land, already site leveling was done. It cannot be used for agriculture also. Again, it cannot be used for farming. Yes or no? The best example for this is Amaravati capital. Agricultural lands were acquired, so thereafter they have started some work. Okay, and again the government has changed. Okay, so after the government has changed, they don't wanted to continue that capital work. Okay, so now the point is whether the decision already taken is irreversible or not. The government cannot give back the lands to the farmers. Why farmers cannot use those lands again? Yes or no? So the capital bursting decision is irreversible. Substantial amount of investment. Capital bursting decision antene substantial amount, ఎక్కువ amount, lot of amount will be invested, and difficulty in estimating the benefits. Difficulty in estimating the benefits. Difficulty in estimating the benefits. So when hit 3 is going to release? Hit 3, నాని హిట్ 3 May 1st. చదువుకోవట్లేదా? ఓకే, May 1st hit 3. Are you going to watch that movie? Are you going to watch that movie hit 3? So okay, so first thing, you do not have a clarity whether you're going to watch that movie or not. Yes or no? Okay, second point, okay, you're going to movie. Next question is whether you're going to purchase a popcorn or not. Popcorn or not? May or may not. In future, are you going to purchase a car or not? Are you going to purchase a car or not? When are you going to purchase a car? No clarity. Yes or no? But for suppose in PVR there is a finance manager, there is a cost accountant. He has to take a capital budgeting decision. He has to estimate a benefit to take a capital budgeting decision. Estimate a benefit. Theatre will get a benefit in the form of ticket revenue, snacks and advertisement. Yes or no? Now tell me, as a cost accountant, from the point of view of a theatre, you have to estimate what benefits. Okay, you do not have a clarity whether you're going to movie or not, whether you're going to watch hit 3 or not. Yes or no? You do not have a clarity whether you're going to purchase a popcorn or not. But on the other side, cost accountant has to estimate the benefit, how much the revenue the theatre is going to generate. Is it difficult or not? Yes. And you don't know when you are going to purchase a car, but the company which has constructed a road or which wanted to construct a road has to estimate the toll revenue. Has to estimate the toll revenue. Okay, you don't know when you are going to purchase a car. Yes or no? But on the other side, a cost accountant on behalf of a company has to estimate what? How much toll revenue this company is going to receive. Is that difficult or not? Yes. Okay, are you going to articles? Okay, are you going to join articles in Hyderabad or Chennai? You don't know, you do not have a clarity. But L&T Metro has to estimate how much revenue they are going to get out of ticket revenue. Is it difficult or not? Yes, difficult. It is not that easy. Okay, so capital bursting decision is very important because it involves substantial amount of investment. It is irreversible, difficulty in estimating the benefits, and long time period. Long time period. If you are investing money in metro rail project, so it will take time to recover the investment. So that's why before taking a decision, you have to be very careful. Okay, you should apply the relevant capital budgeting technique, capital bursting technique. And examples of capital bursting technique already discussed: purchase of new machinery, setting up of a new plant. Okay, setting up a new plant and mango ivadu, plant and machinery. Taking up of a new project, advertising and research. Phases in capital bursting decision. the stages. First stage planning, second stage analysis, planning, analysis, selection, implementation, and review. Review will be done at the end of the project. At the end of the project, review. So whether we have taken a right decision or a wrong decision. So that review will help you to take a next decision. That experience will help you to take a next decision. Okay. So total 5 stages. Next, different analysis for investment decisions. First one, financial analysis. So CFO, Chief Financial Officer, is concerned about financial analysis. In this chapter we are going to discuss about financial analysis only. Market analysis is not our job. Market analysis, whether people are going to come to theater or not, that is not our job actually. But these days we have to think that also. For example, due to OTT platforms, it is a question mark whether okay audience will come to the theater or not. Clear? And big heroes like Prabhas, okay fine, but other heroes, they are acting only in one film for every 3 to 4 years. That will affect theaters or not? Obviously it will affect theaters. If they are releasing one movie for every 3 years, then obviously it will affect theaters. More number of heroes are required, more number of films to be released. So then only theater will get a revenue. Okay. So market analysis is not done by the finance person. Okay. Technical analysis means, for example, for power project, water is necessary. For Coca-Cola company, if they want to manufacture water bottles or cool drinks, they require water. The main source is water. So technical team will come and check whether there are reasonable water resources or not. Technical analysis. Next, what? Environmental analysis means, for example, recently you might have seen Telangana news, Hyderabad Central University. Okay, so the land, okay, government wanted to give that land to a private people for construction of some software companies. Okay, so here it is affecting what? Environment. So the state might get monetary benefit, but what? Environmentally it will get affected. And next, what? Economic or social cost benefit analysis. So generally this will not be done by the companies. Social cost benefit analysis means, okay, company is getting benefit, what about the society? Okay, so we call it as negative externality. For example, Coca-Cola company, okay, monetary, Coca-Cola company is paying lot of taxes, that's fine, but what? At what cost? So the water is being snatched from the farmers and giving to the Coca-Cola company, and the irony is we are purchasing the water. So generally business is, first you have to create a fear. Your water contains okay fluorine. If you okay drink this water, your bones will get affected. That's how the fear will be created. And later on, what? They will start telling you have to consume what? Mineral water. We have got habituated to buy 1 liter water for rupees 20. That was normalized. That has been normalized. Okay, normalize అయిందా లేదా? కోకోకోలా కంపెనీ మనకి నార్మల్గా దొరికే వాటరే, ఓకే, నార్మల్గా మనకి ఎక్కడైనా దొరికే వాటరే ఏం చేశారు? దాన్ని ఏం చేశారు? అర్థమైందా మీకు? 20 రూపీస్కి ఏం చేస్తున్నారు? వాటర్ బాటిల్లో పెట్టి సేల్ చేస్తున్నారు, అది కూడా ప్లాస్టిక్లో. అది కూడా ఏంటి, ప్లాస్టిక్లో. బట్ స్టిల్ వీ గాట్ హ్యాబిచ్యువేటెడ్. సో దట్స్ ద బ్యూటీ ఆఫ్ అడ్వర్టైజ్మెంట్. అడ్వర్టైజ్మెంట్ ఎఫెక్ట్ అలా ఉంటుంది. మనం ఏదైనా కొనిపించవచ్చు, ఎవరిదైనా కొనిపించవచ్చు, ఏదైనా. అర్థం. ఫస్ట్ భయం క్రియేట్ చేయాలి. ఫస్ట్ ఏంటమ్మా, భయం. రోజుకు ఒక ఎగ్ తినాలి, తింటే యూ కెన్ కీప్ ద డాక్టర్ అవే. సో దట్ ఏమవుద్ది, పౌల్ట్రీ ఫార్మ్స్ వాటికి బెనిఫిట్ అవుతుంది. కరోనా వస్తే చికెన్ తినాలి, చికెన్ రేట్ పడిపోయింది అనుకోండి. కరోనా టైంలో సో స్టూడెంట్స్, ఐ మీన్ లాట్ ఆఫ్ పీపుల్ హ్యావ్ స్టాప్డ్ కన్స్యూమింగ్ వాటర్ చికెన్. వెంటనే ఏం చేశారు, టీవీ ఛానల్స్ అన్నీ కూడా, లేదా ఒక ఇద్దరు ముగ్గురు డాక్టర్లు చేంజ్ చెప్పేస్తారు, చికెనే తినాలంటారు. అర్థమైందా? అగైన్ పీపుల్ విల్ స్టార్ట్ వాట్, ఈటింగ్ చికెన్. అంటే ఇది ఏంటంటే బిజినెస్ మ్యాన్ ఏంటి, సింపుల్. ఏం చేస్తారు, అది టీవీ ఛానల్ వాడికి డబ్బులు ఇస్తే టీవీ ఛానల్ వాడు ఏం చేస్తాడు, డాక్టర్కి వస్తారు, వచ్చి ఏం చెప్తారమ్మా, సో తినాలి, చికెన్ తినాలంటారు, అయిపోయింది. సేల్స్ ఏమవుతాయి, ఇంక్రీజ్ అవుతాయి. సేల్స్ ఇంక్రీజ్. అర్థమవుతుందా? లైక్ వైజ్ ఇప్పుడు మన బింగో కానీ లేస్ కానీ ఇవన్నీ కూడా ఏంటి, ప్రిజర్వేటివ్స్. సో ఈట్ బిఫోర్ 6 months బిఫోర్ అంటారు కదా. సంక్రాంతికి చేసుకున్న జంతికలు 4-5 రోజుల్లో పాడైనప్పుడు, సో బింగోస్ అనేవి 6 months ఎలా ఉంటాయి, అన్లెస్ దే యాడ్ సమ్ కెమికల్స్. ఉంటాయా? ఉండవు కదా. మన ట్రెడిషన్స్ అన్నీ కూడా పూర్తిగా ఏంటి, పోయాయి, అన్నీ పోయాయి. ఇవిడేంటమ్మా మొత్తం వెస్ట్రన్ కల్చర్. సో అన్నిట్లో ఏంటి, ప్రిజర్వేటివ్స్ ఉంటాయి, ఉండవా? ప్రిజర్వేటివ్స్ ప్రతి దానిలో ప్రిజర్వేటివ్స్ ఉంటాయి. ఓకే, అది ఎలా హ్యాబిచ్యువేట్ అయింది మనకి, అడ్వర్టైజ్మెంట్. అది ఎలా హ్యాబిచ్యువేట్ అయిందంటే బికాస్ ఆఫ్ అడ్వర్టైజ్మెంట్. సో అడ్వర్టైజ్మెంట్కి ఉన్న పవర్ అది. అర్థమైందా? సో నెక్స్ట్ ఇదేంటమ్మా, ఇంట్రొడక్షన్ టు ఇన్వెస్ట్మెంట్ డెసిషన్స్. నెక్స్ట్ టాపిక్, నౌ కమ్ టు ప్రాబ్లమాటిక్ పార్ట్. సో financial analysis. We are concerned about what? Financial analysis. Financial analysis. Okay, so now tell me, financial analysis. Okay, I will take one example, only one example. I will take one example, and with one example we shall cover all the methods. Okay, you should understand that example clearly. Okay, let us purchase a bus. Let us purchase a bus. Okay, purchase of a bus is a capital budgeting decision or not? Capital budgeting decision. Okay, capital budgeting decision. Okay, for example, Sanjay, he wanted to start a food truck. He wanted to sell breakfasts outside BCCA campus. Is this a capital bursting decision or not? No. Food truck vehicle will have a life more than 1 year. Life more than 1 year. Adodna, life more than 1 year. Is it a capital bursting decision or not? It is a capital bursting decision. Okay, so food truck స్టార్ట్ చేస్తే దట్ ఈస్ అ క్యాపిటల్ బర్స్టింగ్ డెసిషన్. కార్తిక్, హీ స్టార్టెడ్ అ లాస్ట్ జర్నీ బిజినెస్. సేమ్ ఫుడ్ ట్రక్ సంజయ్ వాడేసుకున్న తర్వాత అదే ట్రక్లో ఏంటమ్మా, లాస్ట్ జర్నీ, వే టు హెవెన్. శవాల బండి స్టార్ట్ చేశాడు. whether it is a capital bursting decision or not? Yes, that is also a capital bursting decision. That vehicle will have a life more than 1 year. They will not expect speed. Vehicle speed కి వెళ్ళాలని ఎక్స్పెక్ట్ చేయరు కదా. ఎక్స్పెక్ట్ చేస్తారా? అలా ఏం లేదు కదా. సో అండ్ దట్ బిజినెస్ మీకు అర్థమైందా, లాస్ట్ జర్నీ బిజినెస్. సో స్టార్టెడ్ బై కార్తిక్. ఇట్ ఈస్ ఎ క్యాపిటల్ బర్స్టింగ్ డెసిషన్ ఆర్ నాట్? ఎస్, క్యాపిటల్ బర్స్టింగ్ డెసిషన్. ఓకే, జనరలీ పీపుల్ విల్ నాట్ బార్గెయిన్. అక్కడ బార్గెయిన్ కూడా చేయడానికి స్కోప్ ఉండదు. బార్గెన్ చేయడానికి కూడా ఎక్కువ స్కోప్ ఉండదు. సో అది కూడా ఏంటమ్మా క్యాపిటల్ బర్స్టింగ్ డెసిషన్. ఓకే, ఓకే. సో capital bursting decision. Purchase of bus is a capital bursting decision. Purchase of vehicle by Karthik is a capital bursting decision. Yes or no? So he will be getting a benefit for more than 1 year. Benefit for more than 1 year. So let us take a practical example. Let us buy a bus. Okay. Bus cost 30 lakhs. Already inquired. Note down the example. Bus cost bus cost 30 lakhs. Dilip. Bus cost 30 lakhs. Okay. So let us assume we are operating this bus to carry MEC students who are coming from nearby villages. Nearby villages. Are we going to collect fees or not? We are going to collect fees. Okay. So bus cost 30 lakhs. Capacity. First, we should ask for capacity, yes or no? Before purchasing this bus for rupees 30 lakhs, before deciding, first we should know the capacity, right? Because based on capacity only, we are going to collect fee. Capacity. So, okay, capacity, let us assume capacity is equal to 40. Capacity is equal to 40. Capacity 40. Okay. So we are going to collect what? Okay, bus fee. Bus fees. Okay. So first, before taking any investment decision, first you should know how to identify the benefit. We should be able to identify benefits. So what benefit BCCA is going to get from this bus? Fees. Fees collected from students. How this fees is determined? By using service costing. We have learned in cost accounting. Cost accounting, service costing, driver salary, cleaner salary, repairs and maintenance, toll taxes if any. We do not have any toll tax, but still permit fee, diesel cost, okay, depreciation, insurance, all these expenses we take it and we add profit, and then what? Okay, so divide with number of our students. That's how we determine the fee. Are you getting my point? Okay. So fee is determined using what? Service costing. Service costing. Okay. So let us assume the fee collected from each student is equal to 1000 rupees. Okay. So 1000 rupees per month. So 40 into 1000 into 40 into 1000 into how many months? 10 months. MEC students. MEC students, only college will be run for 10 months. So 4 lakhs. Yes or no? So let us take income statement. Income statement. Income statement. Particulars amount. Particulars amount. So tell me, the benefit is fee. 40 students into 1000 into how many months? 10 months. This is how I estimate what? Revenue. So fees collected 4 lakhs. Fees collected 4 lakhs. Okay. Let us assume 2 trips. We are doing how many trips? 2 trips. If we are doing 2 trips, then what? The amount is 8 lakhs. 8 lakhs is the fees collected. Done. Fees collected 8 lakhs minus variable cost. Let us assume variable cost is equal to 3 lakhs. Diesel comes under what? Variable cost 3 lakhs. And how can we estimate this diesel cost? Based on the distance, mileage. So can we reasonably estimate this or not? Yes, 3 lakhs. Now you will get contribution. 5 lakhs is the contribution. 5 lakhs is the contribution. The next step is what? Fixed cost. Next step is fixed cost. Fixed cost generally what? Insurance, driver's salary, cleaner's salary, all this. Cash fixed cost. Let us consider cash fixed cost. Let us assume fixed cost is just 1 lakh. But generally it will be more than 1 lakh. Because no driver will be taking only 10,000. Okay. Even though he is not working for next 2 months, we should pay salary for entire 12 months. Yes or no? But I am taking only 1 lakh. Now this is known as what? EBIT. Generally it is called as earnings before interest and tax. But here we call it as cash inflow before tax or profit before depreciation and tax. 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 So clear? So okay, imagine, visualize. We collected 8 lakhs from students, paid 3 lakhs in petrol bunk, paid 1 lakh to drivers. What is the net cash flow? 4 lakhs. Net cash flow 4 lakhs. Now, is this the final cash flow? This is not the final cash flow. Why it is not the final cash flow? Because the reason, assessing officer Ravi sir will come and ask for tax. You bought a bus, you got an extra revenue, you have to pay tax. Yes or no? Corporate tax. So that's why I have to pay tax. Let us assume tax rate is equal to 30%. Am I going to pay 30% tax on this 4 lakhs? No, because I am also a chartered accountant, right? So next my question is, depreciation is an allowable expenditure. This 4 lakhs is not by taxable income. Yes sir, I agree with you. So I have bought the bus and my income has got increased, but at the same time depreciation is also there. Depreciation. Okay. And the depreciation is an allowable expenditure. Allowable expenditure. So let us assume life of a bus is equal to 15 years. New bus life will be 15 years. And let us assume the salvage value. Salvage value is equal to 3 lakhs. Salvage value is equal to 3 lakhs. Okay. So whether I am going to pay tax directly on 4 lakhs? No. So that is not correct, because due to purchase of a bus, my depreciation is getting increased, and the depreciation is an allowable expenditure. So that's why minus what? Depreciation. What is the depreciation calculation? 30 lakhs minus 1 lakh 80,000. This is called as profit before tax. Profit before tax. 2,20,000 is the profit before tax. Apply the logic. Why we are reducing depreciation? Because depreciation is allowed as an expenditure. Next, minus what? Tax. At the rate of 30%, 60,000, 66,000. So the profit after tax 1,54,000. Profit after tax and depreciation. This is called as profit after tax and depreciation because already tax reduced, already depreciation was also reduced. But generally we call it as PAT, profit after tax. But already depreciation was also reduced. PBDT means profit before reducing depreciation and tax. So clear? So how much cash I will be having? 1,54,000? No. I should add back depreciation. Why I should add back the depreciation? That is a non-cash expenses. Why I reduced? For the purpose of calculation of a tax. I should reverse it back. So that's why add depreciation. What is the depreciation amount? 1,80,000. So then you will get 3,34,000. So this is cash inflow after what? Cash inflow after tax. Cash inflow after tax. If a tax amount is directly given, then straight away 4 lakhs minus 66,000. For suppose if tax amount is directly given in the question, then what I can do directly? 4 lakhs minus 66,000, then I will get 3,34,000. Are able to understand this? Initially, my outflow. Initially, my cash outflow is equal to. Initially, my cash outflow is equal to how much? 30 lakhs. Bus cost is 30 lakhs. Yes or no? So 30 lakhs is my cash outflow. I am going to get a cash inflow of 3,54,000 every year for how many years? 15 years. 15 years I am going to get a benefit of a 3,54,000 for 15 years. Clear? So let us find out NPV, net present value. Calculation of net present value. Calculation of net present value. Year cash flow PVAF slash PVF at the rate of 20%. What is this 20%? Initially I told, let us assume the cost of a capital is equal to 20%. Minimum return required to be earned by the company to meet the expectation of investors. Investors' required return is 20%. Okay. Now tell me, what is the benefit we are going to get from the bus? 1 to 15 years. I am going to get a benefit of 3,34,000. 3,34,000. Present value annuity factor. 1 to 15 years, 3,34,000 means equal or not equal? Equal. Annuity. Yes or no? So annuity means we multiply with PVAF. 1 divided by 1.2 equal to how many times? 15 times grand total. Annuity regular. 4.675. So 3 34,000 into 4.675. 15 lakh 61,000 608 608. Clear? Is there any other benefit I'm going to get? Yes. At the end of 15th year, if I sell the bus, I can receive 3 lakhs. Scrap value 3 lakhs. I should bring that 3 lakhs to the present value. 3 lakhs to the present value. What is the factor? 1 divided by 1.2 equal to 15 times 0. 0 point 0.066 0.06 49. Discounted cash flow 19,471 472 total 15 lakh 81,018. So the answer is, sum of a discounted cash inflow. We call it as a sum of a discounted cash inflow. Be careful, this is sum of discounted cash inflow. Cash inflows are discounted. Discounted means brought to the present value, and sum, we added everything, yes or no? So that's why this is called as sum of a discounted cash inflow. 15 lakh 81,000 0 1581 080. So first understand this concept. If I purchase a bus for rupees 30 lakhs, I'm going to get a benefit of 3 lakh 34 for 1 to 15 years, and at the end of a 15th year I'm going to get a benefit of 3 lakhs. Okay, what is the, so whether I can multiply with 15 or what? 3 lakh 34,000 into 15, can I do that? Can I do that as? No. Why I cannot do that? Because present 1 rupee is not equal to future 1 rupee. We should bring the future benefit to the present value. Do you remember value of any asset? I have told yesterday, value of any asset is equal to present value of a future economic benefit. Any asset. Here it is bus. In the other question it might be plant and machinery. For Karthik it might be a vehicle. For Sanjay it might be a food truck. Okay. So value of any asset, okay, is equal to present value of a future economic benefit. We bring the future economic benefit to the present value using required return, and that required return is calculated in cost of a capital chapter. Okay, required return calculated in cost of a capital chapter. Okay, so this 15 lakh 81,080 is the value of a bus in our perception. Value of a bus in our perception. So, but bus cost is sum of a discounted cash outflow. Bus cost is 30 lakhs. Net present value negative 14 lakh 18,920. 14 lakh 18,920 is the net present value. Now tell me, NPV positive or negative? So now tell me whether purchase of bus is feasible or not. Not feasible. Whether it will work out or not. It will not work out. It will not work out. For us, it will not work out. For us, it will not work out. Okay. But for suppose if the other person or other college, they are having a 4 trips or 3 trips, they are having a 3 trips. So then what happens? 3 trips, then 40 into 1000 into 10 into 3, 12 lakhs. So variable cost will be the same proportion, right? For 8 lakhs it is 3 lakhs. For 12 lakhs it is 4 lakh 50,000. So 12 lakhs minus 4 lakh 50. 7 lakh 50,000. 7 lakh 50 minus 1 lakh. 6 lakh 50,000 minus what? 1 lakh 80. 6 lakh 50 minus 1 lakh 80. 4 lakh 70,000. 4 lakh 70,000 minus 30% tax. 3 lakh. What is that? 3 lakh 29,000. Profit after tax. Directly profit after tax. 3 lakh 29. For 3 lakh 29 add depreciation 1 lakh 80. 5 lakh. So 5 lakh 9,000. Instead of 3 lakh 34, you should take 5 lakh 9,000. So 5 lakh 9,000 into 4.675. 20 lakh. Still the bus is not feasible. Yes or no? For suppose if a bus is doing 4 rounds, 4 trips, then it might be feasible. Okay. Or if required rate of a return is not 20%, instead of working out on bus, we have worked out on sources of funds. We have minimized the cost of our capital. We have minimized the rate of interest. We have minimized the expectation of equity shareholders. We have changed our capital structure. We have changed our capital structure and we have reduced our required rate of return to 10%. Let us assume it has been reduced to 10%. Then tell me what is the answer? 3 lakh 34 into 1 divided by 1.1 equal to how many times? 15 times. Zero point 15th factor, 15th year factor, 0.0 10%. I'm telling that cost of a capital has been reduced to 10%. 0.239. What about PVF? Grand total 1 divided by 1.1 is equal to 15 times grand total. What is PVF? 7? 7.60? 7.606. Clear? So now what is the sum of a discounted cash inflow? 3 lakh 34 into 7.606. So what is the answer? 30? 25 lakh 40,000 404. Value is increasing, right? Why the value is increasing? Because required return decrease, so the value increases. If a required rate of return is 10% and if a bus is doing 3 trips, then this purchase of bus might work out. Clear? So straight away we have discussed net present value, discounting technique, one of the discount technique, popular technique, NPV, Net present value. How do we get net present value? Sum of a discounted cash inflow minus sum of a discounted cash outflow. If it is negative, reject the proposal. If it is positive, accept the proposal. If it is zero, may or may not. Okay. So simple common sense in our perception. We are going to get a benefit of 15,81,080 rupees from bus. But whereas the bus cost is 30 lakhs, it is not feasible to purchase. Clear? So you have to learn how to identify the benefit. How to identify the benefit. So Karthik business, what is the benefit he is going to get? Same procedure. He also will be collecting a fee. He also will be collecting a fee. Yes or no? On an average 1. On an average 1. 5,000 rupees per day. Okay. Let us assume in a month only 20. Let us consider only 20. So 20 into 5,000. 1 lakh. 12 months. 12 lakhs. 12 lakhs. Okay. So from 12 lakhs, we should reduce what? Variable cost. Variable cost. Okay. Variable cost, and then what? Fixed cost. So then what? Again, profit before depreciation and tax minus depreciation. Profit before tax minus tax. Again the same procedure. Likewise, Sanjay will be getting a revenue. Food truck. He will sell dosa, idli, yes or no? So estimation again. How many dosas he is going to sell? Estimate. Okay. At what price he is going to sell dosa? How many plates of idli he is going to sell? And price. Revenue. Minus what? Variable cost. Contribution. Minus fixed cost. If it is an aircraft, again same. Aircraft is also the same procedure. Okay. So whether it is a large journey bus or aircraft, that doesn't matter. Everything the same procedure. Benefit minus variable cost, contribution minus fixed cost. Clear? Done. So capital bursting decision may give a benefit in the form of increase in sales. Increase in sales. First category. If you are taking a capital bursting decision, that might increase your sales. For this, further this is the format. Second, it might save cost. For example, some capital bursting decisions might save cost. Example, you are replacing a old machine with new machine. Replacing old machine with new machine. Same capacity. Sales are not going to increase, but your repair cost will get reduced. For example, earlier repairs and maintenance 2 lakhs. Right now, the repairs and maintenance cost is only 1 lakh. So the repairs and maintenance cost will get reduced by 1 lakh. The benefit we are going to get from that machine is what? 1 lakh. Okay. Clear, Ganesh, Mahatma? So clear? Ardhavainda? So whether it is aircraft or whatever, it doesn't matter. So capital bursting decision will give a benefit in the form of increase in sales, first one. Or second one, what? It might reduce cost. It might reduce cost. Cost will be reduced. For example, generally new machines will have a less repairs and cost. Old machine will have a high repair and maintenance cost. Clear? Okay. So there are other methods also. Let us discuss after break. Okay. So sit 5 minutes here and take break at 9. Okay. So NPV is equal to sum of a discounted cash inflow minus sum of a discounted cash outflow. Okay. So first we have a non-discounting techniques and discounting techniques. Discounting and non-discounting techniques. So first write down non-discounting techniques. Non-discounting techniques. So non-discounting techniques, the first one, payback period. Payback period. Payback period is the time taken for recovery of a initial investment. Payback period. For example, in this question, payback period is equal to initial investment divided by annual cash inflow. Initial investment divided by annual cash inflow. So that is equal to, what is the initial investment? 30 lakhs divided by 3 lakh 34,000. 30 lakhs divided by 3 lakh 34,000. So the answer is 18 point 8 point, what is this 8.982? So the initial investment we are able to recover in how many years? 8.982 years. In 8.982 years we are able to recover our initial investment. So payback period, time taken for recovery of a initial investment. So we select a project which is having a lower payback period, because everybody wants to recover their investment as early as possible. So that's why investors, okay, so select a project which is having a lower payback period. So payback period means time taken for recovery of a initial investment. So this is a non-discounting technique because we are not discounting the cash flows. We are ignoring the time value of our money. The biggest drawback of this method is, okay, we are ignoring the time value of our money. So this method is useful where there is a high technological obsolescence. So technological obsolescence means change in technology. Obsolescence means a change in technology. So where the technology changes fast, there we use payback period. So we have to recover our investment early. Okay. For example, in case of mobiles, technology is changing fast. So in case of softwares also, generally technology changes fast. Okay. So there we use what? Payback period. So payback period means time taken for recovery of a initial investment. The biggest drawback is we ignore time value of our money. So in this question, what is the payback period? 8.982 years. Time taken for recovery of initial investment. Okay. So the next method, payback reciprocal. Payback reciprocal. Payback reciprocal. Payback reciprocal, page number 8.2 already given. Payback reciprocal. So payback reciprocal means nothing but 1 divided by payback period. 1 divided by payback period. Exactly reverse. Annual cash inflow divided by initial investment, or else 1 divided by 8.982. It is a rate of a return. It is a rate of a return. So clear. So payback period reciprocal. Payback reciprocal means simple. 1 divided by payback period. So we select a project which is having a less or higher, high payback reciprocal. Reciprocal, I'm talking about reciprocal. In case of payback period, we select a project which is having a lower payback period, whereas payback reciprocal, we select a project which is having a higher payback reciprocal. Higher payback reciprocal. Next, payback profitability. Next one is payback profitability. Payback profitability. All these are not practically used generally because we are ignoring time value for money. These are non-discounting techniques. Pay back profitability. Payback profitability. So payback profitability means simple. For example, in this question, so total inflow is equal to, what is the total inflow? 3,34,000 into 15 plus salvage value 3 lakhs minus what? Our investment outflow 30 lakhs. Nothing but total net cash inflow minus initial investment. Total net cash inflow minus initial investment. Here the total net cash inflow is equal to overall final amount. Final amount is equal to 23 lakh. 23 lakh 10,000 is the payback profitability. It is payback profitability. Clear? So 23 lakh 10,000 is the payback profitability. How do we get payback profitability? Total cash inflow minus what? Initial investment. Again, the biggest drawback is what? Time value of money. We ignore time value of money. So this is payback profitability. Clear? Next, ARR, average rate of a return. Average rate of a return. So average rate of a return is equal to average profit after tax divided by initial investment. Average profit after tax divided by initial investment. 2 and 4 are similar. What is 2? Payback reciprocal. How do we get payback reciprocal? 1 divided by payback period. Nothing but annual cash inflow divided by initial investment. Here instead of annual cash inflow, we are taking profit after tax. If you are taking average profit after tax, then it is ARR. ARR, average rate of return, average profit after tax divided by initial investment. So we compare this ARR with cost of a capital, and if ARR is greater than cost of a capital, accept. If ARR is less than cost of a capital, reject. Reject the proposal. So these are the 4 non-discounting techniques, so which are not practically used, because we have to consider time value of money. We have to consider time value of money. So clear? We have to consider what? Time value of money. Okay. So these are non-discounting techniques. Clear techniques. And for ARR, we can use the alternative formula. That is average profit after tax divided by average investment. Or you can take average profit after tax divided by net investment. Average profit after tax divided by net investment. ARR, average rate of a return, is equal to average PAT divided by initial investment or average investment or net investment. Clear? Done? So these are what? Non-discounting techniques. Non-discounting techniques. So in this question, what is ARR? What is the average profit after tax? Profit after tax. 1 lakh 50 1,54,000 divided by what? 30 lakhs. 0.0, nothing but 5.13% ARR. We compare this ARR with what? Cost of a capital. If ARR is greater than cost of a capital, accept, otherwise reject. But the biggest drawback of this all four methods is we are not considering time value of a money. Present 1 rupee have a more value than a future 1 rupee. Okay, so these are the non-discounting techniques. Clear? Okay, and there are other drawbacks also, but the most important drawback is we ignore what? Time value of money. So clear? And payback period, one more drawback is we ignore the cash flows arising after payback period. For example, project Abhi, payback period 4. Project Abhi, payback period 4. Okay. Project Sonia Gandhi, payback period 3 years. Payback period 3 years. Which project are we going to select? Project Sonia or Project Abhi? Project Sonia, because payback period is 3. We select a project which is having a lower payback period. But example, so payback period is 4, Project Abhi. That means we are able to recover investment in how many years? 4 years. But in 5th year we are going to get 100 crores. Still we select what? Project Sonia. Because in payback period we select a project which is having a lower payback period. We ignore the cash inflows after payback period. So after payback, that means after 4 years we are getting 100 crores. That is irrelevant. 2000 crores. No. We are not considering the cash flows after payback period. We see only how early are we recovering our investment. Okay, so that is the drawback for payback period. Okay, so these are the non-discounting techniques. So clear? Next, discounting techniques. Discounting techniques. Discounting techniques. So discounting techniques. So discounted payback period. Discounted payback period means the only difference between the payback period and discounted payback period is instead of normal cash flows, under discounted payback period we consider discounted cash flows. We consider discounted cash inflows. Are you getting my point? Instead of normal cash flows, we consider what? Discounted cash inflows. Normal cash flows are different from discounted cash flows. Discounted cash flows means cash flows into present value factor. Cash flows into present value factor. Okay. The next method, net present value. How do we get net present value? Net present value. Net present value is equal to sum of a discounted cash inflow minus sum of a discounted cash outflow. Sum of a discounted cash inflow minus sum of a discounted cash outflow. So that we have already done, yes or no? NPV, net present value. So in NPV we are considering time value for money. Under discounting payback period also we are considering time value for money. So if NPV is positive, accept the project. If NPV is negative, reject the project. If NPV is equal to 0, may or may not. May or may not. Okay, clear? May or may not. So done. So may or may not. So this is NPV. Next, profitability index. Next one is profitability index. So profitability index profitability index is equal to sum of a discounted cash inflow divided by sum of a discounted cash outflow. Sum of a discounted cash inflow divided by sum of a discounted cash outflow. For example, in this case, what is the sum of a discounted cash inflow? 15 lakhs. In our example, what is the sum of a discounted cash inflow? 15 lakhs. 81,080 divided by sum of a discounted cash outflow 30 lakhs. So profitability index is equal to 0.52. So profitability index is a ratio. Profitability index is a ratio. So what is the meaning of this 0.527? For every 1 rupee investment, for every 1 rupee investment, we are able to get only 0.527 rupees. For every 1 rupee investment, we are able to get only 0.527 inflow. Okay, so are we going to accept the project or not? No. Why? Outflow 1 rupee, inflow 0.527. So nothing but in case of profitability index, if a profitability index is greater than 1, accept. If a profitability index is less than 1, reject. If a profitability index is equal to 1, accept or reject. Profitability index is equal to 1. What does that mean? 1 rupee outflow, 1 rupee inflow. No profit, no loss. Accept or reject. Profitability index is equal to 2. Profitability index is equal to 2. Then what? So then accept. Because outflow 1 rupee, inflow 2 rupees. Inflow 2 rupees. So this is what profitability index. Clear? Profitability index. Okay. And next one, IRR, internal rate of a return. Internal rate of a return, IRR. Before moving on to IRR, let us see the question number 1. From the following information, calculate net cash flow after tax. Already profit after tax is given, right? So what is the statement? Sales minus variable cost, contribution minus fixed cost, profit before depreciation tax. We call this 2 lakhs as a profit before depreciation and tax. Sorry, after depreciation. After depreciation. Okay. So minus what? Tax. We are not going to reduce interest. Because why we are not considering? Because already in cost of a capital, we have considered a cost of a debt. We have already considered cost of a debt. So that's why here we should not consider. So that's why EBIT 2 lakhs minus what? Tax at the rate of 30%. 60,000. Apply the tax rate again. So 1 lakh 40, add depreciation, add back depreciation. 2 lakh 40,000. So are you able to understand that PBDT, profit before depreciation and tax? Okay. What about next one? See the next one. Pioneer Limited is considering 2 mutually exclusive projects. In capital bursting, we have a concept of capital rationing. Capital rationing. HM, fans of GM. So capital rationing situation. Capital rationing. Capital rationing means limited funds, unlimited opportunities, but limited funds. Unlimited opportunities, but what? Limited funds. Limited funds. For example, Prasu, he went for shopping. He liked 100 pairs. Okay, but amount is available only for 1 t-shirt. This situation is called as capital rationing situation. everybody face this situation. Yes or no, Gautami? What is the situation? Tell me. Okay, Prashu. Okay. So this is what capital raising situation. Likewise, there are 5 profit making projects. There are 5 profit making projects, but we could invest only in 2 projects. Amount is limited. So this is known as what? Capital rationing situation. Capital rationing situation. Karthik. Capital rationing situation. So for example, Karthik engagement. Okay. So went to that girl's house. So first they offer what? Sweets, right? Sweets offer చేస్తారు కదా. Okay. For example, Karthik is having an unlimited capacity. Okay. So 10 varieties of a sweets were offered. So 10 varieties of a sweets were offered. Okay. 2 he doesn't like. 8 he likes. Unlimited capacity. So what he is going to do? He is going to accept 8, reject 2. Nothing but he will take an accept reject decision. He will take an accept reject decision. నచ్చినవన్నీ తింటాడు, 8 తింటాడు, 2 ఏంటమ్మా వదిలేస్తాడు. అదేంటి సార్ అన్లిమిటెడ్ కెపాసిటీ కదా. అన్లిమిటెడ్ కెపాసిటీ అయినా నచ్చనివి ఎందుకు తింటాం? తినరు కదా. అర్థం అవుతుందా? సో అలాగే ఇక్కడ మన దగ్గర డబ్బులు ఉన్నాయి, అన్లిమిటెడ్ ఫండ్స్ ఉన్నాయి. అన్లిమిటెడ్ ఫండ్స్. దెర్ ఆర్ 10 ప్రాజెక్ట్స్, 2 లాస్ మేకింగ్, 8 ప్రాఫిట్ మేకింగ్. So are we going to accept all the 10 or only 8? We accept only 8, reject 2. Yes or no? Unlimited money you have. షాపింగ్కి వెళ్ళారు, 100 pairs చూసారు, 80 నచ్చాయి, 20 నచ్చలా. ఏం చేస్తారు? 100 కొంటారా? 100 కొని ఎల్లో షర్ట్, బ్లూ ప్యాంట్, రెడ్ షూ, ఆల్ పార్టీస్ కవర్డ్, బుడబొక్కలోడు అంటారు. సో ఓకే. సో ద పాయింట్ ఈజ్ అట్లా ఉంటుందా? లేదు కదా. యాక్సెప్ట్ రిజెక్ట్ డెసిషన్. ఈవెన్ వెన్ యూ హ్యావ్ అ అన్లిమిటెడ్ ఫండ్స్, ఈవెన్ వెన్ యూ హ్యావ్ అ అన్లిమిటెడ్ ఫండ్స్, యూ టేక్ వాట్? యాక్సెప్ట్ రిజెక్ట్ డెసిషన్. యూ యాక్సెప్ట్ ఓన్లీ ప్రాఫిట్ మేకింగ్, రిజెక్ట్ లాస్ మేకింగ్ ప్రాజెక్ట్స్. సో దిస్ ఈజ్ కాల్డ్ యాజ్ యాక్సెప్ట్ రిజెక్ట్ డెసిషన్. మ్యూచువల్లీ ఎక్స్క్లూజివ్. మ్యూచువల్లీ ఎక్స్క్లూజివ్. మ్యూచువల్లీ exclusive. For example, Dharmateja, he went for engagement. Okay. So they offer 10 varieties of sweets. He liked 8. He liked 8. He doesn't like 2. His capacity is only 1 sweet. Then what? He will be selecting 1 out of 8. Okay. Arsila. He will be having a, so most liked sweet, yes or no? So nothing but if he accept 1 sweet, he reject other 7. So other 7, why he is rejecting? He liked the other 7 also, but why he is rejecting? Because he is accepting 1. If he accept 1, he has to reject other 7. This type of a decision is called as mutually exclusive decision. Exclusive. So 8 profit making projects are there, but we can accept only 1 project because limited funds. So out of 8 we accept most profit making project. So this decision is called as mutually exclusive decision. So Pioneer Limited is considering 2 mutually exclusive projects. 2 mutually exclusive projects. Nothing but if I accept 1, I have to reject other 1. Both require an initial cash outlay of rupees. Both require an initial cash outlay of rupees 10,000 each for machinery and have a life of 5 years. Next, Both require an initial cash outlay of rupees 10,000 each for machinery. 10,000. Have a life of 5 years. Life of a machine 5 years. The company's required rate of return is 10% and it pays a tax at 50%. The project will be depreciated on a straight line basis. The net cash flows before tax. Net cash flows before tax. Cash flows before tax means profit before depreciation and tax expected to be generated by the projects. The present value factors at 10% are as follows. Project 1 2017 cash flow 4,000, 4,000, 4,000, 4,000, 4,000. Project 2 6,000, 3,000, 3,000, 5,000, 5,000. You are required to calculate payback period of each project. Payback period of each project. Okay. Shall we find out payback period? Payback period. So project 1. Calculation of payback period for project 1. చెప్పమ్మా ఏదో చెప్పాలనుకుంటున్నావు పోలందేవి నువ్వే క్యాలిక్యులేషన్ ఆఫ్ క్వశ్చన్ నెంబర్ 2 కదా క్వశ్చన్ నెంబర్ 2 క్యాలిక్యులేషన్ ఆఫ్ ఏం కావాలంట పేబ్యాక్ పీరియడ్ ధర్మతేజ నోట్స్ రాస్తున్నావు కదా ఫస్ట్ టైం ఎలా ఉంది ఫీలింగ్ చేతులు పట్టేస్తున్నాయా calculation of a payback period in that first one project so you might do a mistake subconscious mind so the amount given here is cash flow before tax cash flow before tax yes or no so we should take what cash flows after tax particulars amount in particulars Vasant Vallavaraya particulars amount particulars profit before depreciation tax what is the profit before depreciation tax 4,000 minus what depreciation what is the asset cost 10,000 is there any salvage value no divided by 5 2,000 4,000 minus 2,000 calculator వాడితే శిరీష okay so 2,000 what is this 2,000 hero na Ashwanda 2,000 profit before tax minus what at the rate of 1,000 profit after tax plus depreciation very good Mahesh 2,000 3,000 is the annual cash inflow okay now ఎవరమ్మా పోలందేవి నేను కాదన్నా అంటే నువ్వు ఫిక్స్ అయిపోయా వేరేకి సరే ఓకే పేబ్యాక్ పీరియడ్ పేబ్యాక్ పీరియడ్ ఈజ్ ఈక్వల్ టు ఇనీషియల్ ఇన్వెస్ట్మెంట్ 10,000 divided by annual cash inflow initial investment divided by annual cash inflow Manisha what is the answer 3.33 years 3.33 years 3.33 years to be more specific 3 years so సో 3 years 3 months 3 days రాస్తారు కొంతమంది మహానుభావులు. నాట్ కరెక్ట్. 3 years 0.33 years means 0.33 years. శిరీష రాసావా? 0.33 years. 0.33 years means to convert these years into months we should multiply with 12. 1 year is equal to 12 months. So 3 years, how many months? 0.33 into 12, 4 months. Clear? Done? Karthik? So this is project 1. Let us start what? Project 2. Project 2. Project 2. Project 2. So this time what? Cash inflows, I mean cash flow before tax, even or uneven? If they are even, I will take single column. Uneven means I should take particulars and 5 columns. Particulars year 1, year 2, year 3, year 4, year 5. In particulars, cash flow, sorry, profit before depreciation tax, nothing but cash flow before tax. 6,000, 3,000, 3,000, 5,000, 5,000. Less what? Depreciation. Very good, HM. Tell me, depreciation. 2,000. Straight line method, every year same depreciation. They might give return on value. For suppose if depreciation is return on value method, for the project 1 also, we should take particulars and 5 columns because depreciation is not same for every year. Okay. So 2,000, 4,000. నిన్న చెప్పాను కదమ్మా 90 years నా అలాంటి ఆన్సర్లు రావు. Depreciation minus depreciation. Okay. PD. Profit before tax 4,000, 1,000, 1,000, 3,000, 3,000. Minus what? Tax. What is the tax rate? 50%. 2,500, 1,500, 2,500, 500, 1,500. What is this? This is profit after tax. Add depreciation 2,000. So annual cash inflow 4,000, 2,500, 2,500, 2,000, 3,500, 2,000, 3,500, 3,500. So clear? So this is what annual cash inflow. So when cash inflows are even, we use the formula initial investment divided by annual cash inflow. Okay, but here cash flows are not even. Cash flows are not even. Cash flows are not even. So that's why we should add one more row. Generally we take column, but here So for convenience, we are take cumulative cash inflow. What? Cumulative cash inflow. Payback period means time taken for recovery of an initial investment. Time taken for recovery of initial investment. By the end of first year, we are able to recover 4,000. By the end of first year, we are able to recover 4,000. By the end of second year, we are able to recover 6,500. 6,500. By the end of a third year, we are able to recover 9,000. By the end of a fourth year, we are able to recover 12,500. 16,000 not required. Why? Because our investment is 10,000. So that is not relevant. Okay. So our investment is being recovered between third year and fourth year. That means payback period is greater than 3 years, less than 4 years. Clear? So payback period is equal to 3 years plus. So by the end of 3 years, we are able to recover 9,000. What is the balance to be recovered? 1,000. 180. So 3 years plus 3 years plus balance to be recovered 1,000. So this 1,000 has to be recovered in fourth year. But whereas in fourth year we are able to recover 3,500. Now we should question for 3,500 1 year, right? So for 1,000, what is the time we are going to take for recovery? Nothing but calculation is 3 years plus balance to be recovered 1,000 divided by amount recovered in fourth year, that is 3,000 into 1. So the answer is 0.285. 3.285. 3.285 years. To be more specific, 3 years. 0.285 years means 0.285 into 12. 3.4. 3.4 means 3 months. 0.4 months convert into days. To convert 0.4 months into days, multiply 0.4 with 30 days. 12 days. So the time taken for recovery of initial investment is 3 years, 3 months, 12 days. Clear? 3 years, 3 months, 12 days. So this is how we do. We calculate payback period when the cash flows are uneven. Cash flows are uneven. Clear? Done? Next, see the third one. A project with an initial investment of rupees 50 lakhs, live for 10 years, generates a cash flow after tax of rupees 10 lakhs per annum. Calculate payback reciprocal. Payback reciprocal means annual cash inflow divided by initial investment. That is 10 lakhs divided by 50 lakhs. What is the answer? 20%. Payback profitability means total cash inflow minus initial investment. What is the total cash inflow? 10 years into 10, 100 lakhs minus 50 lakhs is equal to 50 lakhs. Clear? Simple one. Next, see the fourth one. Determine ARR from the following data for two machines A and B. ARR. How do we get ARR? Average profit after tax divided by initial investment. Initial investment. So how do we get average profit after tax? Year 1, annual estimated income after depreciation and income tax. After income tax, that means that is profit after tax. Sanjay. So year 1, 2, 3, total is also given. So average is equal to 36,875 divided by 5. 7,375 is what? Average profit after tax. Okay. Next what? Average investment. Average investment means opening plus closing divided by 2. What is the opening investment? 56,125 plus salvage value at the end 3,000 divided by 2. 29,562. Oh, okay. What is the answer? 20? ARR 20? 24.9. Clear? For B also the same. For B also profit after tax average is the same. Yes or no? For B also same. Clear? Next, the fifth one. Assume a business that is considering a given project. Below are some selected data for the discounted cash flow model created by the company's financial analyst. Very good, Gautami. A project requires an initial investment of rupees 1,91,315. Initial investment. Endama. So a project requires an initial investment of 1,91,315. Expected to generate the following net cash inflow. Year 1, year 2, 3, 4, 5 unda ekkundi 90. Compute discounted payback period. Compute discounted payback period of the project if the appropriate discount rate of a project is 12%. Discounted payback period. Instead of normal cash flows, we take discounted cash flows. So let us start this question. Illustration number 5. Calculation of a discounted payback period. Illustration number 5. Calculation of what? Discounted payback period. Calculation of discounted payback period. Columns. Here cash flow. For suppose if it is normal payback period, we take cumulative cash flows directly. Cumulative cash flows. But it is discounted payback period. So that's why year cash flow PVF at the rate of 12%. Discounted cash flow. Cumulative discounted cash flow. Cumulative discounted cash flow. Clear? These are the columns. Okay. How many years are there? Very good. 1, 2, 3, 4. 1, 2, 3, 4. Cash flow 90,000, 95,000. First is 95,000. Actual Sonia Gandhi will disturb again. ఆ అమ్మ ఏసీకి పాపం అల్లాడిపోతుంది. 95,000, 80,000, 60,000, 55,000. క్యాష్ ఫ్లో టోటల్ చేస్తున్నారా భాష? పాపం అనిపిస్తుంది అండి, ఏసీ వైపు చూస్తున్నావు. ప్రాబ్లం ఏమ్మా? పీవీఎఫ్ ప్రెసెంట్ వాల్యూ ఫ్యాక్టర్ 0.893. ఓకే, నెక్స్ట్ 0.797, 0.7, 0.712. రౌండింగ్ ఆఫ్ ప్రాపర్గా చేయాలి. డూ ప్రాపర్ రౌండింగ్ ఆఫ్. 0.636. డిస్కౌంటెడ్ క్యాష్ ఫ్లో 95,000 into 0.893, 84,000, 63,760, 63,760, right? 42, 7, 42,720, 34,980. Cumulative discounted cash flow 84,835. వసంత్ నువ్వు చెప్పమ్మా. 84,835. నెక్స్ట్ నెంబర్ 1,48,059. ఓకే, నెక్స్ట్ 1,91,000. నెక్స్ట్ వసంత్ 2,26,000. 2. Okay, what is our investment actually? 1 lakh 1,91,315. So directly answer is there. So 3 years. Payback period is equal to 3 years. Payback period is equal to 3 years. Otherwise తెలుసు కదా ఎలా చేయాలో. If in this case investment is equal to 2 lakhs, so then what is the answer? Payback period is equal to 3 years plus balance to be recovered 2 lakhs minus 191,315 divided by 34,980 into 1. In case if investment is equal to 2 lakhs. So this is how we do. But here initial investment is what? 1,91,315. So this calculation is not necessary. Done? So here the answer is what? Final answer 3 years. Answer is 3 years. But if initial investment is 2 lakhs, that is not given in question, but if initial investment is 2 lakhs, this is how the calculation has to be done. You will get 3.24 years. 3.24 years. Clear? Clear? Next. Illustration number 6. Illustration number 6. Same question, I think. Same question. NPV. NPV. How do we get NPV? Bring the future cash inflows to the present value. Minus what? Outflow. What is the outflow here? 2,25,000. So So 1295 is the NPV. So project seems to be attractive. See, no? Project seems to be attractive. Accept the project. Accept the project. Clear? 7. ABC Limited wishes to evaluate two mutually exclusive projects. Machine M and N are being considered, each costing 2 lakhs and having an estimated life of 5 years and 4 years respectively. Both have a nil salvage value. The anticipated cash flows after adjustment of a tax. Direct cash flows are given for M and N are given below. So cash flows are given directly. Find the NPV and ARR. NPV and ARR. NPV is simple. Bring the future cash flows to the present value. Yes or no? So NPV for first project is 48,290. Second one is 52,640. But ARR, be careful with ARR. ARR is equal to average profit after tax divided by average investment or initial investment. Okay. Here average profit after tax is given in the question or not? What is given in the question is, what is given in the question? Cash flows. Cash flows after tax are given. But ARR formula is average profit after tax. We require what? Average profit after tax. Clear? So what is average profit after tax? First average cash inflow. This 66,000 is what? Average cash inflow. 66,000 is average cash inflow. Average cash inflow. Shivapriya. Okay, but we should take average profit after tax. How do we get average profit after tax? Profit after tax, add depreciation, then you will get what? Cash inflow. Profit after tax, add depreciation, then you will get cash inflow, right? In this question, cash inflow is given. What is average cash inflow? 66,000. We should find out what? Profit after tax. So depreciation we should add or minus? Minus. Reduce depreciation from annual cash inflow. What is the depreciation? What is the depreciation? 40,000. Huh? So 66,000 minus 40,000 divided by what? Average investment. What is the average investment? 1 lakh. Why 1 lakh? 2 lakhs plus ending value 0 divided by 2. 1 lakh. So 26%. Clear? Samira? Which machine has to be selected under both alternative? Machine N is the best one. Machine N is the best one. So clear? Manisha. So 10th question repeat, right? Huh? Profitability index. So 10th, simple. Sum of a discounted cash inflow divided by sum of a discounted cash outflow. So try 9 and 8 and 9. Once go through the answers of 8 and 9 for next 7 minutes. Next concept IRR, internal rate of a return. IRR. internal rate of a return internal rate of a return IRR. So IRR is nothing but return from the project. Return from the project. IRR is return from the project. Return from the project. So we compare IRR with cost of a capital. So IRR means the return we are getting from the project. For example, IRR is 25. Cost of a capital is 20. So we are going to accept the project because shareholders are expecting, investors are expecting 20, but project is giving 25. So accept the project. Accept the project. Okay. Next, accept the project. If IRR is less than cost of a capital, for example, IRR is equal to 15%, but cost of a capital is 20. Reject the project. If IRR and cost of a capital both are same, either accept or reject. Either accept or reject. Clear? So now in IRR there are three models: single cash inflow, multiple even cash inflow, multiple uneven cash inflow. First, let us start with formula. A is equal to what? P into 1 plus I power n. Yes or no? Okay, amount is equal to P into 1 plus I power n. Amount is a future value, P is a present value. So P is equal to A into 1 divided by 1 plus I power n. A into 1 divided by 1 plus I power n. Yes or no? Okay. Nothing but future value, present value is equal to future value into present value factor 1 divided by 1 plus I power n. For example, 1 divided by 1.1 equal to 5 times. What is that? That is present value factor. So present value is equal to future value into present value factor. Clear? At foundation level, they used to give principle. For example, in time value of money, we have done one question. Amount is equal to 2 lakhs. Principal is equal to 1 lakh. 1 plus I power 5. N is given, but they asked you to find out what? I. So we have done by using a trial and error method. Yes or no? In calculator, we have taken 0.15. 0.15 plus 1 into 1 lakh press equal to how many times? 5 times. Yesterday we have done this question, right? You will get 2 lakh 1,000 something. So on trial and error basis we have done it. So at foundation level they will give 4 options. Interest, so 10%, 15, 20, 25. So we do a trial and error basis, 10 and then 15. So 15 is the answer. Yes or no? The same concept here also. At foundation level we call I as a interest rate. Now we call it as a IRR, internal rate of a return. For example, at foundation level we'll call 1 lakh as a principal, 2 lakh as a amount. 1 lakh as principal, 2 lakhs as amount. Now we call 1 lakh as an investment. 1 lakh is a investment. 2 lakhs is the cash flow at the end of a fifth year. 2 lakhs is the cash flow at the end of the fifth year. What is the IRR? The way of asking the question is different, but the concept is same. At foundation level, P is equal to 1 lakh, amount is equal to 5 lakhs. So I is equal to question mark. At inter level, initial investment is equal to 1 lakh. Cash inflow at the end of fifth year. Cash inflow at the end of fifth year, 2 lakhs. Calculate what? IRR. Interest rate is 15, IRR is also 15, but the way of asking the question is different. Okay, so if I have to find out IRR, what is this IRR actually? IRR means a rate, discount rate. IRR is the discount rate at which sum of a discounted cash inflow is equal to what? Initial investment. So IRR is return from the project, and IRR is also a discount rate. IRR is a discount rate at which sum of a discounted cash inflow is equal to sum of a discounted cash outflow. Adhodna. So, for example, present value is equal to future value into what? Present value factor. Let us assume initial investment is equal to 1 lakh. That is present value. That is present value. Sum of a discounted cash outflow, 1 lakh is equal to, what is the future value? 2 lakhs. Yes or no? Initial investment is equal to 1 lakh. By investing 1 lakh, we are able to get 2 lakhs at the end of a fifth year. At the end of a fifth year. Now, IRR is a discount rate at which sum of a discounted cash inflow. If you discount the 2 lakhs, the 2 lakhs must be equal to what? 1 lakh. The rate at which the discounted cash inflow is equal to initial investment, that rate is called as a IRR, nothing but return from the project. Return from the project. So for example, if you see question number 9, so if you see the question number 9, what is the NPV? 7840. Yes or no? 7840. Cost of a capital is? Cost of a capital 10%. If NPV is positive, accept the project, right? Why are we accepting the project? Because the reason is the investors are expecting 10%, but the project is giving more than 10. More than 10. That's why we got NPV positive. NPV positive. 10% is not the IRR. 10% is the cost of a capital. 10% is the cost of a capital. Return required to be earned by the company to meet the expectation of a investor. So IRR is greater than 10. IRR is greater than 10. Because if I discount the cash inflows, with the rate, that should be equal to what? 10 lakhs. The rate at which the discounted cash inflows are equal to initial investment, that rate is said to be what? IRR. So that value has to decrease. At 10% we got 10 lakhs 7,840. But we should get 10 lakhs. So in order to get 10 lakhs, rate has to be increased. If you increase the rate, value decreases. Yes or no? So that means IRR is greater than what? 10%. In question number 9, IRR is greater than what? 10%. So IRR is a discount rate at which discounted cash inflows are equal to discounted cash outflows. So 1 lakh is the initial investment. 1 lakh is the initial investment. 2 lakhs is the cash inflow. So 2 lakhs into what? Present value factor at the rate of IRR. If I discount that 2 lakhs, that amount must be equal to what? 1 lakh. Okay, clear? So this is being derived from the basic formula, that is A is equal to P into 1 plus I power n. You know that formula, right? So P is equal to A into 1 divided by 1 plus I power n. 1 divided by 1 plus I power n is nothing but what? Present value factor. Okay, so present value is equal to P means principal. Principal is present value. Amount is future value. So present value. Principal is nothing but initial cash outflow. Initial cash outflow. Future value is the future cash inflow. So that is what I have written. Now the present value factor is equal to present value factor is equal to 1 lakh divided by 2 lakhs. 0.5. 0.5. Now we should find out where does this 0.5 lies. We should find out the rate at which this 0.5 lies. Trial 1 at the rate of 10%. Trial 1 at the rate of 10%. So nothing but 1 divided by 1.1 equal to 5 times. Because I have told you that cash flow is at the end of 5th year. 0.621. But I should get 0.5. Value has to decrease. That means I have to increase the rate. If I increase the rate, the value decreases. So trial 2 at the rate of 15%. Then 0.497. So approximately the answer is 15%. Answer is 15%. Answer is what? 15%. IRR is equal to 15%. If you want to find out the accurate answer, what is the desired factor? The desired factor is 0.5. The desired factor 0.5 lies between 10% and 15%. That means IRR greater than 10% but less than 15%. IRR is greater than 10% but less than what? 15%. So that means, see the calculation. This is the complicated part. IRR is equal to greater than what? 10%. So 10% plus 10% plus. Definitely it is greater than 10%. For calculation of IRR, I am taking 10% as a base. 10% as a base. What is the factor at 10%? 0.621. But what is the desired factor? 0.5. At 10% the factor is 0.621, but the desired factor is 0.5. I should get the factor 0.5. That means I desire a change. What is the desired change? 0.621 minus 0.5. That is the change I require, divided by the given change. The change available is 0.621 minus 0.497. 0.621 minus 0.497 into what? 5. Nothing but, so what is the difference between 0.621 and 0.497? 0.124. For 0.124, the percentage difference is 5%, right? 0.621 is at 10%, 0.497 is at 15%. Yes or no? So difference between the factor is 0.124. For this difference in factor 0.124, difference in percentage is 5%. 5%. But what is the desired difference in factor? 0.121. So the question is, for 0.124, the percentage change is 5%. But I require for 0.121, Dharmateja, same. 0.121, what is the percentage change? 4.879. So the accurate answer is 10 plus 4.879. Nothing but 14.879 percentage is the accurate answer. If you want more accuracy, take the factor at 14%. This is 14.879. So what is the factor at 14%? 0.51. But I don't want 0.519. I want 0.5. So this time I am taking a base, 14% as a base. I'm taking 14% as a base. What is the desired change? 0.52519. 0.519 minus 0.5 divided by 0.519 minus 0.497 into what? This time into 1. Why 1? Why it is 1? Because I am taking 14% as a base. 14 and 15. 14 and 15. The difference in percentage is only 1%. So what is the difference between 0.519 and 0.497? 0.022. For 0.022, the percentage change is 1%. What is the desired change? 0.019. So this is called as interpolation. 0.864. So the accurate answer is 14.864. Earlier you got 14.879. If the gap is less, you will get more accurate answer. Second case, the gap is only 1%. In the above case, the gap is 5%. Clear? So this is called what? Interpolation. IRR. So this is a basic simple example with single cash flow. Investment is 1 lakh and benefit is 2 lakhs at the end of a fifth year. So when the cash flow is single, I will write initial cash outflow is equal to cash inflow into PVF. Initial outflow is equal to cash inflow into PVF. So this is derived from P is equal to A into 1 divided by 1 plus I power N. Clear? So generally we write at IRR initial cash outflow is equal to sum of a discounted cash inflow. Initial cash outflow is equal to cash inflow into PVF at the rate of IRR. What is the initial cash outflow here? 1 lakh. Cash inflow 2 lakhs into what? PV factor, present value factor. This is how we write when single cash flow is given. At IRR, initial cash outflow is equal to sum of a discounted cash inflow. Initial cash outflow is equal to cash inflow into PV factor at the rate of IRR. Then we find out PVF, present value factor, and thereafter trials. We have to find out the rate at which that particular factor lies, and that rate will be the IRR. Clear? So this is what for single cash flow. For suppose if it is even cash inflow, second category, what? Multiple even cash inflow. For example, if the capital bursting decision is yielding even cash flows, even means equal. Even means what? Equal cash inflow. Equal cash inflow. So then, example, initial cash outflow is equal to 1 lakh. Annual cash inflow is equal to 30,000. Annual cash inflow is equal to 30,000. Life 5 years. Life how many years? 5 years. IRR is equal to question mark. What is the difference between the previous question and this question? In this question, annual cash inflow, per annum cash inflow 30,000 and life is 5 years. So you are not getting benefit only 1 year. In previous question, benefit is only at the end of a 5th year. This time we are getting benefit for every year. For how many years? 5 years. So at IRR, initial cash outflow is equal to, at IRR, Chepama BT. Initial cash outflow is equal to, initial cash outflow is equal to, so initial cash outflow is equal to what? Sum of a discounted cash inflow. So initial cash outflow is equal to, this time instead of writing cash inflow, I should write annual cash inflow into present value annuity factor at the rate of IRR. At the rate of IRR. So this time I am writing PVAF, not PVF, PVAF, present value annuity factor. Why? Because we are receiving an annuity, same amount at same intervals. So what is the initial cash outflow? 1 lakh is equal to, what is the annual cash inflow? 30,000 into present value annuity factor. So PVAF is equal to 1 lakh divided by 30,000. You will get 3.33. We should find out the rate at which this PVAF 3.33 lies in annuity table. Okay, trial 1 Ashwant. At the rate of, trial 1 at the rate of 1%. trial egadadhan trial first trial 12 10 okay, thank you Bharat. 10% trial 1 at the rate of 10% PVF. So what to do? 1 divided by 1.1 is equal to 5 times GT press grand total 3.79. First trial and error. So we require 3.33, but we got 3.79. So whether to increase the rate or decrease? Rate increase or decrease? Increase, basic fundamental. Required return increases, value decreases. We want 3.33, so that's why increase the rate. Trial 2. Trial 2 at the rate of 12 11 12 13 అలా వేసుకుంటూ వెళ్తే అయిపోద్ది 15 present value annuity factor 3.35. But what is the desired factor? 3.33. So value has to further decrease. Value has to further decrease, yes or no? So that means the rate has to be increased or decreased? Rate has to be increased. This time do not take 20 because we need a slight difference. So that's why trial 3 at 16%. So PVF 3.27. 3.27. Clear? So IRR lies between what? IRR lies between 15 and 16 because desired factor 3.33 lies between 15 and 16. So IRR is equal to 15% plus. At 15% the factor is 3.35, but we require 3.33. So desired change 3.35 minus 3.33 divided by what is the change available? 3.35 minus 3.27 into what? Into 1, because we are taking difference between 15 and 16. So answer is 15.25%. 15.25% is the answer. Clear? You can take 16% as a base also. 16%. 16% means plus or minus? Minus, because IRR is less than 16. Or else, what is 16% factor? 16% plus. Example, 16% plus. What is the factor at 16%? 3.27 minus desired factor 3.33. Automatically you will get negative. Divided by 3.35 minus 3.27 into 1. Again you will get same answer, 15.25%. 15.25%. So clear? Clear? IRR, second method, even cash inflow. Even cash inflow. చేసావు మా లాస్ట్ మస్తాన్ భాషనా ఓకే ఓకే 15.25%. 15.25%. మనోజ్ Clear our second method? Anchika, clear our second method? Unna? Esava sleep. Next third method. Next third model. Uneven cash inflow. Uneven cash inflow. Uneven cash inflow. So next one, uneven cash inflow. Uneven cash inflow. For question number 10, we can find out what? For question number 10, we can find out what? IRR. 9, sorry. Question number 9. For question number 9, what is the sum of a discounted cash inflow? 10 lakh 7,840. Yes or no? Question number 9. Uneven. Uneven means not equal. Uneven cash inflows. Uneven what? Cash inflows. Uneven cash inflows. Okay. Shall we start uneven cash inflow? So we are using the same facts given in the question number 9. So what is the sum of a discounted cash inflow at the rate of 10%? 10 lakh 7,840 rupees. IRR is a discount rate at which sum of a discounted cash inflows are equal to outflow. What is the outflow? 10 lakhs. But we got 10 lakh 7,840. But we should get 10 lakhs. The value has to decrease. Value has to decrease. That means increase rate. Let us increase the rate. So let us take what? 15, huh? 12, okay, 12. There is a slight difference, so that's why let us take what? 12. So sum of a discounted cash inflows at the rate of 12%. So tell me the columns. Year, cash flow, PV factor at the rate of 12%, discounted cash flow. Yes or no? Year 1, 2, 3, 4, 5. 4 years. 5 annaru. Okay, cash flow. Dharmadeja, cash flow. Cash flow 3 lakhs. 3 lakhs. 4 years 3 lakhs na. 4 years 3 lakhs ekkada asalu? Question number 9. 270కి వెళ్ళిపోయారు మీరు. ఇది కదమ్మా, క్యాష్ ఫ్లో ఆఫ్టర్ ట్యాక్స్ ఈజ్ 3 lakhs, 3 lakhs, 3 lakhs, 20, 2 lakh 20, 1 lakh 80. Five years, ఆన్సర్ రాంగా. 10 lakhs 7,840 కూడా రాంగా. Okay, let us take that cash flows. 3 lakhs, 3 lakhs, 3 lakhs, 2 lakh 20, 1 lakh 80. 5 years. Tell me the cash flows. 3 lakhs, 3 lakhs, 3 lakhs, 2 lakh 20, 1 lakh 80. For example, if these cash flows are given and discounted at the rate of 10%, will you get 10 lakh 7,840 or not? No. ఆన్సర్ రాంగ్ అంటున్నారు. ఓకే, నేను అడుగుతున్న క్వశ్చన్ ఏంటంటే ఇఫ్ యూఆర్ డిస్కౌంటింగ్ at 10%, 9 lakh 3 lakhs into 0.909, 3 lakhs into 0.826, 3 lakhs into 0.751, 2 lakh 20 into 0.683, 1 lakh 80 into 0.621. What is the total? I'm explaining the concept. Just I want to explain the concept. So the answer might be wrong, but still, to understand the concept, what is relevant is sum of our discounted cash inflows at the rate of 10%, 10 lakh 7,840. Yes or no? Yes. Okay. So forget about the previous, data. Now at 10% you got sum of a discounted cash inflows 10 lakh 7,840. Now let us discount using 12%. Why are we discounting using 12%? Because I should get 10 lakhs. Outflow is equal to 10 lakhs. I should get 10 lakhs. So that's why I'm increasing the rate. What is the PV factor, Mahesh? PV factor 0.893, 0.797, 0.712, 0.636, 0.567. Discounted cash flow 2 lakh 267 900, 2 lakh 39,100, 2 lakh 30,600, 213,600. Very good, Amma Bharat. 213,600. Next 139,920. Next 1,02,060 na total 9,62,580. సౌమ్య ఇదా మీరు చెప్పింది ఇందాక 9,62,580. I'm just explaining the IRR concept using the data given in question number 9. Okay, so I'm just taking the cash flows after tax. Clear? So what is the amount? 9,62,580. So now tell me, okay, what is the desired cash inflow? Sum of our discounted cash inflows must be equal to what? 10 lakhs, which lies between 10% and 12%. 10% and 12%. So IRR is equal to what? 10 percentage plus 10 percentage plus what? 10 percentage plus 10 lakh 7,840 minus 10 lakhs. This is the desired change. Yes or no? I am taking 10% as a base. At 10 lakhs it is 10 lakh 7,840, but I require what? 10 lakhs. This is a desired change divided by 10 lakh 7,840 minus 9 lakh 62,580 into 2 into 2. So what is the answer? 10.34%. 10.34% is the answer. 10.34% is the answer. Clear? So this is the IRR, which is greater than cost of our capital, that is 10%. So that's why we have accepted the project. Clear? When cash inflows are uneven, then on trial and error basis we find out sum of our discounted cash inflows. At 10% we got 10,07,840. At 12% we got 9,62,580. The desired cash inflow 10 lakhs lies between 10 and 12. Clear? Idendam IRR, uneven cash inflow. Uneven cash inflow. Clear? Okay. So 10, next what, 11. So see the 11th one. Calculate IRR by using interpolation technique. Interpolation technique, Charan. Interpolation technique. When initial investment is rupees 56,000, initial investment is 56,000. At 10% it is 60,000 and at 11% it is 50,000. Initial investment 56,000. That means the desired, what is the desired cash inflow? 56,000, which lies between 10 and 11. So tell me the calculation. Answer is 10% plus. At 10% we got 60,000 minus 56,000 divided by 60,000 minus what? 50,000 into what? Into 1. Clear? 10.4%. 10.4%. Okay. Done. So if you want to write it as a formula, then lower rate of interest plus present value at lower rate of interest minus cash outflow divided by present value at lower rate minus present value at a higher rate into difference. If you want to by heart the formula, that's okay, fine. Clear? 11th one. So 12th one, modified IRR. See the illustration number 15. Illustration number 15. So Vedika Limited with an limited investment funds 6 lakhs is evaluating the desirability of 5 investment proposals. Their profiles are summarized below. Project investment, annual cash inflow, life. Project investment, annual cash inflow and life. Project N and Q are mutually exclusive. The cost of a fund is 10%. Find out the feasible combination of a project and rank them on the basis of NPV. On the basis of NPV. Okay. So now, mutually exclusive. What is the amount available? 6 lakhs. M investment amount is 1 lakh, N 2 lakhs, O 2 lakh 40, P 3 lakhs, Q 4 lakhs. What is the total? 10 lakh 40,000. 10 or 12? 12 lakh. So 12 lakh 40,000. Okay, so 12 lakh 40,000 is the overall investment required, but we have only 6 lakhs. Prasu, we have only 6 lakhs. So this situation is called as a capital rationing situation. Capital rationing situation. Okay. So can we accept all the 5 projects? No. We cannot accept 5 projects, right? So first we should find out NPV. How do we get NPV? Sum of our discounted cash inflow minus sum of our discounted cash outflow. So first project, 36,000 is the cash flow, and for 10 years what is the factor? 6.145. 2,21,220 is the what? The sum of our discounted cash inflow. NPV 1,21,220. So 121,220 is the NPV, net present value. And N, what is the cash flow? 1 lakh. What is the life? 4 years. Factor is 3.170. So 3,17,000 minus 2 lakhs, 1,17,000. So 1,17,000 is the NPV. Next, likewise O, P and Q. These are the NPVs. All the NPVs are positive. All the NPVs are positive. All the NPVs are positive. But we cannot accept all the projects because we have a limited funds. What is the fund? 6 lakhs. Okay. So what combination can we accept actually? Combination. I can accept M, N, O. First combination I can accept is M, N, O, because total investment is equal to 1 plus 2 plus 2.4, total 5.4 lakhs. So first combination I can accept is M, N, O. Yes or no? P also, na? P I cannot accept. Why? What is the P investment? 3 lakhs. What is the fund available? 6 lakhs. So the first combination is M, N, O. And the second combination M, N, P. M, N, P. M, N, Q. Is it possible? M, N, Q. M, N, Q is not possible. 1, 2 and 4. Total 7. But we have only 6 lakhs. Yes or no? So what is the next combination? With M, is there any other possibility? M, O, P, not possible. M, O, Q, not possible. M, N, M, N, P, already written. MNO పొద్దునే అయిపోయిందమ్మా. With M, is there any combination with M? M. With M, is there any combination possible? No. With M, M, M for Manisha. M and Q possible, ah? M and Q, how is it possible? M 1 lakh, N 2 lakhs, Q 4 lakhs. M Q అది చెప్పండి ముందు. M అండ్ Q. ఓకే, నీ ఎక్స్ప్రెషన్స్ బాగున్నాయేమో కానీ M and Q with M. So 3 combinations. So leave M. Next what? N. With N I can accept what? N NP, because NO already included in M and O. So that's why NP, NP and NQ, NP and NQ also, NP and what? NQ, NQ is also possible. NN, NQ. Okay, NQ mutual exclusive. Okay, I'm sorry. NQ is mutually exclusive, so that's why we cannot take N and Q. What is the next combination? O and P. Is there any other combination? No. For these combinations, we should find out NPV. So MNP, what is the NPV? M 1,21,220 plus 1,17,000 plus 3,25,920. Overall, Charan 5,64,140. Next, M, N, and O. So 1 lakh, 1,21,220 plus 1,17,000 plus 80,100. 3,18,320. Shivpriya, what is your answer? Sanjay, next. O and P. O and P. 80,100 plus 3,25,920. 4,06,020. Next, M and Q. 1,21,220 plus 1,44,620. 2,65,840. Very good, Amma. Next, N and P. N and P. 4 lakhs. So, which combination is having a highest NPV? M and P. Second highest. N and P. O and P. N and P. Next. O and P. Next, Sirisha. M and O. Next, M and Q. So, which is the best combination? So, as the funds are limited, we should accept project M, Manisha, project N, Nahatma, and next project P, Prasu. Okay, that is the combination. Best combination, okay? So, this will be done when the projects are indivisible. Projects are indivisible. That means you have to make a full investment. We cannot make a part investment. If the projects are divisible, then we give a ranking based on a profitability index. We give a ranking based on a profitability index. Abhi, profitability index. If a projects are divisible, Ushasri, ranking will be given on the basis of what? Profitability index. Okay. ఏంటమ్మా గణేష్ బ్రేకా తీసుకుందాం కానీ ఒకసారి నెక్స్ట్ దా 14. If you see the 14th question, profitability index is calculated. If you see the 14th question, projects are divisible and projects are indivisible. Projects are divisible means what? We can make a part investments also. Part investment also. In that case, what we find out profitability index. Okay, profitability index. So project A, what is the profitability index? 1.43, 1.64, 1.4, 1.5, 1.8, 0.67. Rank 1 goes to what? 1.8. That means project E. Project E. Clear? So that means the fund will be invested first in project E. What is the investment in project E? 55 lakhs. What is the fund available? 1.5 CR. 1.5 crores. And what is the next highest profitability index? Project B. So 25 lakhs invested in project B. So next highest 1.5. So 20 lakhs invested in D. So total amount spent 1 CR. Total amount spent 1 CR. We have a 50 lakhs more. Next highest 1.43. 1.43 investment size is 70 lakhs, but we are going to invest only 50 lakhs. So the pattern of investment is 55 lakhs in E, 20 lakhs in D, 25 lakhs in B, and 50 lakhs in A. 50 lakhs in A. How much NPV are you going to get? NPV 45 lakhs. 45 lakhs plus 16 lakhs plus what? 10 lakhs plus next project A. A, we are not making a full investment. We are making only 50 lakhs investment. So that's why 50 lakhs into 50 lakhs into what? 50 lakhs into what? You should take 1.43 minus 1. 50 lakhs into 1.43 minus 1. 50 lakhs into 1.43 minus 1. 1.43 is the profitability index. Inflow for every 1 rupee, outflow. 1.43 minus 1. 0.43 is the NPV for 1 rupee. NPV for 1 rupee. What is the amount of investment? 50 lakhs. So 50 lakhs into 0.43. 21 lakh. So you should add, you should take here 21 lakh 50,000. So the overall NPV is 45 lakhs plus 16 lakhs plus 10 lakhs plus 21 lakh 50,000. 92 lakh. So 92 lakh 50,000 is the answer. So see, this is when projects are divisible. If the projects are indivisible, then combination of projects will be taken. Like in previous question. Like in previous question, we take a combination of projects. So clear? So this is what capital rationing. Capital rationing. When the funds are limited. So we should see whether the projects are divisible or indivisible. If the projects are divisible, so we select the projects basis on the basis of profitability index. If the projects are indivisible, projects are selected based on NPV, I mean combination. We select the projects, we select a combination which is having a highest NPV. So clear? ఒకసారి చూడండి అవి questions 14 and 15.